Welcome to Yahoo Finance and welcome to a live episode of the Opening Bid podcast. I'm Yahoo Finance executive editor Brian Sazi, and normally we tape this big, beautiful podcast from the NASDAQ market site in Times Square, but today we have something special. We are coming to you live from our second annual Invest Conference at Second in New York City. I am so jacked up about this conference. I got absolutely zero sleep. We got Brian Moynihan on tap. We got Marc, Rowan, the CEO of Apollo, on tap. Amazing guests, but for right now, we're going to bring some of these conversations to life and really dig into euphoric markets. That includes Tesla ripping to new highs, crypto touching close to 90,000 with two friends of the show, Sarah Malik, president of Nuveen Equities and Fixed Income and chief investment officer, and Neil Richardson, another friend of the show, chief economist and ESG officer at ADP. Good to see you.
Nice.
Feels like a football program here, like bringing this to life. I just need everybody to start clapping around me. So good to see you guys. Welcome to Invest. I want to start with you, Sarah, because we are seeing full-on euphoria in these markets in the wake of the election. What is going on?
Well, Brian, I think if the Trump trade and the meme stock mania had a baby, that would be what we saw in the past week. But what are we focusing on? Well, everyone's thinking about taxes, tariffs, and regulations, and what does that mean for the economy and the market? So I think three things to think about. The deficit, what does it mean for the economy? What does it mean for inflation? So first of all, it is concerning as to how much spending is going to go on next year, and will that blow out the deficit? Also for the economy, could all of these policies in place lead to an overheating economy? And what does it mean for inflation? From a portfolio point of view, though, what we're looking at in terms of portfolio positioning is, first of all, the Fed. I think the Fed, because of the strength of the economy and potential sticky to accelerating inflation, the Fed's going to cut rates less than the market expects. The market thinks one more rate cut in December for next year. We think we're going to be lower than that when all is said and done. Second, market's going to broaden. It's been broadening since July. Tech stocks have moved a little bit more out of favor. They've moved even more out of favor in the last weeks. I think the broader market's going to be picking up the slack. So those are two key factors that we're thinking about. And then finally, valuations. Let's talk about that. Where do we go from here? S&P 500 trading at about 22 times forward PE.
Seems expensive.
It does. When you think about the last time in the last quarter century when it traded higher, in March 2020, it traded at 24 times PE. The S&P is expensive, but markets don't die of old age. We need a catalyst to take this market down. We don't really have that catalyst at this point.
Neil, we joked off camera, like, I don't know, is the economy growing like 8% next year? No, but like the market, it feels like the market is ready and now expecting like great things from an economic standpoint next year. In the wake of the election, I mean, as an economist, have you raised your GDP forecast? You're expecting a consumer spending boom. Like, debunk a little bit what the market is expecting.
You know, we started off, Brian, and good morning. Good morning, Sarah. We started off talking about this feels like a football energy to it, and I've been following football quite a bit. Go Hoosiers, undefeated. Anyway, the fundamentals of the economy are fantastic. It's not a perfect economy, and we can drill down on why it's not perfect, but it's really good. If you look across, if you're looking at the fundamentals, what are you seeing? You're seeing pretty low maintained unemployment. You're seeing that firms are hiring. Let's put this October report aside. After a malaise through the summer in hiring, we saw a pickup at ADP in September, a pickup in October, all firm sizes participating in this resurgence in hiring after we got some certainty. I think that certainty is a game changer. What firms were waiting on is a bit of clarity. And they've received it. They received it from the election definitively, decisively. We expected this decision to take a few weeks.
Hey, we got a winner.
We got a person.
Yeah, a person.
And we saw that the Fed was committed to continuing these rate cuts. So those two pieces of an uncertain picture were now clarified, and I think that boosted the markets more than anything. It's the certainty and the fundamentals together.
Are you confident, though, that as potentially, and I say potentially because that's what the market is trading on here, that we get an acceleration in the economy next year?
No. There is no foregone. We're not even confident, honestly, given what we're seeing in services inflation, given what we're seeing in this resurgence of hiring. There is no confidence that even inflation will continue to trend down in a straight line. It's going to be a bumpy path. That last mile, those last few inches towards the goal are sometimes the toughest, and I think that's what you're going to see in 2025 as you look around the world and pockets of inflationary trends that could feed back into the U.S. economy.
How big a risk is that, Sarah, to the investment thesis here? The market is asset values are reflating, but if we get a reflation in the economy, you don't get those Fed rate cuts, and then does that blow up the Trump trade?
I think the last mile of inflation is the key risk for 2025, and you are seeing inflation expectations pick up. University of Michigan inflation expectations has picked up to, on the one-year basis, 2.6%, 5 to 10-year, 3.1%. People are concerned that these policies of more spending, tax cuts, tariffs are going to lead to greater inflation. And then the flip side of that, Neela brought up a couple of good points. One was that markets hate uncertainty, so what they're happy about post last Tuesday is that we have certainty and we got it quickly, but also talking about payrolls. October payrolls, hopefully an anomaly coming in at plus 12,000, but it also shows that perhaps September payrolls, which were a little over 250,000, were also an anomaly. So where are the employment markets right now, and what does that mean? Because if you're going to have a bit of a pickup in inflation, we need the U.S. economy to hold up. Employment and consumer has been holding up the U.S. economy. If both of those don't stay where they are or at levels that are expansionary, then we could have an issue and start talking about that word we all hate to talk about, which is stagflation.
You think we're in a what's the potential for a stagflationary environment?
Not seeing it yet. I mean, this economy has been characterized in so many ways: soft landing, hard landing, recession, stagflation.
Well, I love writing about stagflation because people, they see the word, they're like, oh, I don't know, sounds interesting. I don't know, let's click through.
It's a word we haven't talked about in a few weeks, so let's choose that one.
Absolutely.
But if you look at actual fundamentals, you'll see that hiring is still strong, and like Sarah mentioned, it's supporting really robust and resilient consumer spending. I think this economy has landed. I think it landed like last year. We're just sitting on the tarmac at Newark Airport waiting for
Nobody
the all
wants
clear.
to be at Newark. Sorry, Newark. Like, nobody likes your airport. Like, anybody.
Those are your words.
No, it's fair. No, it's fair. I'll take the heat.
But there is a sense that this economy has landed, that inflation has come down tremendously close to the Fed target. Now, that last mile is important, but as long as we can sustain steady hiring and an employed consumer, then we're good to go for 2025. And if you look at other pieces of data besides that, I think hurricane and strike affected October BLS release, what will you see? You'll see that jobless claims are still really, really low. Not just low for now, they're low historically. If you look at ADP data, we pay 1 in 6 workers in the United States, strong, robust hiring there. Where you see weakness is manufacturing, and that is a cause for concern because manufacturing is very cyclical. That industry should benefit the most from rate cuts. The fact that it isn't yet is a problem, and I think that's a systemic structural problem, not something that the Fed can help with.
We've got a lot of cool people that are going to be at this event, but a lot of them will be the average investor. I mean, that is the Yahoo Finance community. And they're going to come in here, they're going to enjoy their time, but they're going to go back home and they still see prices for stuff high. They'll go to the grocery store, eggs are still high, cereal prices still high. Like, why is inflation maybe not coming down to the extent some of these folks would think?
2 reasons. And yes, we have a grumpy consumer that's still spending. And the reason why is that as economists, we focus on rates. We love rates. Rates come down. But as a consumer, even I as an economist walk into a store and say, man,
when did cereal become like $8 a box? And there's like less cereal in the box. It's like this.
It's where are these prices coming from? Yeah. I immediately stop being an economist and start being a consumer. And yes, I'm mad about the box of cereal. It's $8, exactly. But also from the labor market's perspective, real wages haven't grown all that long. And so the consumer has been missing out on real wage gains. Even though wage growth was high, inflation was higher. And so we haven't had a consumer that's really benefited from real wage growth to make up for what they lost when we were coming out of the high inflation period. So that's the issue.
Sarah, do you think, can the Fed cut rates while cereal prices are still $8? I mean, I'm just putting in like super simple terms, but they've cut rates now a couple times. Do they risk sowing the seeds of more inflation, and then they have to stop and the market just gets all chaotic in the middle of next year?
Well, I think first of all, just touching on the consumer, which Neela talked about, the strength of the consumer has been tilted to the high-end consumer. So I think that's another, under the surface, what we need to think about is that some of the lower-end consumer, they have been really impacted more so than other areas. That's one area to think about also. I think that that's going to be the Fed's conundrum, is that this last mile of inflation is staying between probably 2 and 3% for the foreseeable future, yet the markets want the Fed to cut rates 5 times. How do we do that? I think that's where we're going to run into an issue, and we're going to see less Fed rate cuts than the market wants, which has been a theme for this entire cycle. Remember, beginning of this year, we came in expecting 7, equivalent of 7 rate cuts.
I was at Davos. I'm like, wow, we're getting like 7 rate cuts. It was like, well, no, it's not happening.
So, I mean, we'll be lucky if we'll get 3 to 4 in the end. And what are we going to get next year? I don't think we are going to get 4 because of the issue of inflation. And secondarily, as we've talked about, the economy remains quite strong. So that's not an era for the Fed to cut rates. And we're already seeing with this sort of easy monetary fiscal policy what's happening with the markets, which is also creating a wealth effect. There's just a lot of liquidity already out there in the system. And in some way, we're going to have to probably pull that back a bit, or we're going to keep moving into what could be called a bubble territory.
Sarah, as someone that oversees a large sum of money, where do you stand on, it could be a rocky year for the Federal Reserve and Jerome Powell. The president comes in, maybe critiques Powell again, but like how important is that for you that the Fed is a true independent institution?
I mean, I think it is important for the Fed to act independently in their battle. And I also think a lot of the risk now is going to shift to the Fed. And what do they do in terms of managing rate cuts in order to finally get inflation to where consumers and the economy needs it to be? And can they do that while keeping the economy strong? And that gets back to soft landing, hard landing, no landing. Where are we in this cycle is all going to be very important. What we're looking at is, I think, first of all, for large asset managers, what we've seen starting in early July, there was a shift away from technology. So roll into, let's go backwards, Feb 2023. That's when the AI trade became, very well known. Those stocks took off. They basically drove the markets until early July 2024. And since then, we have seen this broadening out of the market to other sectors. And then with the expectation for Trump winning, markets became even broader. Now the meme stocks are participating. So for large asset managers, we need to be able to position outside of growth into more cyclicals and also make sure that we're well positioned across defensive stocks in case the economy does start to slow down. So those are the kind of things we've been thinking about, staying higher quality for when or if that recession comes, and if rates stay high and companies with large debt burdens on their balance sheets start to struggle.
Hang with us. We're going to go off for a quick break because we got to pay those bills. We'll be right back here on Opening Bid live from the Invest Conference. All right, welcome back to Yahoo Finance and a live episode of the Opening Bid podcast. I'm Yahoo Finance Executive Editor Brian Sozzi, coming to you live from our second annual Invest Conference here in New York City at Second. So jazzed about the lineup and the programming we are about to bring to you. Also jazzed about this conversation we've been having on stocks and the economy with Sarah Malik and Neil Richardson. Neil, let me go back to you. How should an investor think about the Trump economy in 2025? How will it be defined?
I think it's, first of all, Brian, important to reset all of your assumptions about what works and what doesn't work in the economy and follow the data. Now, we can criticize the Fed at times for being maybe too data dependent, but where they haven't gone wrong is how anchored they have been on the here and now and what's happening in the economy. Investors like to project. That's how they make money, right, Sarah? But in this economy, it's really important to follow the data. Look at the labor market, understand what the consumer is. When it comes to policy moves, look at the fine print over the macro policy. If you're thinking through different scenarios on tariffs, and scenario analysis is going to be really important, look at the product exclusion list, not just the policy, because that's going to complete the picture for you. If you're a retail investor, focus on the consumer. It's your most important data point. You know, there's going to be a lot said in the news media, there's going to be a lot said with the policy, but the consumer never bends the truth. The consumer always knows what the consumer's position is, and if the consumer is still spending, that means the economy is still strong.
Can government, though, a new administration, can they enact change quick enough to, you go from economy, like you were talking about, that's not perfect, and you have a market now expecting that at some point it does hit perfect levels next year. I mean, like, is it mid-year 2025, or it takes a year or two?
I'm going to make a prediction.
Okay.
The economy will never be perfect.
Will never be perfect. Okay. I'm trying to be hopeful
You heard it here
I'm trying to be
first,
hopeful. Okay. that's going to be one of the headlines. It will not be perfect.
But there's going to be places of strength, and you have to look at those places. We've seen generative AI take over the consumer imagination, at least in my house, and stocks have rallied on that. If that's a place of strength, then you have at least a direction to watch going into next year. I've said that manufacturing has been weak. What role is manufacturing playing in your overall portfolio? Because you want a little bit of that. But how manufacturing fares in 2025 will be the test of policy. Because it was weak going into the pandemic, it's been weak coming out of the pandemic. It's critical in terms of American overall strength long term. If manufacturing turns around, then that would be a big game changer for the US economy over the long term, not just the short term.
I'm going to make fun of myself here, Sarah. I hate when I ask, are we in a bubble? Because I sound like a clown. I'll ask you. I have no other way to ask it. I mean, are we seeing a bubble happen in markets based on assumptions to the economy that may not happen?
Well, first of all, I'm glad you're no longer asking me about cereal, because you're making me you're making me hungry for
these prices are live.
For my favorite cereal, which was Fruit Loops, by the way, when I was a kid. I love them.
That's a close second to mine.
I'm a rice trace guy. I'm a rice trace.
What were you? I was all for the sugar. If you look at valuations, we talked about this a little earlier. S&P at 22 times. Go back a quarter century, you're going to find a higher valuation one time in March 2020 when it was 24 times. So the valuations, you might argue, were in a bubble. But there's a lot of differences from the late 90s to today. In the late 90s, I was a small cap growth portfolio manager, so I remember it well, almost have PTSD from it. Tech stocks were a lot different back then. They were unprofitable. They didn't really have a proper growth path. AI is here to stay. The mega cap 7 companies are obviously very profitable, strong growers, structural growth going forward. I don't think it's a tech bubble. Talking about other areas of the market that have worked in the last week, small caps, banks, crypto.
Banks have been on fire.
And these are, again, none of these, looking at small caps and banks where, areas that we're invested, these are fundamentally strong companies. Small caps are still trading at about a 2-decade low versus large caps. So in no way would you say those are expensive, and they have a lot of tailwinds now with lower taxes, lower interest rates, which is good for their debt burdens, and tariffs, which is better for domestically oriented companies, of which small caps have more of a domestic profile than large caps do. Banks, same thing. Easier regulations for banks should make banks stronger and have better growth going forward. So these areas that are on fire in the last week are certainly not in bubble territory. So barring valuations, and as I said earlier, bull markets don't die of old age, I don't think we are in bubble territory. I think this is a market that still in the near term has upside unless we hit that inflation wall going forward.
Can you unpack what we're seeing in Tesla? Like, I know you're not I'm making calls on the stock. Like for the average person, like what is going on to wake up on a Monday yesterday and see the stock explode? It is a $1 trillion market cap. Like, what is the psychology behind what's happening with that?
I think there's two factors to think about with Tesla. One is the fundamentals, and second is Elon Musk's influence, within Tesla. So fundamentally, think about Tesla. The shift to electric vehicles, shift to renewable energy is a trend that's in place. It's going to remain in place. So that is for the long term, Tesla has a lot of growth trajectory in front of it. And then, of course, with Elon Musk and his relationship with Donald Trump and with the Republicans, I think there was also a lot of attention brought to Tesla, which made the stock spike. It had not been a winner year to date in general versus the other Mag 7, so it had been a laggard. This is part of a catch-up trade for the stock. And then, as I mentioned, strong long-term fundamentals and that shift to electric vehicles and more use of renewable energy is still in place for the stock. Now, with these stocks reacting so strongly in the past week or so, and what we're seeing today is them starting to settle down, and Trump, of course, not even in office yet, I think it's not going to be straight up and to the right from here on out. There's going to be a settling period, a period of churn until Trump comes in and we really see the policies and the impact of what he puts into place.
What's your view on crypto? Is it part of Nuveen? I mean, is it something like you have to at some point be involved with if this administration becomes more friendly to digital assets? I mean, to see Bitcoin knocking on the door of $90,000. That's a huge move.
That buys a lot of cereal.
That buys a lot of cereal and maybe gets me like a new car, like a couple watches, but it's crazy.
First of all, looking at crypto, it's a play on easier regulations, which is positive for the currency. It's an area that we're always watching. My concern and my hesitation when looking at crypto is it can be very volatile. So similar to the volatility of equities, probably times 5. Liquidity can be an issue with crypto. So there are and fundamentals can be hard to analyze, and you've seen that with these price moves. And so it's difficult as a fundamental investor to say, okay, like what's your price target on crypto? And then on top of it, if you're, for people who have cash on the sidelines, there's still trillions of cash sitting in T-bills and CDs, earning a lot less than what the equity markets are returning, which is about 25% year to date on equities. And they're trying to move their money back into the markets in a low risk way. So I think they're more thinking about fixed income, defensive, lower volatility equities than they are about, let me take my cash and put it into crypto and see how it does.
And I think these short-term trends that you're seeing maybe post-election are going to collide with the demographic changes we're already seeing in the country, right? Yes, it might make sense to move from cash into stock, but you have a large contingent of retirees who want their safe and secure asset. So here's where the difference is going to become, is the long term versus the short term. And I think it's going to be exacerbated next year because so much is changing. And if I could say a little bit about the fundamentals of the U.S. economy, maybe not Tesla stock.
If you want to comment on that too, we'll take it.
But one thing we're going to see, I think, is lower, more moderate hiring going forward. That is just the aftermath of a large recovery. But I will contend that the hiring we've seen lately is more robust, even though it's been on average lower than the hiring we saw in 22, 23. That was replacement hiring. Now, when firms are hiring, it's because they want to grow their workforce, not replace it. And the hiring has been broad-based. It's not, except for manufacturing, we've seen all service sector firms participate. What that means is it's not being carried by a couple of hard-hit pandemic sectors like leisure and hospitality and healthcare. So if you're thinking about the sectorial or the industry makeup of your portfolio, having a labor market that supports widespread growth across the service sector will be a help in terms of like having this more broad-based investment plan as opposed to a few sectors that are working.
No, that's a really good point. In the final minutes that we have on opening bid, we always like to get our guests' hot takes. Maybe I think on the economy, what is your hot take or biggest prediction for the economy in 2025? What might surprise people?
That Taylor Swift doesn't make as much money in 2025 as she does in 2024.
But she's still going to power the economy, right?
Yes,
okay.
Several, but not as much strength as we did. I'm on the spur of the moment.
Are you a Swiftie? I mean, you're a Swiftie?
Of course, who
really?
isn't?
Neither are my kids.
Not a Swiftie. No.
Didn't go to the concert.
Okay, one non-Swiftie.
Okay, all right. Sarah, over to you. A hot take for 2025. Maybe it's a big call on markets or sector, whatever you got.
Well, it's interesting. The focus is nonstop on the U.S. right now, deservedly so. Not a lot of talk about non-U.S., especially unless it's about China. And what are the tariffs going to be just applied to China or more broadly? What does that mean for the rest of the world?
Take up that cereal box for like $12.
What's going on with geopolitical issues, and what does that mean for the markets? I think a lot of that is sort of getting pushed to the wayside right now, and it's going to become very important, and it still is important as of today. Maybe two more hot takes will just be on. I mentioned small caps, one of our top areas, given how cheap they are and given the new administration and their view. A couple of stocks that we like: Addus Home Care and Lumenum. Addus Home Care, a play on aging demographics and home health care within the house. M&A activity, which we expect to pick up in 2025, I think could be positive for them as they add on acquisitions. And Lumenum, a photonics and optical play, also is a play on AI, data centers, more telecom building in the U.S. I do think infrastructure in the U.S. will continue to grow, and that's a play on that.
I would have to add to the global picture, it's been a support for the U.S. economy. If it goes awry, it will be a headwind. So we can't write off the global sector. It's really super important to the growth in 2025.
What you want to see is our producer Ray off camera here. She loves these hot takes. These were her ideas, so she's got like 9 of them here. So I hope we gave enough to Ray. She's giving me a thumbs up. Thumbs up, there we go, amazing. On a personal, thank you guys both for doing this, coming to us at our Invest conference. It's early. You were both early supporters of Yahoo Finance, literally since day one we launched, and I thank you very much. Amazing conversation. Neela Richardson, Chief Economist and ESG Officer at ADP, and Sarah Malik, President of New Equities and Fixed Income, and Chief Investment Officer. Big title, big responsibilities. Thank you so much. Have a great rest of the week.
Thank you, Brian.
All right, much more ahead from the Invest conference on Yahoo Finance. We'll be right back with Shauna Smith and Madison Mills going to bring you inside our big, beautiful, amazing conference. We'll be right back.
Welcome to Yahoo Finance's flagship event, Invest. I'm Shauna Smith alongside Madison Mills here in New York City. And we have a jam-packed lineup of the biggest names in business, markets, and the economy, looking at the key themes that are affecting your money. Leaders across industries from finance and banking to healthcare, technology, and even defense are here giving you first-hand look at the health of the economy. And that information can help you make the best investment decisions.
And we are just 15 minutes away from the start of our program. You're going to be hearing from Apollo's CEO, Marc Rowan. Apollo, of course, the parent company of Yahoo Finance. Also this morning, you're going to be hearing from BlackRock's Rick Ryder and Macy's chairman and CEO, Tony Spring. Sean, I know we've got a big day ahead. I'm going to be chatting with Tom Steyer later today and Deena Shakir as well over at Lux Capital. But a big day of conversations here at Yahoo Finance.
It certainly is going to be a massive day. We've got Marc Rowan up first, the CEO of Apollo. Will certainly be very interesting just to get his insight on the market's reaction to the election outcome, just what he sees right now as a landscape for the economy, any insight just in terms of how optimistic he is heading into the new year. And I also think deal-making activity. You and I have talked to so many guests over the last several weeks, and especially here over the last week since we did get the election outcome, just whether or not that landscape is going to improve. So, of course, any insight there in terms of what Apollo is thinking and where they see the best strategy going forward, I think will certainly be very interesting. And then Rick Ryder over at BlackRock, he's going to be great just to get his sense on the bond market's reaction, right? What we have certainly seen play out, a bit of the selling that we've seen going on there, and just his assessment of where things stand for the economy and whether or not he is optimistic as we look ahead, just given the fact that there is a lot of uncertainty about what Fed policy is going to look like and how that is going to trickle down and affect so many aspects of our audience's investments, their portfolios, and maybe give us some insight on the best strategy going forward.
And so many macro themes for us to hit on throughout the day. Obviously, what has come following the election results. We're still, of course, waiting for the final ticker to come through in terms of what's going to happen with the House of Representatives. But how are traders positioning ahead of a potential red sweep is something, of course, we're going to be talking to a lot of our guests today. Shauna, you mentioned the macro backdrop, something else that's going to be an incredible conversation with Neel Kashkari over at the Federal Reserve, right? What is he thinking about that path to 2% for the inflation rate? Over the weekend, he was talking about how there's still more work to be done. You would think that usually that kind of comment would throw a little bit of cold water on the market rally that we have been seeing. But of course, the Trump trade beating all this week, and we saw that rally continuing and hitting yet another all-time high for the S&P yesterday.
And that has certainly been remarkable, right? It's almost like, and this has been the case for so long at this point, going back the last, 12 to 18 months, that the market very much hears what it wants to hear. And it's able to dismiss some of those, any sort of worrisome signals for the most part. Obviously, we've gotten reactions here and there, but very much focusing on what they want to be looking at. And we have certainly seen that be enough here to fuel the market's rally. So that, of course, is certainly going to be a focal point during the conversation with Neel Kashkari coming up later today. And then also just bringing it back home to the consumer right now, the environment of the consumer, how healthy the consumer is, the confidence of the consumer. I think that will be a great insight that we will likely get here from Tony Spring, the CEO of Macy's, just in terms of what he's seeing, the trends that he is seeing in stores, whether or not there has been any sort of, I guess, change in buying power or buying strategy here from the consumer now that we do have some clarity post-election, because that was something that we certainly have been hearing a lot about, just the fact that people have been holding back on some of those larger ticket purchases, waiting for clarity in terms of who is going to be in the White House. So now here we are with that event behind us, just what that tells us about what we could see this holiday season too.
Right, and not just individual companies holding back, individual consumers rather holding back, but big companies holding back on spending as well, which is something that we heard about in some of the earnings results this morning.
Certainly will be. And I will also be speaking with a former CNN chair and CEO, Chris Licht, getting his insight on the media industry, also his reaction to President-elect Trump winning the election last week. And also I will be speaking with Arvind Krishna, the CEO of IBM. Of course, we will talk the change at the White House and ultimately what that signals here for the tech sector going forward. All right, let's get to our trending tickers. We certainly will be watching some of the big movers here this morning. And first, we got to start with Home Depot. Results out this morning. We are seeing some reaction play out in the market here as we do look at what could be looked at a stronger than expected report here from Home Depot, raising its full year outlook as key sales here. The key sales metric after bad weather boosted demand for home improvement materials during its most recent quarter. Warmer weather also expected to help. It did fuel a more than 6% 8% year-over-year sales increase during that period. And Maddie, when you take a look at this, couple that with the fact that they're able to do this in the face of higher rates, or maybe higher than expected rates up until this point, lots of uncertainty about what the Fed's path forward is going to look like. But again, when you take a look at these sales numbers here from Home Depot, at least better than what the street had been looking for.
And the best sales numbers in nearly 2 years. It's really interesting because it seems like for Home Depot, the weather backdrop beat the macro backdrop. And I wonder how that's going to impact their guidance moving forward, because we are heading out of a very volatile hurricane season that they say was a boost to their sales. It seems like there's a question about the macro moving forward here. We have some analyst commentary from Morgan Stanley saying that they don't believe lower interest rates have actually spurred those larger ticket purchases yet. So maybe as the Fed does continue their rate cutting cycle, that could also be a boon for Home Depot moving forward. So maybe that will give them some protection on that forward-looking guidance following those hurricane-related sales. Also, D.A. Davidson saying that those hurricane sales, even without that, they were still doing well. They were still trending in the right direction. So that's another thing that investors are happy about with Home Depot this morning.
It certainly is. And also one of the things that stuck out to me was where we saw some of the sales strength. And this was really given on the earnings call and some of the commentary that we're getting. But the warmer weather helping sales of products like grills. That's what the CFO was saying. Just the fact that people are out there grilling for a lot longer, maybe because of this warmer weather. That's certainly been the case here in New York City. So that has been one of the areas that has helped their business. Also, just the pickup in demand for seasonal items across the board, supplies there for certain outdoor projects. That was enough to boost. Going back to your commentary there, just the weather being able to outweigh some of the macro concerns. Of course, that is driving Home Depot sales here today, or drove it last quarter and is driving the stock here this morning.
Yeah, you're still looking at gains. So we're going to see how it shakes out throughout the rest of the day, but expect a good day for Home Depot.
All right, let's take a look at Shell winning an appeal against a landmark Dutch climate ruling. That 2021 ruling ordered the oil giant to cut its carbon emissions by 45% by 2030. So let's talk about exactly what this means here. The oil and gas company had challenged that 2021 ruling that it must reduce the emissions by 45% by 2030. A court of appeal ruled here on Tuesday that while Shell does have a, quote, special responsibility, putting in the words of the court here, to cut its emissions as a big oil company, this would not be achieved by imposing a specific legal goal. So that is the important part of the crux of this ruling here. Shell, though, still planning to have its emissions from its own operations by 2030. And they also added to the fact that, quote, we are making good progress on our strategy to deliver more value with less emissions here, Maddie.
It's really interesting because this is not just news that's going to impact Shell. It could also impact other companies that are facing regulatory pressure, especially in the European Union, where we know that regulation tends to be a little bit more hawkish than it is here in the United States, especially as we head into a Trump administration. Greenpeace, for example, has a case against Shell's UK oil projects. That suit is still going to be ongoing, but today's result could be an indication of where that is going to head towards. Obviously, the CEO of Shell, which is based in London, is welcoming this news of this appeal not going through, because cutting those carbon emissions by 45% by 2030, that was going to be a big order for the company. So looking like they are not going to have to reduce those emissions in kind of a standardized, regulated way, that they can kind of go about it in their own terms.
Yeah, it's great to point out. All right, let's get to another mover here this morning, and that is On Holding, rising as third quarter net sales beat the street's expectations. We're seeing that reaction play out in the market here this morning with shares of On Holding. Remember, this is the Roger Federer-backed company. Their quarterly sales did beat the street's expectations, gaining some ground, it looks like, against some of the bigger players within the space. When you take a look at Adidas, when you take a look at Nike, just the advantage maybe that On Holding has, where they saw the most gains or where they saw the most strength here last quarter. Net sales hitting a record high, jumping 33% from just a year ago. And they actually saw strong sales within their own stores and also through their own website. So again, less reliant on some of the third-party sellers when you talk about their relationships here with department stores. So again, they're seeing some of that traction at their own or on their own site. And I also think this is a great look at the consumer. We're just talking about what we're going to hear from Macy CEO Tony Spring later on this morning here at Invest. But again, when you take a look at a name like On Holdings, their sneakers aren't very expensive, but they're expensive, right? 140, 190 bucks over it on some of their models. So again, just the fact that people are out there spending and spending at a faster clip than they were a year ago just shows, one, they're growing dominance or growing strength within the space, especially going up against some of those larger competitors. And I think it also just spells some of that maybe more optimistic outlook that we do have for a smaller name like On Holdings here than for the quarters to come.
It's fascinating that they were so volatile over the course of the morning, too, because when you take a look at these plus signs next to numbers, these numbers are huge, beating on net sales, beating on regional sales, beating on direct-to-consumer net sales. That was up 50% year over year. That's a huge gain, and that's why we saw a bit of a reversal to those earlier pressures. So it'll be interesting to see how the stock goes throughout the day.
All right, let's head over to our New York studio. Alexandra Canal standing by with a closer look at some of the movement that we're seeing in the markets this morning. Allie.
Hi, Shauna. Yes, I want to check on commodities after OPEC cut its oil demand growth forecast for this year and next year for a fourth consecutive month. They cited weakness in China, India, along with other regions. And they also cut their 2025 global demand growth estimate to 1.54 million barrels per day. That's down from the previous 1.64 million. So if we take a look at oil prices right now, they are to the downside this morning. Actually, they're to the upside this morning, up about 0.8%. Over the 10-day period, though, we have seen a little bit of pressure there. We're currently trading just under 69 bucks a barrel there. Year to date, we have seen some pressure on oil with those OPEC cuts, along with some of that geopolitical risk that we tend to see. Another thing I want to take a look at is gold. Now, intraday, we are seeing gold to the downside here. This comes as a lot of money has flown into the US dollar after the election of Donald Trump. His policies are seen as very pro-America, driving that dollar higher. Over the 5-day period, gold is down 3%. We have seen a huge rally in gold, though. Year to date, we are still up to levels around 27%. And then I mentioned the dollar, so let's just quickly look here because it's pretty interesting if you look at a 10-day period, this spike that we saw following the election of Trump. Back to you, Shauna.
All right, Allie, thanks so much for breaking down some of the movement that we're seeing here ahead of the bell. Stick with us here on Yahoo Finance. Yahoo Finance Invest gets underway in just a few minutes. We'll be right back. Welcome back to Yahoo Finance. We are live at Yahoo Finance Invest, our flagship event right here in New York City. I'm Shauna Smith alongside Madison Mills, just moments away from the event getting underway. And Maddie, we have a great lineup kicking it off with Apollo CEO Marc Rowan. He will be our first panel here this morning. He will be speaking with our executive editor, Brian Sozzi, and he will kick off a long list of very impressive interviews with industry leaders across industries here, just giving us a great scope and great view of the current economy and and how business leaders are viewing the markets right now.
Yeah, from investment overall to individual consumer names, it's going to be a great day of conversations. We've also got macro, a Federal Reserve member is going to be here to talk, so it's going to be a great day of conversations for sure.
Certainly will be a great day of conversations, one that we are very much looking forward to here at Yahoo Finance. Yahoo Finance Invest starts now.
This is Yahoo Finance's flagship show, The Morning Brief.
Let's get to the 3 things that you need to know today.
Welcome to the latest episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sazi.
That is the closing bell on Wall Street, and now it's market domination overtime.
The world's dealing with a lot of challenges right now.
People want to deploy these data centers right now. They want to put our GPUs to work right now and start making money and start saving money.
But if you look at our core capabilities, the technology capabilities that we have, we can make a lot of other products that meet the needs of society.
First up, a U.S. future is pushing higher after the October jobs report.
The next big revolution is going to come in materials, and I think it'll come plant-based or something that will revolutionize the industry.
Help us try to make sense of today's trade. You know, in your opinion, was this individual stories, Jack? You know, was it McDonald's, Apple? Was it rates?
We allow them to continue what they're doing, to flood the market with EVs that are incredibly cheap.
Where do you see GM in 5 years?
I'm working hard to make sure we're leading in electric vehicles in the countries that we operate. Our vision is to create a world with zero crashes, zero emissions, and zero congestion.
Let's see where the major averages ended the day on this day in which we saw broad and dramatic reaction to the news that Donald Trump had been elected to a second term with a break in between. The Dow finishing today 1,500 points higher, up 3.5%, seeing more records as well for the major averages. Welcome, everyone, to Yahoo Finance Invest, both to our in-person audience here at Second in New York City and to our viewers who are watching us online, as they always do. I'm Julie Hyman, host of Market Domination and Market Domination Overtime on Yahoo Finance.
And I'm Brad Smith, host of Morning Brief on Yahoo Finance, as well as Wealth on Yahoo Finance.
And you just saw a little bit of a sampling, a highlight of the kinds of things that we talk about all day long at Yahoo Finance. I joined the company 6 years ago, and I've been proud of being a part of building the best guide for financial markets and business news and analysis to help every investor achieve their wealth-creating goals.
And so today we get to dig even deeper here at Invest. The themes, the data, the profiles that are featured during every trading session, well, they get to come to life here at Second in New York, where we're joined by guests who are sure to move markets today.
Yes, most definitely. And speaking of markets, of course, in the past week, we had a potentially game-changing presidential election for our nation's economy, for the business climate. Markets are pricing in sunny skies as far as the eye can see, but of course, there are a lot of questions from here.
And so that we already know that the Yahoo Finance power users, some of you in this room, are cold-blooded. You're cool under pressure. And so you're not going to crack, you're not going to break, but you're ready for new challenges and new opportunities, as they certainly do present themselves.
And we're going to be your hosts as we go throughout the day. But first, we would like to welcome up Tapan Bhatt. He is President and General Manager of Yahoo Finance.
Good morning, everyone. It's my pleasure to welcome you to the second in-person Yahoo Finance Invest Conference. So today we are bringing here, all of you here, to share some of the things that we are facing. Since we last met, it's been an incredible year for Yahoo Finance. We've launched new products, new shows, new podcasts, and conducted insightful newsmaker interviews. And throughout this, we've also forged partnerships with new financial creators, some of whom are here in the room right now. They bring together unique viewpoints to help consumers make better financial decisions and make them with confidence. So we say behind every great investor is Yahoo Finance. You probably saw that sign right up there. And so we've got an amazing lineup of great investors here today. And this couldn't come as a more opportune moment. As Brad and Julie were saying, we've got some game-changing things going on. New elections, a new political cast of characters in many countries around the world. Huge tectonic shifts happening in technology, and a pretty volatile market environment. So this is a time for great change, and with great change comes challenges and opportunities, and that's the theme for this year's conference. So after last year's conference, we had heard that people who attended felt this was a great way to connect with other leaders. Because fundamentally, what this is about is connecting with others, getting ideas, and really building community. And that's no surprise, because Yahoo Finance has been, from the get-go, one of the OG communities for investing on the internet. So we had our old Yahoo Finance Meshes boards, which are still there. But we've got something new coming out, and that's the first step. Today, we're excited to say that we are launching our new Yahoo Finance Community Hub in beta for an invite-only group of folks. And all of you who are attending in person will get an invite. We hope this will help you follow other investors, hear what they have to say, share some of your trade ideas, and get ideas for better investing tips and ways you can make more money. So this connection is something that we think will be a great way for you to build community. But community starts in this room. And all of you here are going to hear from some great folks coming up. You're going to hear from each other. You've got time for breaks, for coffee, for lunch, and for cocktail hour. Not at the same time. But so sit back, enjoy the show, and enjoy. Thanks. Bye.
Let's begin. The word deregulation is the a la mode in business and the outlooks for 2025. And as a result, investors anticipate a dam-breaking moment in deal-making. Our first conversation takes this theme head-on with one of the largest retirement and asset management firms in the world. Please join me in welcoming our first guest, Apollo co-founder and CEO, Marc Rowan, who will be interviewed by Yahoo Finance executive editor, Brian Sozzi.
Exactly.
Holy cow.
That's the right theme, challenges and opportunities.
Yeah, right. Well, all about opportunities if you're looking at the market here the past 5 days. So I think, of course, Marc, one, just good to see you. Thanks for coming down here to the conference. So we've seen really a euphoric market response in the days after the re-election of President Trump. I mean, you heard Tapam mention a new cast of characters. These new cast of characters coming into the administration, are they as market friendly as the market is pricing in today?
Look, they are clearly market friendly, and clearly markets, financial institutions, other institutions sensed a need for change. I think they're going to bring change. As I was joking, pre-election, this election was about whether you were more scared of 4 years of the same or more scared of 4 years of change. I think the verdict's been rendered. Market's verdict's been rendered. I come at this incredibly optimistically.
What type of changes do you think would unlock a higher market? I mean, what makes you so hopeful?
Look, we're coming in this administration is coming in at a point in time where they really do have an opportunity to pivot. Think about where the U.S. is in the world. I mean, all the action is here. I mean, just recite what's going on. The economy is in great shape, certainly relative to the other two large blocks of Europe and China. We have stimulated our economy over the past 4 years, and we're about to get the dividend of that. I mean, we forget 3 years ago we passed almost $2 trillion for infrastructure. It's all under construction. 2 years ago, $52 billion for semi plants. Not a single plant is open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, all under construction. 3 years in a row, we've been the largest recipient of foreign direct investment, all under construction. It's coming our way. We're where the action is, and now the question is, can we lead? And you can pick almost any area. Pick energy. We've spent all this time where the dialogue's been about energy transition. I think we're actually going to start talking about energy accretion. I mean, think of just the demand for data, for power, for data to help redefine our future. We can't just talk about transition anymore. We have to acknowledge we are going to need more power. No one produces clean power the way we produce it. We can have it produced here, or we can rely on others producing it for us. Financial services, I think we're going to see exactly the same sorts of changes.
How fast do you think the administration can move in loosening up regulations across industries?
You know, we'll wait and see, but certainly the regulatory tone over the past 4 years has been difficult. I expect that the tone will be much more constructive to allow financial systems, financial markets, corporate markets to evolve to where the world is, not where the world was.
How much of a transformation will it be for the business of Apollo and others in the financial services community to get new regulators into the mix to make perhaps doing what you do easier?
Look, I don't think it's going to be massively different for firms like Apollo. I think certainly our industry has prospered over the last 4 years, just as we've prospered over the last 8 years. But I do think that there are really interesting opportunities, particularly in retirement, which is a conversation you and I have had previously. I mean, think about what we do. The largest pool of capital anywhere in the world is our 401k market, $12 to $13 trillion. What do these people invest in? Well, generally they're in daily liquid index funds for 50 years. Why? We have no idea. That's just always the way it's been done. Every place else in the world where the addition of private assets, the addition of other types of assets to retirement plans has been tried, it has resulted in better outcomes. And not slightly better outcomes, 40 and 50% better outcomes, Australia being a case in point. I think one of the upsides for our industry is a revisiting of this whole notion of public being safe and private being risky, potentially including into retirement solutions, which is what our country needs.
Is this the administration that finally helps to solve the retirement crisis? That's what you and I last talked about in Milken. I mean, can they move that quickly?
I don't think solving a retirement crisis is a 4-year plan. It is ultimately about putting in place a series of changes that will allow market forces over a really long period of time to solve retirement crisis. How do we encourage savings? How do we allow people to invest? How do we police it and create appropriate rules and regulations so that individual investors have access to the best solutions, but at the same time have protections if they are not as knowledgeable? It's going to be a balancing act, but I hope that we see the kinds of reforms that will allow a smoother path to retirement. Remember, superannuation in Australia is 40 years old. 40 years of compounding is just immensely powerful.
In the, in the prior Trump term, I think investors, many times they woke up and they saw a tweet move a stock price, and they saw a lot of moving activity each day from the president. Have you sensed, talking to the folks that you talk to, that this is an administration that will be different? Will this be a different 4 years than the prior 4 years? And has the president-elect, will he be a different president?
Bold forecast is not my area of expertise. I look at the people who he is surrounding himself with, and I come away very optimistic. I think this administration has a remarkable chance to really pivot the country, to take advantage of all the inherent positives that we have. I mean, imagine how powerful it would be if we actually got our act together and were well governed. It's truly unbelievable what we can do.
Does geopolitical risk pick up with this administration if we enact a trade war, for example?
Look, again, I don't want to veer out of my lane, but let's acknowledge, you look at markets are at the moment not pricing in much for geopolitical risk. There's very little risk premium. Valuations are high. Credit spreads are low. The thing we've learned is geopolitics is unpredictable. I don't see any reason, and this is a personal comment, not one from vast experience, I don't see any reason why this administration would have any greater geopolitical risk. Historically, geopolitical risk has come from U.S. weakness. The absence of a strong U.S. presence has resulted in more risk. So let's wait and see.
What did the current administration get wrong? Because I think a lot of investors have seen an infrastructure plan. Those things have started to move. Is it the regulatory environment that got too restrictive?
Well, let's look at it this way. We are, at the moment, running circa a $2 trillion deficit during relatively or record low unemployment and in peacetime. And so have we unleashed market forces to build for the future? Let's face it, our energy grid is changing. The need to get, yes, we can subsidize it, we can incent it, but the need for more power is evident. Those countries that build power, that support data, that support advanced data, advanced AI, advanced power are going to win. Those that don't are going to be left behind. This is going to be table stakes. Do we have a policy that allows us to do that currently? We don't. Look, think about employment. Employment has changed. People are no longer working for the same company, other than Apollo, of course, for the entirety of their career. Have we set up a healthcare system, a retirement system, and other systems that allow for mobility? And you go on, and you can be critical, but you can also say that we've waited too long to fix underlying problems, so that small amounts of tinkering are unlikely to result in directional change. I think what the market likes about what they're hearing is they're hearing directional change. The kinds of people that the president-elect has been able to surround himself with, I think, have been captivating for the market, and whether it's the Elon Musks or the others, bringing people who have a new way of thinking is likely to lead to different outcomes.
Can the administration cut taxes at the same time as the deficit continues to rise?
Yes, up to a point, but this is all about balancing act. Our financial situation is fixable. It is fixable in a way that is positive for the base that President-elect has said that he wants to help, but it is not fixable by small amounts of tinkering. It is about wholesale change, and we as humans, we are sometimes scared of wholesale change.
Oh, does Elon represent wholesale change? $2 trillion in potential cuts he's floated.
I think Elon Musk represents wholesale change, and I think we actually need wholesale change.
Interesting. So I know Apollo's focused, and you brought this up at your recent Investor Day, global infrastructure. How is Apollo playing in that arena to help support that build out? I imagine AI is a big area of focus for the team.
Look, we call it a global industrial renaissance. Think about what we're doing in the world. Almost everywhere in the world, we're building infrastructure. There was an article today talking about European defense, and the most striking thing about European defense was how much infrastructure was required in Germany. So infrastructure is one of the things that we're building. We're doing energy transition because there is no change, there is no going back. We are going to build alternative sources of energy, and companies are transitioning where they get and how they use energy. And the third is this notion of power accretion rather than just energy transition, I think is going to become part of our lexicon. We have vastly underestimated how much power we need. Which of us thought utilities was going to be a growth industry?
Oh, nuclear. Everybody's talking about nuclear.
In all forms. I mean, the irony that AI could actually be the cause of a renaissance in nuclear power, we just have to, kind of chuckle at that. But if you step back and you think about it, all three of these megatrends, this global industrial renaissance, are long duration, complex, and are generally ill-suited to shorter-term bank balance sheets or plain vanilla bond market. The amount of credit, the amount of hybrid equity, and the amount of equity that is going to be needed dwarfs anything we've ever seen from an investment point of view. Oh, by the way, the government's still running a $2 trillion deficit at the same time, and we have massive change in our financial marketplace. This growth in the need for credit, particularly complex, long-dated credit, is one of the primary drivers of our business. And I think that is going to power not just Apollo, that's going to power our whole industry.
How could we have a lot of avid investors watching live on Yahoo Finance in this audience. How do they get involved in this megatrend?
Look, I think they can get involved lots of ways, but I step back and I think about what we try and do as an investor and what we try to do as a company. So I ask really simple questions. Are we an asset manager? No. An asset manager can take any amount of money and invest it. We are in the business of excess return per unit of risk. We're in the business of alpha. Then you look out at the marketplace and you say, are valuations low? No. Are spreads wide? No. Okay, where am I as an asset manager in search of alpha going to go? And I look for places there are big inefficiencies where there are structural changes taking place. The intersection of the banking system and the investment marketplace and the need for long-term capital is causing capital formation to take place outside of the banking system and outside of the traditional bond market. Many investors have already pivoted here, the growth in private credit. But the growth in private credit is the tip of the iceberg. Private credit so far has been defined by levered lending and below investment grade activities. I actually think we're going to see an entire convergence of public and private in the credit marketplace. It may take time for that to happen, but it's coming our way. So investors who are positioned at this point in time, I think are going to earn excess return per unit of risk for a really long time.
Bless you. Are investors thinking about Apollo the wrong way? Look, Apollo is, of course, the parent company of Yahoo Finance. I mean, we always have known Apollo for big deals, but it sounds like you're about to unlock, or you have unlocked, a whole other growth mechanism inside the company.
This is about, so the answer is, I think investors have not thought much about Apollo, Blackstone, KKR, or anyone else in our industry. People are locked in a mindset of 40 years ago, which is private equity, as opposed to thinking about the industry as private assets. So think about the journey we've been on. 40 years ago, private was risky and public was safe. Private was three products: venture capital, private equity, and hedge funds, all three of which have risk, but used appropriately can offer good returns. And public was 8,000 companies, diversified portfolio of stocks and bonds. Okay, just a few years have passed. In fact, the entirety of my career. Is what we thought true? I don't think it's true. I think private is now safe and risky. Public is now safe and risky. But if you think about it, if something is risky and private, you stick it in a little bucket called alternatives. You watch that bucket really carefully. You demand really high rates of return. But if private is both risky and safe, maybe everything we've done from a portfolio allocation point of view before makes no sense. And that's actually what we're seeing happening in our business. The traditional role of privates in alternatives, private equity, venture capital, hedge funds, is there and growing. But the biggest trend in our industry is investors, individual investors and institutional investors, looking at their fixed income bucket and saying to themselves, why is this 100% public? Why don't I see whether I can earn some more excess return in public and private, and mixing alpha and beta? And the reason it's happening there first is investors don't need much of an education, because you have rating agencies who are capable of telling investors that something is of equivalent credit quality in the public market, equivalent credit quality in the private market. And this is what I expect to happen over the next 3 to 5 years. But make no mistake, it's not going to stop at fixed income. It's coming for equity as well. We will, as I've suggested, we will own, as investors, equity that is private rather than private equity. Because 8,000 public companies is now 4,000 public companies. More companies go private than come public. There is very little reason to want to be public other than for the largest market caps, given the
Who wants to do earnings calls, Marc? Nobody wants to do earnings calls.
Well, some of us like doing earnings calls.
You have to say that.
But it must be some bizarre personality defect that I like doing them.
But in the last minute and a half we have left, I remember talking to you 2 years ago, and your mantra, I guess, to the firm was that no new toys, meaning no big acquisitions. I mean, is 2025, with rates coming down, a friendlier administration, Apollo's back in the market for big new toys?
I won't say new toys. The absolute prohibition is gone. Christmas is back on at Apollo. Hanukkah, Christmas, whatever we need to do. But what I will say is we have to be very humble in what we do. At the end of the day, we are a small asset manager in the scheme of the world. If we hit our business plan, we will be twice our size in 5 years. We will still be a small asset manager. We are winning because of strategy, we are winning because of what we've done, but mostly we win because of culture. And to me, acquisitions that bring in lots of people, other than if they're essential to what we do, just put pressure on our culture. So I think you will see for us small additions to our capability through acquisitions, but I will be surprised if something transformational happens. We have so much to do in just our base business that it's some new toys now.
Okay, some new toys, 30 seconds left. How might people view the Apollo culture incorrectly?
Look, the folklore of 40 years ago is about private equity and sharp elbows and conquering, and we want 100% of everything. And I look at the shape of the business today. The business is about $600 billion of credit and about $200 billion of equity. In the credit business, if you own 100% of anything, it means you failed because you've originated something no one else wants. And I think we've come to the marketplace, and whether it's partnering with financial institutions like Citi, or it is partnering with companies like Yahoo, or it's partnering with other sponsors or other forms of financial intermediaries, we recognize that this is now a partnership. I can say jokingly, there are no permanent friends or permanent enemies. Some of our largest competitors are actually our biggest partners as well.
Really enjoyed this conversation. Thank you for always making time for Yahoo Finance. And
always
me personally,
pleasure.
Marc Rowan, co-founder and CEO of Apollo Group. We'll talk to you soon.
Thank you.
Thank you. Thank you.
I love what Marc was saying about the possibility for investors in the future to own equity in private companies. Some people want to own equity right now in a private company like SpaceX. I just want to own private equity or equity in a private company like Wawa. If you know me, you know I won't be taking any shade from people who love Sheetz or any of these other chains that are out there. But we'll leave that conversation for another day. Our next conversation here. Fixed income is rarely the talk of the water cooler. And if it is at your water cooler, then invite me sometime because I would love to listen in. But there's a strong case for why it should be the talk of many water coolers right now, especially during global cross currents in the interest rate policies that we're seeing. This next household known institution accounts for $11.5 trillion in assets under management, and they are locked in on fixed income. Please welcome BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder, as well as Yahoo Finance's own Julie Hyman.
So there's a lot to talk about. Of the $11.5 trillion that Brad just mentioned that BlackRock oversees, $3 trillion is under Rick's purview. So, as Brad said, well known to many people, BlackRock is because of its management of retirement accounts in particular, but much broader than that. So speaking of the election, Rick, the description of this session talked about a prolonged interest rate cutting cycle, which we kind of took for granted until last week, right? And it seems as though markets certainly have turned expectations on their head. So what are we looking at now in terms of that interest rate cycle?
So the first thing I think it's interesting, by the way, thanks for having me. This is a cool event. Much appreciated. So think about where we were a few weeks ago. It's pretty remarkable. The narrative was hard landing, economy slowing, consumers falling off a cliff, et cetera. They priced the Fed down to a 270 funds rate by the end of next year. We're almost at 4% today. So it's interesting when I hear people say, well, rates are coming down. It's like, My screens don't show that. It's pretty remarkable how much things have shifted. So let's think about where are we in terms of a foundational point of view. Coming into this election, the economy is in pretty good shape. We printed 3.0% GDP in the second quarter, 2.8% in the third quarter. Didn't feel like hard landing. Consumer is, and you could see that in the earnings reports, consumer still doing pretty well. Now you have this election. Now you have a whole new playbook around the red wave. And quite frankly, the dispersion of where interest rates could go has just widened out. And by the way, I'm going to answer the question, but I will say one thing. Anybody who says they know, so you think about, and Marc talked a bunch about this, tariffs, what it means for growth, the strategic decoupling that could happen. By the way, you've got somebody sitting in the White House, i.e. Elon Musk, that's pretty good at automation and innovation and productivity enhancement. Like, we're going to go through the next couple of years of an extraordinary sense of change. And anybody who says they know what that's going to look like is lying or is arrogant. What do I think has happened? If you take the rate, so in my base case for like 10-year treasuries, people like to hone in on 10-year treasuries, it tends to follow nominal GDP. Nominal GDP, and if you watch, you come off the curve of nominal GDP if you have massive fiscal stimulus or monetary policy, but you generally come pretty darn close back to it. So if you said where we were a month or so ago, you could have assumed real GDP at about 1.5 to 2 and inflation of 2-ish, maybe a little higher. And I think, quite frankly, all the improvement in inflation has happened. So that gets you about 4. Now with this election, you say, gosh, we're maybe tariffs of significant magnitude, although I think ultimately won't be nearly as pervasive as is being chronicled. But you're going to unleash a fair amount of deregulation, growth initiative, and gosh, maybe we got to take our nominal GDP forecast up a bit, whether that comes from inflation or growth. And by the way, tariffs tend to lift inflation, but they dull growth. So you got to think through, there's a balance there. Listen, I think the range of the 10-year, if the 10-year was in a 3.5 to 4.25, I think you got to lift it. Let's say 50 basis points. And I think you got to widen the range a bit, 4 to 5. And then we got to see what these series of initiatives come from there to determine where are we going to be relative to that. And by the way, I could lay out my base case. Growth is going to be stronger. And then it's going to be, we were on a trajectory where inflation wasn't coming down anyway. Maybe we have a little bit more inflation before the productivity enhancement really kicks in.
So as you said, we're all still trying to sort of guess at exactly what the fiscal policy is going to look like. We've gotten some clues into other parts of policy over the past few days with some of the reports of who could be appointed to the administration in various roles. We don't know who the Treasury Secretary will be yet, for example. What are you going to be watching to figure out where all this stuff is going?
So, I mean, the biggest thing, I do a lot in equities, but also, fixed income is a bigger part of my remit. Listen, I think the debt in this country is, and how they address the debt in this country is going to be the most pervasive.
Well, they don't seem to be addressing the debt at all, Rick, at this point.
I don't, I will say markets, and I say this, I have said this on the show with y'all, I think markets tend to react to the shark closest to the boat. The shark on the debt dynamic is not going to be next to the boat in January, February, but it is going to get next to the boat sometime. I don't know if it's the latter part of 2025 or the beginning of 2026, unless they address, and by the way, unless they address the size of the spending dynamics, the amount of debt we're issuing, and then obviously inflation relative to that. Now, I've heard the president-elect talk about things around energy and dereg and how to bring cost and inflation down. That's a really big deal, particularly for the long end of the rates market. But they have to address. And by the way, if the right people are in charge and running it, you could build a lot of confidence in, okay, there's a plan. It doesn't have to be executed, and it can't be executed in the next 6 months or a year, but there's a 5-year plan that we can debate, what you put in place when you leave off, or when you leave office, how that changes. But you've got to put in place a plan that people feel comfortable that we're going to get the debt under control. And by the way, it's not just the debt, it's the debt service. And I know I say this all the time. It is, we used to issue treasury bills at 0%, 1%. We're now issuing $400 billion a week. And by the way, some weeks significantly higher than that, at 5-ish. And so what happens is the cost of the debt in this country just keeps going up, so it eats up all the discretionary spend in the country, and then you have no fiscal flexibility. And for an administration and Congress that wants to execute change and evolution, if you have no fiscal flexibility, pretty hard to do that.
So I guess tease out a little more what the shark closest to the boat will look like if the debt gets to that level, if the debt servicing costs are going higher, if we don't have that flexibility. I mean, the debt's been growing. And it hasn't been a problem, right? The market, we have seen investors continue to buy U.S. debt. When does it become, what would force it to become a problem?
You know, the biggest, listen, I talk about it all the time, long end interest rates are where you have the volatility and the dispersion because you try and think about where we're going to be longer term. What is inflation going to be? The long end of the yield curve, to me, is where you got to be really, really careful and really thoughtful about it. And what I worry about at times, and again, it's all about, I think people underestimate confidence in markets and how, if you think about what's happened to the equity market over the last, if people have confidence and they think, gosh, maybe earnings are buoyed a bit, I feel pretty good about it. My PE ratio is high, but gosh, if I buoy earnings, you got operating leverage on a good economy, pretty good. You got to create confidence because the back end of the yield curve, and we go through auctions, sizable treasury auctions almost every day. You got to instill confidence, and I watch these auctions, particularly further out the yield curve, like a hawk. And there's going to be periods of time where people say, you know what, I don't feel great about it. I'm gonna pause. There's a lot of talk about bond vigilantes when people come in. You got to be careful, and so we're going to watch those auctions. And those auctions give you a really good indicator. And by the way, foreign demand.
Right.
We used to rely on foreign demand. China, Japan, et cetera. Long discussion. Japan's buying less. Long discussion about JGBs, cross-currency swap. China's definitely buying less and going to be funding more of their domestic infrastructure. So we got to fund it largely domestically. And so you got to watch these auctions.
So watch the auctions for number of bidders,
totally,
yield that they're getting, and that foreign investment in the U.S. If those things drop off, then what? How does that scenario play off if you start to see a drop in demand for U.S. debt?
So I also have to shift to the more encouraging side of things.
We'll get to that. First, give us the worst case here.
So. Listen, I think what happens, the U.S. is a reserve currency in the world. I don't think people understand when you look at, roughly 2/3 of the world's transactions, liabilities are in dollars. The form of collateral in the world is treasury bills. When you dilute reserve currency status, let's say we go down the scenario we talked about, and you don't see enough buying of the debt, well, it goes right on the Fed's balance sheet, a la, what did the Bank of Japan do when you saw yen go from 100 to 166? That is not a scenario you want to have play out with the reserve currency in the world. Think about how many countries are pegged to the dollar, let alone transactions, et cetera. So, like I say, well, I'm painting the tail risk, and by the way, not to overstate it, I think it is the tail risk that, we have bigger issue around it. If you put in place a set of measures that instill confidence, I tell you, the U.S. economy and the U.S. investor base, and I'll throw out one number that'll blow you away. There's roughly $220 trillion of net worth in the United States today. So you take the debt, and we talk about the amount of debt. You got an immense buyer base that can buy treasuries. We're watching it in credit. We're watching it in equities. So your ability to deal with these issues, the asset protection, people say U.S. should be downgraded. The asset protection and the ability to enact measures within the U.S. to support that debt and other things is pretty extraordinary.
So what is that? Okay, so that's one risk with the sort of deficit increase policies that we think might be put in place. What would be the best case scenario? Would it be, Marc Rowan just talked about outgrowing some of these concerns. Is that the best case scenario?
Where I think what could happen and what I think you can get really excited about. The only way you bring the debt down, or the only way to deal with this, you got to outrun the debt. Because you can't take it off the books unless you do a wealth tax of significant magnitude, which I don't think is going to happen. I'm certain won't happen in the near term. So how do you outrun it? Nominal GDP has to be over the cost of the debt. I've watched Italy for years, very hard for Italy to delever because they don't grow fast enough. You don't have enough nominal GDP. U.S. is at a point in time, much of what Marc talked about, you have this extraordinary ability to grow. The amount of money in infrastructure we're going to see, the amount in data center, energy, cooling, is extraordinary. And so the ability to actually put in place initiatives to promote that growth forward, keep nominal GDP. If we keep nominal GDP, let's say it's 5, and we could debate, do you get there from inflation, you get there from growth, and probably some combination thereof. If you operate at nominal GDP of 5, and then you keep the cost of the debt, and this is the Fed, part of why I think the Fed still's got to get the rate down a bit. You could operate, if we're running at 3.5 to 4 cost of debt, you slowly bring the debt down. By the way, it's pretty incredible. You think about how much debt and the size of these deficits the last couple of years, but it actually hasn't created a pernicious dynamic in terms of debt to GDP. Why is it? Because we grow so darn fast. As long as you keep promoting the growth, as long as you outrun the growth, then we'll be okay. And then we got to deal with, things like mandatory spend in this country, retirement age, et cetera. You can create a plan that you can get your arms around and say, gosh, this works. And what Marc said, the amount of money that's in private equity, private capital, public capital that wants to get in, I think about pension funds, life insurance companies, that want to fund long-durated assets, that could be debt or equity, is pretty extraordinary. So meaning the point in time couldn't be any better. The environmental condition, the balance sheet needs to be fixed.
I want to talk about equities for a moment because you have a lot of equities under your purview also. We've heard obviously equities have been flying the past week or so, and the forecasts keep going up. So Evercore ISI's Julian Emanuel says we could see 6,600 for the S&P 500 by the end of next June. We talked to Ed Yardeni on the show yesterday. He says 7,000 by the end of 2025. Do those numbers make sense to you?
So, listen, I don't love the multiple of equities. I think you're counting on a fair amount of growth, but something has evolved. If you believe, equities, there are two things that drive equities higher, and I think will drive them higher. I don't love the multiple, I'm long. I use a lot of convexity in my book using options, and we've actually, including the last couple of days, when volatility comes down so much, like we're rolling some call options at 11 and 12 volatility. That's like nirvana for a manager. If you can create your equity in a more convex structure, that is nirvana. So I'm long, and listen, I think what happens is there are two things at play. One, I think the multiple's high, but if you think the E in PE is going to be significantly higher, you get that multiple to a reasonable level, and we talked about the amount of spend on infrastructure. Listen, we could debate small cap, mid cap. I think the places that are going to spend in this space and the revenue and the capex driving that revenue is pretty impressive. The second thing that I think people underestimate, the technicals are crazy for equities.
Crazy good?
Crazy good. And I know we're talking about on your show. You think about today, there's $9 trillion in global money market funds, there's $23 trillion and include deposits, some of that's pledged. And then and you think about the amount of money that comes in a 401k, wealth, salary, X% goes into equities, and there's no sellers. And by the way, the big companies buy back $1 trillion of their stock. So you shrink the denominator because they're buying back a bunch of their stock, and there's no sellers. Like when there was an IPO, people were like, oh my God, there's an IPO. Well, relative to the size of the markets, there's nothing. There's who's the natural seller? And I've learned over my career, the technicals win. Even if you believe in the fundamentals, the technicals win more. And that is super powerful. People want the multiple, myself included, want the multiple lower. But boy, it's pretty hard. If there's no egregious piece of news, geopolitical, et cetera, the natural migration is to higher prices.
Well, okay, so if you talk about on the bond market side of things, if one risk is sort of a buyer strike, so to speak, what's the risk on the stock side? You mentioned, geopolitical. Geopolitical hasn't made a dent in equities.
Pretty amazing.
In a long time.
Yeah.
So earnings continue to grow. Revenue continues to grow.
Yeah.
You've got maybe better, fiscal policy that could be helpful for stocks.
Yeah.
What could go wrong then?
So can we go back to the debt discussion?
Sure.
So that's the one. Like if you said to me, like what keeps you up, I don't do a lot of sleeping, but what keeps me up at night, the first thing is, listen, you got to watch the geopolitical, keep an eye on it. Like you say, people tend, unless it is huge, people say, okay, I've seen this before. And by the way, I've lost more money hedging over my career for geopolitical. And unless it's something dramatic, it doesn't really influence. Listen, how we play out this quote unquote strategic decoupling with China is going to be significant. Are we going to tariff And my sense is not. There won't be massive across-the-board tariffs. There'll be some form of bilateral negotiations. But tariffs do reduce growth. They bring up inflation. They do reduce growth significantly. We got to keep an eye on that. My sense is this administration will be pretty thoughtful about it, I think. And then the other is, listen, I just think we got to deal with the debt thing. If you took the discount rate significantly higher, if you took the cost of financing for companies significantly higher, that you dull cash flow generation because the cash flow gets stuck at the debt. Like those are the risks, and that today is what I think is out there.
And you mentioned the tariffs could be a bit inflationary. I mean, a scenario you're talking about with bond vigilantes, et cetera, that also could be inflationary. Totally. Yes. So, I mean, but how do you figure out how do you sort of game it out and figure out the probabilities at this point?
So I don't. I mean, by the way, the bond vigilance, don't sort of inflation, but they certainly could press the rate up.
Right.
And so how do you assess that? And the way I think about it, when we try and build balance in the portfolio, is you think about, gosh, particularly today when volatility comes down, I'm the happiest person in the world because now I can run my equity portfolio and build a ton of downside into it. So that is one. Two, I love owning yield. I love owning yield, and you don't have to go out the yield curve. I mean, credit. Marc talked about it. I've been doing credit for I've been doing credit for a really long time. I've never seen it. So post-COVID, companies term their debt out. They have no maturity wall, many of them. And you got a decent economy, good free cash flow, cash on hand for many companies. I just love owning yields, stay shorter on the yield curve, just keep clipping coupon in the front end, keep my interest rate exposure down, and you create balance in the portfolio. If your equity has got some convexity, some hedging to it, and then you're creating a lot of income on your fixed income side. By the way, using Europe as a place to lend into is fantastic because Europe's not going to grow as quickly or significantly slower than the U.S. You watch what's happening in Germany, et cetera. Europe is a fantastic place to get income, take some interest rate risk, and so just create more balance. And by the way, like Marc said, more and more people are going to use private markets. And we do a lot of bespoke financing, and I think the terms are phenomenal today.
Right.
But you got to create balance and create a lot of liquidity in your portfolio too, because stuff happens, I've learned.
All right, quickly, last 30 seconds. A year from now, you want to take a stab at where the 10 year's going to be?
No.
Okay.
Listen, I think if you buy into this nominal GDP, I don't think it moves very far from here. With my would I err on the side of maybe a bit higher, given but we got to see what comes out, tariffs, et cetera.
I had a feeling you would answer that way.
Sorry for being.
Fair enough. Rick Reeder, thank you so much for being here. Really appreciate it. Thanks.
Okay, how we feeling? Everybody's feeling pretty settled in right now. I see a lot of people taking notes out there. We're gonna get some physical activity going here because you're looking just a little too cool for me this morning. We should all be revved up at this point. We're gonna get a little physical activity. Don't worry, I'm not gonna ask anybody to break dance. Raygun is already the greatest of all time. Top break dancer, I bet you that. All these things considered, we wanna do a little informal survey. When is the last time in the, let's say, by show of hands, past year, that anybody here has been in a department store and made a purchase? Okay, we're gonna narrow it down now. 6 months, 3 months, last week, yesterday. Okay, well, you're in for a treat. In our next conversation here, the storied shopping mall, of course, where inspiration has met commerce for decades, is rapidly digitizing, all while consumers are trying to figure out how to outlast inflation. Our next guest runs a business whose roots trace back to 1858 and now must continue to modernize in 2025 and for 2025 and beyond. Please welcome Tony Spring, who is the chairman and CEO of Macy's, and Yahoo Finance senior reporter, Brooke DePalma.
Tony, thank you so much for sitting down with us. Yeah, good morning. I want to get right to the heart of the business, the customer. We are now, as everyone knows, 7 days post-election. How does this impact the Macy's consumer?
Well, I think the consumer never likes uncertainty. So I think as we all experienced kind of what will happen, the consumer doesn't enjoy that. I think the level of uncertainty we've seen in 2024 has been high on a number of different factors. So I think post the election, retail is a great place for those that want to celebrate and those that want to escape. So we actually are a great place for people to come for what we call retail therapy, a chance for people to enjoy themselves. The holidays are coming. It's a perfect time of year where you're actually thinking about your family, your friends, your loved ones, as opposed to the geopolitical environment where you've got people who are, on opposite sides of the equation and not necessarily comfortable having conversations.
Now, did it help the fact that we had a decisive conclusion on who won Wednesday morning?
Yes.
Yeah. And are consumers seeking value in this sort of environment, or are they willing to splurge now that we got past that uncertainty?
I think you have different consumers looking for different things. One reason is why Macy's Inc. as a portfolio, Macy's, Bloomingdale's, and Bluemercury is such a powerful engine of retail is because we appeal to different types of consumers. There are those people that are looking for what's the latest fashion, what is newness, and that's very important to the Bloomingdale's business. It's also important to the Macy's business. We have consumers that are looking for great value. Value obviously is described by what I pay, but also the experience I have, how quickly it comes, how convenient it is, and Macy's leans into that very effectively. And then at Bluemercury, you have the benefit of obviously efficacy and skincare and local talent that is right in your community. So it's a convenient factor as well.
I want to take a step back with the election in mind and a Trump administration yet again. Tariffs, top of mind. Yeah. Of course, we heard a bit from the last guest about the potential impact. How much of a potential headwind is this for Macy's?
Look, this isn't the first time we've seen the discussion about tariffs. We have the experience from the first administration, Trump administration, and certainly the Biden administration left in place some of the tariffs. So we as retailers and as manufacturers have diversified our sourcing. So certainly for the private brands that we produce, the vast majority we've moved out of China into other countries we produce in, and it's an ongoing conversation with our business partners, our manufacturers, our suppliers, and making sure that they're thinking about, obviously if something can be made outside of China, that's going to be advantageous. If you can at least balance your production into another country, that's also going to help. And I think it's frankly opened up South American market for production and other parts of Asia.
Will you have to raise prices?
Look, it's too soon to say, and we don't know the magnitude. I think there's what people say, and there's what people do. We certainly are all familiar with what campaign pledges are, and then ultimately what comes to pass. I would hope not, would be my answer. I think if it's anything sizable or meaningful, then we'll have to evaluate it.
Yeah, now you do sit on the executive committee for the National Retail Federation, and they do expect American spending power to be reduced by billions of dollars each year.
If it comes to pass.
If it comes to pass.
And again, are we talking about what percent? Because there have been a range of percentage that have been shared. I think some is designed as a negotiating tactic. If it's a negotiating tactic, wonderful. But look, we know we are a competitor with China. Hopefully it's not an adversarial relationship, and they are at the bargaining table in some way, shape, or form to provide what is good for American manufacturers as well as what is good for the U.S. economy.
Are your partners saying that they plan to pull inventory ahead to prepare for the possibility of this?
No. I think that people are very mindful, having lived through a pandemic and having lived through a financial meltdown, that the management of their balance sheet and the thoughtfulness of cash flow, they're not going to own inventory they don't need to own. And again, the ability to manufacture products all across the world is now a bigger advantage than it was in 2015, 2016.
On the flip side, is there an opportunity to source more American goods should this happen?
Look, depending on the category, I think so. And again, the newer the category, the more price flexibility the consumer has, the more interest in innovation. I think there is more opportunity. But we're not going to return to a time 50 years ago when so much more was manufactured in this country. That would not be taking advantage of the world economy. And I think we all enjoy the benefits of a world economy. I think now we've just got to figure out what is fair, competitive trading practices.
I want to flip to the fun side of things. I know that in late February, Macy's introduced this bold new chapter strategy. Now, for those who don't know, within the first 50 stores, you have more sales assistants in the shoe department, you have more help in the fitting room, there's more visual advertising within the store, within the products. What sort of returns are you seeing early on that gives you confidence in this strategy?
Yeah, we've seen 2 quarters of growth in our first 50 stores. So, taking a step back, bold new chapter, obviously for Macy's Inc. First part being to reimagine Macy's. The reimagining Macy's is to close 150 underproductive stores and invest in our 350 go-forward stores. A part of that 350 is 50 stores that we selected to try to amp up our efforts. And that was in product, that was in service, that was in presentation, that was in marketing, all the things you referenced. The early signs of success are customer service scores up 600 basis points, sales in almost every family of business up in these stores, or up from a differential standpoint to the remaining Macy's go-forward fleet. We're seeing interest in brands and in products, manufacturers wanting to sell us into those stores because of the way we are treating the product and the care we're showing for their brand and their business. So I'm cautiously optimistic. Again, it's 2 quarters in a 3-year strategy, so we're not slamming the ball, but I think there's interest in doing more of what we're doing and bringing some of the strong fundamentals back to retail. How do we have better product, better experience, and better value?
In terms of what exactly you're seeing, I mean, are customers coming back more frequently? Are they coming more? Are they returning more? Are they buying more when they do? What exactly is driving that sales growth higher?
It's a little bit of each element of what we call the golden equation. So it's a little bit more traffic, it's a little bit better conversion, it's a little bit better average order value, and certainly the engagement comes first from the people that are already shopping the store. We can do a number of things in a store. If I haven't been coming for a while, and not necessarily going to just come jumping right back in. So we think over time, actually, this arc gets better, because as more people tell word of mouth, as our localized marketing gets stronger, I think we'll see even more of a response from the local communities. But so far, so good. We really feel that we will continue to see improvement in our first 50, and that will lead to an expansion over time into more of our go-forward fleet.
What's the method of getting the word out?
It's obviously geo-targeted emails. It's old-fashioned things like local radio stations. It's some work within the mall in terms of signage. It's communication about special events that we do, leveraging influencers and leveraging our partners who do some of those events. So you've got all these mechanisms in a distributed media market now. You've got these different opportunities to bring in the local clientele.
So many Macy's cardholders know those star rewards that come in the mail. Is that part of the strategy still?
Always. I mean, I think that we all want to be part of a good reward program, and a good reward program to each of us is one that has value. Do I get back more than I put in? So for our program, there's no cost to join, but the opportunity is that the more that you concentrate your spending at Macy's, the more rewards you earn. And that obviously results in free product or discounted product that you can enjoy. Same at Bloomingdale's, by the way. If you're a loyalist member at Bloomingdale's, you have the same kinds of advantages.
How do you take everything that you're learning at these stores and scale them out? And when will we see those scaled out?
Yeah, we'll make an announcement as a part of our fourth quarter earnings when we talk about guidance for 2025. But I think it's fair to say the ideal was not to have only 50 stores. So we will have more stores. We announced on the second quarter earnings call that we're expanding our tests in shoes and handbags to 100 more locations. That's additional staffing into those stores. And so far, so good. Pleased again with the consumer response.
More staffing, more inventory, or a change of inventory rather. How expensive is this investment?
Look, I think it's up to us as a business to do 2 things. One, to provide the customer a reason to buy at Macy's, Bloomingdale's, and Bluemercury. That's our responsibility every single day. And the other is to allocate our investments so they get the proper return. Our job is not to spend more money and get less from the consumer. Our job is to spend the right money and be able to inspire the consumer to buy. So these are choices. So in my mind, we've underinvested in our stores. There are other places we have to be more efficient. Third component of Bold New Chapter is improving end-to-end operations, so that whether that's more automation, use of AI, the opportunity to allocate inventory more effectively, to be in stock at a size and color level, depending on where you're shopping. Those things are all important at driving the cost down in our operation.
Yeah, the fact that you've underinvested in the stores as of late is really interesting, because for those of you who don't know Tony, he is a true merchant, as I've heard from so many people. You started your career at Bloomingdale's overseeing a sales floor of 15 people. You've always been in customer service. Fun fact, you worked at Burger King in high school. People are not as optimistic as you are about the department store. So many have turned to e-commerce. What makes you so confident that this strategy will help make Macy's relevant?
I just want to take a step back and rephrase the term department store, because essentially if I told everyone that I had a business, that we could be in the cosmetics business, we could be in the women's apparel business, we could be in the men's business, we could be in the home business, we could be in the electronics business, you might call that a marketplace. And a marketplace is very attractive to people, because a marketplace is where I can go and find the things I want in the brands and the prices and the styles that I like. And I think a part of what we've not told as compelling a story with is that department store says it's fixed. You know, what we've allocated to apparel or allocated to men's, we can't change. Crazy. We can absolutely change that. We could change the amount of inventory we have in those categories. We could change the amount of people we have in those categories. We could change the amount of advertising we dedicate to those categories. So what I love about department stores, and my love goes back 37 years now, is the fact that we can move to where the customer is going. So if the men's business is great, we can have more inventory in men's, more advertising in men's, and more people in men's. And if we're in a moment where people are excited about fragrances, we can double down on the fragrance business. And so I think sometimes that fact is missed when there is a interest in the specialty business or in the off-price business, that the department store has the bandwidth and the scale to be in all these categories. And celebrating life's moments is something that Macy's does pretty well. So whether it's the prom dress, whether it's the first interview suit, whether I'm getting married, whether I'm having my first child, all those are moments where we can show up. And because we're in all these categories, it allows us to show up as one of the top choices.
Do you think in recent years you have, or Macy's has, lost share? And do you think this will help you get it back?
Look, we wouldn't have launched a bold new chapter at the beginning of 2024 and said essentially, we're looking at ourselves in the mirror and we see something that we don't like. We've given up share. We're not delivering as consistently as we'd like. We want to reimagine ourselves. So in the Macy's brand, that was, again, shrinking stores and reinventing and reimagining the quality of the stores that we have. But it's also doubling down on the Bloomingdale's and Bluemercury business. Again, both those businesses are healthy. Bluemercury into 15 quarters of comp growth. Bloomingdale's coming off of its 150th anniversary a couple of years ago and its most productive and profitable year ever. And just launching in the second or third quarter, I should say, a celebration of Italy with over 300 unique products and 30 new manufacturers. So we've got 3 assets within our portfolio, not to mention the fact that we have IP like the parade and the fireworks and the flower show and Santaland. So there's a lot within this portfolio that gets me excited. Am I cautious about the current climate? Am I concerned when I see the customer being careful about price? Of course. But that frankly just makes us work harder in thinking about how can we motivate the customer to buy.
Speaking of the portfolio, I do want to talk about real estate. Consumers are visiting malls less. You have planned to close. Can we expect more closures beyond 2026?
What we announced was 3 years at approximately 150 stores. I don't see substantially more closures than that. Maybe a few fewer, depending on how those stores perform over the arc of the strategy. I love stores. I've been working in a Burger King, starting in our department stores. I love visiting stores. When I leave you, I'm going to Texas, and I'm going to visit 7 stores over the next day and a half. But they have to be good stores. And stores that were built 50 years ago in a different environment in a particular suburb where people are no longer going, that's not advantageous to our portfolio or to our brand. So we're going to have great stores. Our stores are going to be more interesting to shop, and they're going to be accretive to the overall omni-channel experience. Basically, it's the customer's choice where they want to buy. We're going to have great website, great app, and a great store experience. So if somebody wants to buy online, they could buy online at Macy's, Bloomingdale's, or Bluemercury.
Now, it's been quite the first year for you. Of course, we have to hit on that activist investor that you've since have ended talks with. Real estate was a big focus of theirs from Brigade and Arc House Management. Shares now far lower than that $24 offer that you got, now sitting around $15. Are you confident that this strategy will make Macy's more valuable than that offer?
I think it will, and the board unanimously voted in favor of parting ways from the discussions and focusing on the strategy of the company. You're going to have those things happen. And again, our strategy was not a 1 month or a 1 quarter strategy. Our strategy is a 3-year strategy, and it's creating sustainable, profitable growth. It's delivering a better experience for the customer. It's reimagining this portfolio, and ultimately delivering more value to our shareholders. So I think, again, it's incumbent upon us to look beyond the current stock price, to look beyond the current market dynamics, and build a better experience for the consumer.
Are you open to another offer?
We're always open to what's going to provide value for our shareholders. But I think that part of what sometimes gets overlooked is the fact that we're a retail company with great real estate. We're a retail company with IP, like the parade, the flower show, the fireworks, and Sandland. We're a retail company, but we're 3 retail brands, Bloomingdale's, Bluemercury, and Macy's. So I think in aggregate, there's a tremendous value that I think shows lots of potential for growth as we go forward.
One of those coveted properties is Herald Square. Curious, what is the valuation of the company, or rather the Herald Square location? Analysts have said anywhere between $1.5 to $3 billion in the market.
I leave it to the analysts to speculate.
Why does it make sense to keep it in the portfolio?
Oh, I think it's the nucleus of the Macy's brand, and that's not to say, by the way, I think you got a chance to see the store. We have currently over 30 different installations in a partnership with Urban Space, who operates the Bryant Park market, and so we're going to continue to look for other ways to add more interest, entertainment, animation, food and beverage into the store. But I think Macy's is Macy's because of stores like 34th Street.
Would you ever consider selling the air rights like you did a few years ago?
We are, Brooke, we are open to absolutely all ideas that increase value for the shareholders and deliver a better experience for the consumer. We have to keep both those things in mind.
Let's talk about the parade. We're about 2 weeks away. I can't believe it. Almost 100 years that Macy's has been doing the parade. How do you lean into that historic heritage of the parade, but also helping to drive sales using it?
Yeah, look, it's going to be a spectacular parade this year. If you're in New York, come to the parade. If you're not in New York, on NBC on Thanksgiving morning, almost 30 million people between NBC and Peacock watch the event. So one of the top-rated events over the course of the year. It will be the biggest parade ever. We've got Minnie Mouse for the first time flying in the parade. We have a partnership with Disney for the holidays where we have Disney shops in 200 stores. There's parade merchandise available online right now. You have to have your swag to watch the parade. So, I think that we're leaning into the IP. There's paraded deals that we're running right now leading up to Thanksgiving. I think one of the things that I felt coming into the role was that we've got these wonderful day or week-long events, and we haven't figured out how to expand them and really leverage the power of them. And I think our new head of marketing, Sharon Otterman, is doing a great job, and it's showing up right now in how we've approached Thanksgiving and how we'll ultimately approach Christmas holiday season.
Do you think the Thanksgiving Day parade could be even more modern? I mean, we're seeing others out there who are retailers show QR codes on affiliate events. What more can you do?
You will see more on the website on the day of Thanksgiving. You will see more on the lead up to Thanksgiving Day. You see Santa arrive at the end of the parade. Black Friday essentially is the beginning of the power holiday shopping season. So we've got the audience attention at the most important critical time of the year for retail. How do we capitalize on it? So I would expect you'll see us do that better and better. This is the 98th year of the parade. In 2026, we have the 100th year of the parade, the 50th year of the fireworks, the 250th year of this country. So I think there's a lot to celebrate. Let's get through 2024, but in 2026.
Lots on the road ahead. I just want to hit home this conversation. We're in this environment where young consumers are turning to Amazon, they're turning to Shein, they're turning to Temu. Do you think that you can capture the younger audience to stay and go to Macy's in the future?
Yes, as long as we continue to evolve our operating model. We have 5 generations shopping with us currently. And I want to make sure that 5 generations enjoy and feel comfortable shopping with us. Some are going to shop us for fragrances. We have lots of young people today who view Macy's as the fragrance destination because we have brands from all the different designers at all kinds of different price points. We're also the place where moms go with their daughters to buy prom dresses. We're also the place where people go, as we said, to get married. We're also the place people go to get things for their first home. We just launched a baby registry. The benefit of something like Marketplace online allows us to delve into categories like baby furniture and electronics and gaming, things that appeal in some cases to younger consumers that we haven't always had within our stores.
Tony, a quick question for my mom. Will we ever see a remake of Miracle on 34th Street? Another one?
I think it's a good idea. Why not? You know, first of all, it's one of those wonderful old movies that makes us all smile, warm-hearted going into the holiday season, and we've seen lesser movies remade, so why not remake that one?
Ooh, stay tuned. Tony Spring, Chairman and CEO of Macy's. Thank you so much. I appreciate it. Thank you so much.
All right, well, I'm pumped for the parade. I don't know who else is at this point, but we got a few weeks out until that point, so you got a lot. I was actually looking up who the balloons, the floats are going to be, so I've never stayed in New York for that period, so we'll see if I do this year. I'll let you know of my travel plans for anybody who wants to know. Also, we're going to take a break right now. You can join us in the terrace room for coffee, a quick bite, anything that gets you energized, rev back up, as we are set to begin once again and resume at 10:30 a.m. Eastern Time. And here's who we have coming up. We'll be sitting down with Lux Capital General Partner Deena Shakir. We'll also have Induro Industries co-founder and CEO Brian Schimpf, and also Precision Neuroscience co-founder and CEO Michael Major, as well as the former presidential candidate and co-executive chair of Galvanize Climate Solutions, Tom Steyer. All that and much more coming up at 10:30 a.m. Eastern Time. Yahoo Finance Invest will continue. Get on.
Welcome into our live coverage from Yahoo Finance Invest right here in New York City. I'm Shauna Smith alongside Jared Blickery, and we just heard from a trio of top leaders across the business landscape. Apollo CEO Marc Rowan joined our very own Brian Sozzi on stage. We have BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. He was on the stage as well with our very own Julie Hyman, and Macy's CEO Tony Spring. Both Marc Rowan and Rick Reeder weighing in on the election, the economic implications of what ultimately some of the fiscal policy could have, the impact that could have on the road forward. And then we were just hearing Tony Spring was on stage moments ago here, Jared, just talking about the health of the consumer, some of the trends that he's seeing. And overall, my big takeaway is everyone's very optimistic at this point. A lot of the uncertainty that we've been talking about over the last several months, much of that has been put to rest now that we know who is going to be in the White House. And I think many, at least from the business leaders that we heard from so far, Marc Rowan, just very confident in what President-elect Trump is going to bring here for the country, who he's going to surround himself with, and ultimately how that is going to shape the economic landscape here for years to come.
It has been an incredible short run here. Since the election, markets have really responded so positively just to the fact that there is a bit less uncertainty. There is a wave of CapEx spending that was just waiting to be unleashed, and it looks like that may be underway, and so we'll have to see if that materializes. But stocks may be getting a little bit ahead. Stocks are very optimistic, and one of my big takeaways so far from this morning, Tony Spring talking about Thanksgiving and the Macy's Day Parade right around the corner, just kind of creeps up on you every year. But it has been an incredible event. We were talking not only with Tony Spring, but Rick Reeder, Chief Investment Officer of Global Fixed Income over at BlackRock. And we've got Brian Sozzi with us as well. We're going to talk with him in a little bit about Marc Rowan and Apollo Global Management, some new initiatives there. And just overall, thinking about the big picture landscape with the new president in office, cabinet being decided right now, and we've seen the risk markets take off. We've seen them respond in a very positive way. We've seen stocks surge. We've also seen bond yields surge, and that has been kind of a thorn in the side for markets before, but maybe markets are responding to the prospects of growth. And so when you see higher bond yields concurrent with prospects for growth, then it's not necessarily such a bad thing. We've also been seeing a stronger dollar, and sometimes that weighs on risk. But I'll tell you what, we have seen a stronger dollar and stronger stocks many times in the past. So it's not one of those head scratchers. It depends on the environment, and that's kind of where we are right now.
Yeah, and I thought Rick Reeder's commentary just about the fact that the economy is in pretty good shape. He talked about the fact that the fiscal implications, what exactly that ultimately is going to have, just in terms of the impact that's going to have on inflation. Much of that remains unknown known at this point, but he did talk about the fact that there's still lots of reasons to be optimistic going forward, and it's about finding those investment opportunities, which we know is so important to our audience. And we are just getting started here at Yahoo Finance Invest. We have an all-star lineup for you here over the next several hours. We have Deena Shakir of Lux Capital will be joining us. Brian Schimpf will also be on stage here in just a few moments. We also have Michael Major. He will be joining us here of Precision later on this afternoon, as well as Tom Steyer. He will be joining Madison Mills on stage here in just a few minutes. So again, lots to look forward to as we really get insight across industries, former policy leaders, even Neil Kashkari coming on later on in the day, just giving us some insight as to what the landscape is going to look like here for the economy, for the markets here, for potentially for years to come. We want to bring in our very own executive editor, Brian Zazi, to hear his takeaways so far from Invest. And Brian, you kicked it off for us here this morning with Marc Rowan. Great interview, great insight into how he's thinking about various investment opportunities right now.
I should be out in that room catching a bagel, shaking hands, and kissing some babies. I mean, only for you two am I going to come here.
Thank you. 5 minutes of your time, that's all we ask.
All right, I appreciate it. Sure, but before we get to me, like, who are you? You got some big interviews too. Like,
I do have some big interviews. Chris Licht, the former CEO of CNN, I'll be speaking with later on today.
I haven't heard from him
Arvind Krishna, we haven't heard from him, but there's going to be lots of, I think, focus on exactly one, what he's been up to, but two, what he thinks of the election right now. Now that we have the outcome, the impact it's going to have on the media landscape, that of course is going to be so important to talk about. And then Arvind Krishna, the CEO of IBM. We talk so much about tech leading the rally, AI.
You're talking about a tech turnaround right there. IBM stock at record highs. When's the last time record highs? We've seen it. We've seen it up there. We've seen it up there.
All right. So for me, I just want to talk. I'm so happy. It's like this is just an awesome event. This is a cool thing we do each year. The team is killing it. Tony Spring, wow, big interview by Brooke De Palma with Macy's CEO, talking about why he said no to taking that company private. But what I thought was interesting, besides all the parade stuff, I'm a big parade fan. I just love watching the Macy's Day Parade.
Who doesn't?
Right, but what he talked about is more store closures in parts of this country that it no longer makes sense to have a department store in. If the community has moved to urban areas, that giant 100,000 square foot box that says Macy's on the side makes no sense. Close the freaking store down. So I appreciate what Tony Spring is doing, and I understand it. Now, in terms of Marc Rowan, of course, Apollo is the parent company of Yahoo Finance. Marc kicked off the conference, and I thought what he said about Elon Musk was fascinating. Brief comment, but I think very telling. I think Marc views Elon as transformational, a potentially transformational person involved somehow in the administration, maybe somehow cutting costs. Perhaps with those cost cuts, you can cut taxes and somehow still see the deficit go up at the same time. But Marc, very bullish. He's been talking to a lot of, he's amongst the Wall Street insiders talking to the Trump transition team, I think recommending some key folks for key positions. But again, to your point, Shona, another leader, at least in the early going, optimistic on what the Trump administration can do perhaps within the first 18 months.
I also thought it was so interesting what he had to say about the geopolitical risk standpoint. I mean, you had a couple of follow-up questions there just in terms of how he's thinking about that, whether or not it's at greater risk with a second Trump administration. And he basically was saying that he didn't think so. He thought it was pretty much on par with what we've seen in the past. And he was relatively, I guess to use the word optimistic again, but just in terms of the fact that we will be able, or the new administration will be able to navigate what is obviously a very tumultuous and challenging time here globally.
I actually asked that question with Jared, with you in mind, actually, because you're always at our Wi-Fi Interactive. I mean, and lately, we're talking about record high stock prices. So for me, I'm looking at what could pop a hole in this balloon. China. And it is the geopolitical risk. If Trump comes out here and says we're slapping even higher tariffs on China, we're going to put a tariff on Europe. I mean, how does the market react to that? To me, I think it would react negative. It goes down.
To the down. It reacted first to the downside, but we've seen it claw back. And I think Chinese measures to stimulate their own economy have kind of fallen a little bit flat. We've seen it come in fits and starts. So it's going to be key here to see how not only what Trump's policies are, but the Chinese in reaction, because that's been the wild card in the past and the big question mark.
And nothing happens overnight. We started at 8 a.m. with a live episode of my opening bid podcast, and Sarah Malik and Neela Richardson. Sarah giving us some good breaking down the move behind Tesla stock. Encourage everybody to listen to that episode.
$350.
Yeah, wild.
Wow.
Just wild. But Neela made a good point. A lot of the market is pricing out what could happen in the future. That's what the market does. It's a real-time pricing mechanism. But looser regulations, easier policies. This stuff doesn't happen overnight. It doesn't mean we're getting 8% GDP growth next year. I mean, we could see the economy chug along in the first half of next year, 2%, 3% GDP. back to creating 100,000 jobs a month? I mean, that's not the boom that the market is expecting. It's going to take time.
It's also not a recession.
No, it's not a recession.
That risk was really priced out. You can't even talk about recession nowadays because the risk seems to have changed from from the hard landing to the no landing. And the risk of reacceleration is there. We're going to get CPI, I believe, is it tomorrow already?
I've lost track.
All right.
I barely know where I am right now.
Yeah, we'll be covering that live 8:30 a.m. Here at Yahoo Finance. But the CPI prints have been relatively tame. So what happens if they start reaccelerating to the upside? I think that's a risk that might be underappreciated right here.
And a little bit of we've already, I asked Sarah a little bit about crypto.
Ooh, Bitcoin 90?
This move is pretty wild. And I think this is a theme that's going to start coming up in some of the afternoon sessions. I'm talking to Bank of America CEO Brian Moynihan. I remember talking to him at the World Economic Forum 4 years ago. Didn't strike a bullish or bearish tone on crypto, said they were watching it. I think that was fair at the time, but now, I mean, you see Bitcoin knocking on the door of 100,000.
You got to participate. You can't watch.
You can't watch. I mean, what does the easier regulations for digital assets mean to a bank like Bank of America? What does it mean to financial services? What does it mean to the average investor that comes onto Yahoo Finance? How do they play this? Do you buy the BTC, or do you just go all in NVIDIA again, the original OG AI mining play?
Dogecoin, it is a joke coin, but Dogecoin is up several 100%. And while that doesn't have a particular use case, Shiba Inu. I mean, there's a lot of, you laugh.
I just love the dog. I love the dog.
Okay, who doesn't love the dog? But there's some serious math and science behind a lot of these tokens. Yeah. So there's a lot of choices out there, but you have the stalwarts, the Bitcoin, Ethereum, Solana. Solana's just been gangbusters recently. So we'll see who wins the network effects that come with Web3. That's another huge conversation.
All right, guys, we got to leave that conversation there. Saz, great stuff. I know you are a very, very busy man here today. Let's kick it over to Alexandra Canal. She's standing by in our studios. Ali.
Hi, Shauna. Yeah, we're looking at a mixed sector picture right now. We're seeing markets led by communication services, energy, financials also in the green. Energy has been drifting higher as we see oil prices move to the upside following those OPEC cuts. Meanwhile, to the downside here, we have materials and utilities. Utilities often seen as a defensive play. But if we take a look at a 2-day period, these are some modest gains and losses in either direction here. We'll see things like consumer discretionary really surge over the 2-day period, up more than 1%. Remember, Tesla is a name within this category, and that's just seen monster-sized gains following the election of Donald Trump. And speaking of that, I want to take a check at Bitcoin. You guys were just discussing that. We're seeing prices trade above 87,000 a coin. We saw Bitcoin prices hit all-time highs on Monday, over 88,000 a coin. A lot of strategists saying that it's possible we could see $100,000 very soon. If we take a look over the past 10 days, you'll see that Bitcoin just rocketed higher the day after the election on Wednesday, up about 26%. Over the past 2-month period, we are up about 50%. And this comes as there's a lot of optimism over a Trump presidency, what that could mean for crypto, how he's more open to crypto overall. So the altcoins, Bitcoin, a lot of those crypto adjacent stocks like Coinbase, Robinhood, even MicroStrategy, which carries a lot of Bitcoin on its balance sheet, we're seeing move to the upside today. So a lot of things we're keeping an eye on. We did see, we're seeing all 3 of the major averages reverse earlier gains. We're now in the red here, although the NASDAQ is hugging the flat line. So we'll see where we continue to trade throughout the session, guys. Back to you.
All right, we certainly will be keeping an eye on that. Ali Canal, thanks so much. And that market check is sponsored by Tasty Trade. Keep it right here on Yahoo Finance. We got much more coming up live from Yahoo Finance Invest. That's straight ahead. Now time for some of today's trending tickers. First up, let's take a look at Shopify issuing an upbeat holiday forecast here. Taking a look at that stock, obviously the street reacting positively to that upbeat holiday forecast. AI tools attracting more customers. E-commerce company also topping the street's expectations for third quarter revenue. And taking a look at the street's reaction, Jared, one of the things that stuck out to me in analyst reaction very quick following these results was how much optimism there seems to be surrounding cash flow margins. And what we're seeing there just in terms of their free cash flow, that certainly seems to be a standout here this quarter. But I think one of my big takeaways was their AI investments. We talked about how critical that is for so many of these companies, especially like Shopify. Their AI investments clearly seem to be working, and it's helping them attract more customers there to its product.
AI is working, and it's creating a better experience, better user experience. And here's what RBC Capital Management had to say about the report. And by the way, they have an outperform rating on the stock with a price target of 100, which is now lower than the price today because it's up 25%. But here's what RBC is saying. Both results and the outlook are, quote, well ahead of expectations. They expect free cash flow margins, and this gets back to what you were saying, Shauna, in the fourth quarter to be in line with the third quarter at 19%, which implies free cash flow of $509 to $525 million, and that's versus consensus of $471, so way above consensus. Another quick quote from Vital Knowledge. They say the results show, quote, decent upside on key metrics, and then they're also talking about the free cash flow margins. And if we can go to the Wi-Fi Interactive real quickly, I'll chart some of this. Here we have Shopify up 25% today. That's got to be the best day in a while. Here is the year to date, and you can see basically unchanged until just prior to the report today. Now up to 44%. It was getting some lift off in the prior week, as a lot of stocks were. And then let's check out the max, because this was an early pandemic darling, peaked in 2021 in the early part of the year, as a lot of disruption stocks did, as a lot of those e-commerce stocks did, fell off something like 80-90%, and it is up considerably since then, past the 50% mark there. Shauna.
All right, Jared, let's take a look at Tyson Foods. It's the next stock that we're watching here this morning. Tyson Foods beating fourth quarter earnings on strength in its chicken business. The meat supplier also forecasting stronger results here for the year ahead. Now, chicken is Tyson's second largest source of revenue. So if you're not familiar with that, you just talk about how significant then this is. Chicken actually accounted for almost 70% of Tyson's profits here during the period. The bulk of the rest coming from prepared foods. Beef was a weak part of the business, contributing to about $71 million in losses. But again, when you take a look at these results, stronger results in 2025. So it looks like at least they're expecting some of the strength that they're seeing in chicken to offset the weakness that they're seeing in beef.
Yeah, and when you take all of that net, they are seeing the forecast for 2025 is sales expected to be 1% to flat. So not a lot of upside there. But as you said, there's some differences in between. There are different operating segments. They are seeing 2025 beef adjusted operating loss, and that's what you're talking about here, is that loss in beef between 0.4 billion and 0.2 billion, and then they're seeing pork prices, pork adjusted operating income of 0.1 billion to 0.2 billion. Let me go to the Wi-Fi Interactive and I'll chart this stock as well. Tyson up 10% today. Let's check out the year to date, and you can see up 20%, just kind of testing those highs that we saw just before in the late August period. And then let's go to a max as well, and we can see this was another pandemic story. I can show you a 5-year and it'll show the years a little bit better, but peaked in 2022, and considerable drop down right there, and it's just been reclaiming some of that territory over the last year, now up about 38%.
All right, Jared, let's take a look at Hertz before we go here, because that stock is falling off the lows of the morning, which is important to say. It had been off just about 8%. Now we're looking at declines closer to 3%, but falling after posting a wider than expected loss. The company booking a $1 billion charge. That, of course, was related to the declining value of its fleet, an issue that Hertz has been trying to figure out, and a lot of that because of Tesla, the strategy there that clearly did not work out in Hertz's favor. They have a new CEO, Gil West. He's at the helm right now, trying to push in a lot of changes. He certainly does have his work cut out for him. You talk about the fact that he's trying to cut costs. He's overhauling the management team. He's been working to fix some of the damage here by selling tens of thousands of cars. But right now, you take a look at that one-time impairment charge. The fact that it was a $1 billion non-cash impairment charge really just, I think, illustrates the difficult position that Hertz is in right now.
I have a confession. I almost added to that impairment charge. Early on when Hertz was rolling out their Teslas, I signed up for one of them. I happened to be going to California, and I almost crashed it before I got off the lot. No jokes. But I did not. And,
Why?
Well, just because I didn't really know what I was doing and I didn't have a lot of instructions. I was shocked that they just gave me this fully electronic vehicle, lots of touchscreen action there that I was not apprised with. And but no, I'm perfectly safe. But I did not contribute to that. But that was a huge factor there.
Yeah, certainly. And I think when we're trying to figure out where things go from here, analysts obviously still have lots of questions. This is the fourth quarter in a row that we did see quarterly losses. So again, we have seen this steady decline here in Hertz's business. So obviously it looks like the new CEO has his work cut out for him as he does try to turn things around. Let's take a look at some of the highlights so far from this morning's Yahoo Finance Invest. Let's take a listen.
We're coming in this administration is coming in at a point in time where they really do have an opportunity to pivot. Think about where the U.S. is in the world. I mean, all the action is here. I mean, just recite what's going on. The economy is in great shape, certainly relative to the other two large blocks of Europe and China. We have stimulated our economy over the past 4 years, and we're about to get the dividend of that. I mean, we forget 3 years ago, we passed almost $2 trillion for infrastructure. It's all under construction. 2 years ago, $52 billion for semi plants. Not a single plant is open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, all under construction. 3 years in a row, we've been the largest recipient of foreign direct investment, all under construction. It's coming our way. We're where the action is, and now the question is, can we lead?
Think about where we were a few weeks ago. It's pretty remarkable. The narrative was hard landing, economy slowing, consumers falling off a cliff, et cetera. They priced the Fed down to a 270 funds rate by the end of next year. We're almost at 4% today. So it's interesting when I hear people say, well, rates are coming down. It's like, my screens don't show that. It's pretty remarkable how much things have shifted. The economy's in pretty good shape. We printed 3.0% GDP in the second quarter, 2.8% in the third quarter. Didn't feel like hard landing. Consumer is, and you could see that in the earnings reports, consumer's still doing pretty well. Now you have this election. Now you have a whole new playbook around the red wave. And quite frankly, the dispersion of where interest rates could go has just widened out.
This isn't the first time we've seen the discussion about tariffs. We have the experience from the first administration, Trump administration, and certainly the Biden administration left in place some of the tariffs. So we as retailers and as manufacturers have diversified our sourcing. So certainly for the private brands that we produce, the vast majority we've moved out of China into other countries we produce in. And it's an ongoing conversation with our business partners, our manufacturers, our suppliers, and making sure that they're thinking about, obviously, if something can be made outside of China, that's going to be advantageous. If you can at least balance your production into another country, that's also going to help. And I think it's frankly opened up South American market for production and other parts of Asia.
Will you have to raise prices?
Look, it's too soon to say, and we don't know the magnitude.
Coming up, we have much more for you live from Yahoo Finance Invest here in New York City. We'll be right back. Welcome back to our live coverage of Yahoo Finance Invest here in New York City. I'm Shauna Smith alongside Jared Blickering. And Jared, when you take a look at the markets here, almost an hour into the trading day, and looks like we're seeing some fatigue maybe in the recent rally.
A little bit. We're not seeing a whole lot of activity, but if we go to the Wi-Fi Interactive, we can see a mixed market. NASDAQ has been flipping between red and green. In fact, so have the other indices. S&P 500 currently red. Dow down about 19 basis points. We'll get the number total for you. Looks like down 81 points. So just a really minor action here that we're tracking. Also want to take a look at the VIX. We have seen volatility dropping since the election. Now we have a 14 handle, so underneath the 15 level, I'll just show you 3 months worth of VIX action. You can see kind of like a sine wave here, going up, going down. We're at the bottom end of the range. That is very conducive for risk in the risk markets here. And let's get a read on the bond market as well. We have the 10-year T-note yield up 7 basis points to 4.38%. These are fairly high levels, but what gives me some optimism here, word of the day, is the ICE B of A Move Index, that is bond market volatility, which has also dropped precipitously since the election, so matching equities there. So it's been a risk-on environment, though we're not necessarily seeing it reflected today. And in fact, staples is the #1 performing sector. That's a bit defensive. So is energy, tech and communication services rounding out the green. Materials, the biggest loser. Consumer discretionary also down more than 1%. And then here's the NASDAQ. NVIDIA almost at a record high, not quite there. Tesla taking a little bit of a backseat today. It's been on a tear recently. Meta up 1%, Microsoft up about 0.25%. And let's get a check on crypto. Bitcoin flirting with 90,000. Right now, it is at 86,923. So right there, Shauna, near the Rubicon.
It certainly has been remarkable to see the steady climb that we have seen in crypto, especially in Bitcoin. All right, Jared, we are just getting started here at Yahoo Finance Invest, and we have a huge lineup of guests still to come. Coming up next here from Yahoo Finance Invest, we have Deena Shakir of Lux Capital, Brian Schimpf of Anduril, Michael Major of Precision, and also Tom Steyer of Galvanize. He will be joining us shortly here at Yahoo Finance Invest. Stay with us. We'll be right back.
please welcome to the stage your hosts, Yahoo Finance anchors Julie Hyman and Brad Smith.
Welcome back our live audience here in New York City, as well as, of course, all our viewers who are watching us online. We've got a lot more coming your way with our morning program here, including interviews with leaders from Lux Capital, Anduril Industries, Precision Neuroscience, and Galvanized Climate Solutions.
Yes, so let's begin things. Health technology is changing the patient experience, placing new value on individualized data to customize health and wellness journeys. For more on the future of the industry, please welcome in Deena Shakir, General Partner at Lux Capital and Yahoo Finance's own anchor and reporter Madison Mills.
Morning, everyone. Thanks so much for being here today. And Deena, thank you so much for making the time this morning. As our lovely MCs mentioned, you're over at Lux Capital as a general partner. I know you focus on tech, women's health, a lot of different areas of investment. I just want to level set to kick off, right? We've heard a lot of conversation on stage today about interest rates coming down. It's the era of free money, rah, rah. Is that what you're seeing? What have you been seeing over the past 6 months or so?
Yeah, well, first of all, thanks for having me. Delighted to be here. You know, venture is an asset class in finance that has to think 10 years ahead. So we don't necessarily immediately see the implications of what's happening from a day-to-day perspective on the markets. That being said, it's a tale of two cities in venture. And so you've got the AI side of things, and now I would also add perhaps the defense tech side of things. I know we have one of our companies presenting right after me. And then there's the everything else. The everything else has not quite seen that exuberance yet. The AI and defense tech is benefiting quite a bit from some of these tailwinds.
What will it take for the everything else to catch up?
Well, I think we're all waiting with bated breath for exit opportunities. And it's been very slow for several years now. At the end of every year, when I'm doing one of my prediction, interviews about what the next year will look like, we're all hopefully optimistic about what the IPO market will look like. But it remains to be seen whether we're actually going to see some real, healthy IPOs. And then, the M&A side of things has also been a little tough, certainly with some of the pressure from the current administration around that. So there's a bit more hope around that to come as well.
That brings me to the idea of Trump 2.0, which I'm hoping to get into with you here. A lot of optimism on the stage about what the next 4 years look like. Marc Rowan saying he's incredibly optimistic to kick off the day. As an investor yourself, but also an investor who focuses on women's health, how does that rah-rah attitude sit with you?
Yes, I think, not to use the phrase again, but I think it's also, again, a tale of two cities. Let's talk about the venture side of things, and then we can get into the women's health and the health tech. On the venture side, I also sit on the board of the National Venture Capital Association, so we spend a lot of time with legislators on the Hill trying to advocate for policies and for changes that will benefit the entire industry, that will benefit the founders in whom we invest. And there are some things, I mentioned FTC and so on, that perhaps, could open up a little bit more under a new administration. And so that may present some broad macro excitement in the industry. But when it comes to health and when it comes to women's health, I don't think that many folks in that space necessarily share the same optimism. I think there's a lot of concern for autonomy. But at the same time, oddly, quite a bit of optimism. And the reason that I say that is because we already sort of experienced this. In fact, I did an interview with Yahoo Finance right after the repeal of Dobbs, where I said I had seen, and I'll say this is true today, an influx, almost an inundation of inbound from investors as well as entrepreneurs who are particularly interested in women's health, who see capital as a means of capital deployment as a means of action. The investors, are one side of it, but the innovators are actually what give me the most hope. The entrepreneurs in our portfolio, many of you might know Kate Ryder, founder and CEO of Maven Clinic, Melissa Taran from A-Life Health, Ellen De Silva from Summer Health. These are entrepreneurs who are in it for the long run and who see what they're doing on the private sector side as a way of providing services which are taking care of an evergreen need for healthcare. Let's face it, regardless of what changes on the regulatory side, regardless of who is in power in the Oval Office, healthcare needs don't go away. They won't go away. And so the opportunity for entrepreneurs to step in and use technology to create really valuable businesses, but ultimately to serve the needs of advancing human health for women and for families is perhaps more important than ever.
I remember in that Yahoo Finance interview after the overturning of Roe v. Wade, you talked about the massive increase in sales that Maven saw, which is a women's health-focused health tech company. Have you seen a similar groundswell in investment post this election? What does the reaction function look like?
Well, I think it's too early to tell, but I will say that I have seen, certainly I'm talking to all the companies in our portfolio regularly and to other like-minded investors who deploy capital in this space. There's a little bit less shell shock than there was previously. Now it's like we've done this before, we've seen this before. I think there's perhaps a bit more concern around the public health side of things and what might happen there. But when it comes to women's health investments and women's health companies, not a lot will change immediately. Remains to be seen how many of these sweeping changes will affect the companies in terms of the work that they provide. But for now, it's carry on, and the work is more urgent, more important than ever.
Another aspect of the macro picture I want to talk to you about is this idea that women are getting richer. They're inheriting more wealth. I think it's $80 trillion expected to be funneled to women by 2030. As women get richer and they are becoming the biggest investors, is there an opportunity in venture, in private investing, for women to both seek out better returns but also higher impact that you talk about?
Yeah, absolutely. When it comes to, we just talked about women's health. I'll use that as an example. Women's health is an area that represents, of course, half the population. 80% of the dollars spent in healthcare are actually controlled by women. Neil Shaw, who's the chief medical officer of Maven Clinic, coined a term which I like to piggyback on, who says that women are the chief medical officers of the home. And yeah, this category was categorically underinvested in. It was seen as niche. Literally that word, for many, many years. And it still represents a very small percentage, not only of dollars deployed in venture, but also on the R&D side of things. So there is a massive opportunity to unlock here. And the fact of the matter is a lot of the people doing that deployment are also women, because for a very simple reason. It's natural, intuitive to us. We live it, we experience it. And for a long time, when the investors were largely male, and if you talk to some of these early innovators like Kate, she'll tell you her seed rounds, even her Series A, 90% of the investors she was talking to were men. Still a lot of the investors are men, even in women's health, but their diligence process was talking to their wives or their daughters. So that is changing, and I'm on boards of women's health companies with a lot of men who are starting to see that this is not just good for the world, but it is good for business, that there is a real opportunity to create value for our shareholders, for our LPs. And I think that's something that we'll start to see lots more of, hopefully coming from women.
And Maven just hit a milestone, right? A $1.7 billion valuation, I believe. Does that officially put the idea that women's health is niche to bed, or is there still more work to be done?
Well, I think the idea hopefully should have been put to bed a long time ago.
Well, hopefully.
Yes, and Maven was, in 2021 became the first unicorn in this space. They are continuing to trailblaze, but what we all really need to see is some exits. And so I think that, again, as the market starts to open up, hopefully we'll see more of that these are not only incredible private companies, but can be generational businesses that are durable and hopefully, can become public entities. And so.
What do you watch to indicate that we're finally heading towards exits? I know this is the big question you always get asked is, okay, is it the exit year, like you said? Mm-hmm. What are you looking at that maybe investors in the room can also start to kind of copycat to indicate, okay, we actually are finally seeing the year of IPOs come back in?
Yeah, I wish I could say I was Nostradamus on this. I don't think I necessarily am, but we look at, what the crossovers are doing. Mm-hmm. We have a lot of conversations with, public investors. We look at how the very few comps we have in this space, but how those comps are performing. We look at sort of the pace of growth capital and how that's changing. And we look at, macro, right, like everyone else.
Is the macro starting to signal a sea change the way that we've seen, at least in the markets, and just the euphoria?
Not quite euphoria yet, but there has been a little trickle on the public side, at least this year, which is more than we could say for the last couple of years. And so hopefully that bodes well. And here we are just, it's only been a week or so, right? So we have to see the impact of what will happen with the administration changing in January. But I certainly have heard a lot of optimism.
And is I can't believe how I've gone 10 minutes into this and haven't mentioned the Fed. This is clear that we're right after an election result, but how much is that macro picture of the moves of the central bank going to play into what we see with IPO exits next year?
A lot, certainly, yeah. A lot, and I think it always has, and it always will, and that's sort of the elephant in the room.
Yeah, I think another big aspect of the market rally that we've seen beyond the tailwind from the Fed is, of course, the AI rally and the AI euphoria. Have you seen any of the AI goodness hitting the companies that you follow, specifically in women's health? Like, I know we talked about this on our pre-interview call, but I can't believe that the options that women have for giving birth, they're still the same that my mom had, like epidural or natural. And my friends and I in the group chat are kind of baffled that there hasn't been some massive new evolution that we can look forward to, right? When is the AI goodness going to hit women's health?
I'm actually really excited about what's out there. There's a lot happening, but let's remember the actual percentage of dollars going into R&D in women's health is less than 2%. So as long as less than 2% of research money is going into this space, we're not going to see crazy breakthrough. Yeah. That is changing. This past year, ARPA-H had this $100 million initiative to fund women's health research, real moonshots, just like they did, with other sectors. We're seeing everything from investments in artificial womb technology, incredible advances on fertility tech, AI in particular being used. We have a company in our portfolio called A-Life, which is revolutionizing the way that embryos can be selected and optimized for that. Early detection of cancer, lots of advancements on that. Early detection of things like preeclampsia. As you know, I personally suffered a near-death experience with postpartum preeclampsia that couldn't have been predicted. And I've started to see some technologies that are actually looking into early detection of these types of diseases that can be deadly to women. So there is a lot out there. It just takes a longer time horizon, and it takes a lot more capital at the earliest stages. And at Lux, we love to invest at those early stages, and particularly in breakthrough science. And so we have the opportunity to invest in companies that are really just an idea and an incredible researcher, and turn that into a viable, durable business.
How did that experience that you mentioned, postpartum, and the health impact that you personally had, how did that impact how you look at investments, what you're looking for, and just your perspective on what's next?
Yeah. So I have 3 children, and my youngest is 14 months. So just over a year ago, I was just about a week postpartum, and I was at home already when I had the worst headache of my life. And truly, if this had happened with one of my other kids, I probably wouldn't have survived. But because I live and breathe women's health, somewhere in the back of my mind, I had registered if I have a headache, I should check my blood pressure. And I happened to have a cuff because I had this emergency kit that I bought during COVID. Turns out my blood pressure was off the charts. It was like 200/99. I didn't even know what that meant because I've never had high blood pressure. 3rd kid, never. And Maven Clinic saved my life. Literally, I was so fortunate to have the chief medical officer on speed dial. He triaged me. I quickly went back. By the time I was admitted to the emergency room, they told me if I had been 15 or 20 minutes later, I probably would have had a fatal seizure. And I was in the hospital for 5 days. So that experience really reminded me of why we do what we do. I shouldn't be so lucky that I happen to have, this chief medical officer on speed dial. Technology and AI now should make it this accessible for every human being in this country to get access to information and care when they need it. And so, although it was the most terrifying, health scare I've ever had, it really energized me into the kind of work that we do. And when it comes to AI in particular, it is being applied in more and more areas. We're just at the precipice now of beginning to see the implications. It's changing so rapidly, so quickly, and it's every company in our portfolio is applying it or building on it in ways that are revolutionary.
And it sounds like you see AI as a way of democratizing access to health so that someone who doesn't have the chief medical officer on speed dial has a fighting chance as well.
Absolutely, and everything else, right? For clinicians to, spend their time caring for patients and not doing administrative work. For researchers, we are looking at a company right now that's in the regulatory and compliance space for clinical trials. Doesn't sound like the sexiest topic, but making that process more efficient is going to be what leads us to these better breakthroughs down the road. So we're looking at all aspects of the healthcare industry.
And specifically on AI, do you even look at a pitch that doesn't have AI mentioned 1,000 times?
Well, every entrepreneur now has to have their AI slide, certainly, but we can also see through that. It's pretty clear when you're just kind of like, oh, and here's the AI of it all, as opposed to something that's actually really being built on this novel new technology. And so it's not a criteria that I necessarily need to see, but if it makes sense and that company's not looking at it, they're not going to be able to keep up with the times.
And interestingly, OpenAI obviously just had a huge funding round, the biggest in VC funding ever at $6.6 billion. Do your LPs want Lux getting in on OpenAI funding?
I mean, our job is to return money to our LPs, and the way you do that in venture is you buy low and you sell high. And so hopefully we're looking at the next OpenAIs of the world, and we believe that we are, and being able to build ownership early and to see before it's obvious. We like to say that we turn the impossible into the inevitable. And so if something is already at that stage, the return profile looks a little different than it would if you're investing in those really early stage companies.
How are you finding the next OpenAI? What does that look like?
Yeah, so we just launched a new initiative, which is called Lux Labs, some of you may have heard of, where we incubate companies. We are doing everything from spinning research teams out of big tech. I worked for many years at Google, and I used to work with a lot of these researchers. A lot of those public tech companies now are not investing as much in the R&D side because they're focused on the bottom line. That offers a lot of talent that we can look at. And so we have a company in our portfolio based here in New York called Osmo, which is an example of that. They're literally digitizing scent. That's right, scent, like your nose. It's incredible. In fact, they just launched a tool where you can use AI to create your own scent. I happened to use it recently, and I literally described a scent, and it was mailed to me just a few days later, and it's exactly as I envisioned it. So, that of course is the sort of the fun side of it, but this technology can also be used to detect disease, to help manufacture pharmaceuticals, and so much more. So we love to invest in those kind of technologies coming out of academia, out of big tech. We invest in incredible entrepreneurs as well at the earliest days. That's our job, is to find that talent.
So heading into 25, what would you say will be the VC buzzword coming up here? Is it still going to be AI? Is it going to be something else?
AI, I think, is not going anywhere. I think perhaps we'll start to use more specific terminology because, AI itself is not exactly. I was working on AI a decade ago at Google, so it's not new. But what's on top of that? And I think we're going to start to look at more of sort of the AI applied to picks and shovels, as opposed to just sort of the chat GPT of it all. And so companies like I mentioned that are doing, things like regulatory and compliance, AI being applied to biology, AI being applied to manufacturing, AI being applied to defense. We've got Brian coming after this. So those types of things I think we'll start to see more of now that the sort of original euphoria is dissipating.
Well, as we wrap, I do want to mention you're also an author, and we've got your latest book here, Lena Mo's CEO. Children's book author can be added to your massive resume. Deena, talk to us about Lena Mo, what you see coming up next for her.
Sure. So we've got copies out here, actually. So if anyone has a child in your life, I hope you pick it up. I wrote this book out of a personal need. As I mentioned, I have 3 kids, and a few years ago, I went to their preschool to explain what I do for a living. Those of us in the field know it's hard enough to explain to fully educated grown-ups what venture capital is. It was a very tall order to explain it to 2 to 4-year-olds, but I took it upon myself to do that because there was no book out there. And the fact of the matter is, I'm investing in 10 years ahead. We should be investing in 20, 30 years ahead. And if no book exists right now for kids to dream big, to see how technology, literally this book is about a girl who builds a robot, how technology can help solve a real problem and turn it into a real business, we're not going to be able to find those entrepreneurs in the future. So I wrote it for a personal need. I've gotten amazing feedback. Turns out kids like it. It's fun. And in terms of what's next, we'll see. But my goal in writing this book, and the reason I've decided to go with Simon & Schuster as opposed to self-publishing, is I want this book to be in every library around the country. I want it to be in schools, and so I'm also donating 100% of proceeds to charity as well. So it's really more of a passion project, but it's been really fun, and I hope you all can grab a copy and that you like it.
All right, well, Deena, we'll leave it there. Thank you so much for joining us.
Thanks for having me.
Really appreciate it. Thank you.
Thanks.
Much to Maddie and Deena for that conversation. As they mentioned, for people who are here in the audience, there will be copies of the book outside. Even if you don't have kids, no judgment. If you want to understand better how venture capital works, I have a feeling it'll help. Well, Deena actually gave a shout out to our next conversation, which moves from med tech to defense tech, which has been such a fascinating area to track and cover. You know, we're used to talking about the big publicly traded defense contractors, the Northrop Grummans, the Raytheons, the Lockheed Martins of the world. But of course, there is this new crop of startup defense companies that are really focusing on disruptive tech within that field. One of those, of course, is Anduril Industries. The co-founder and CEO is joining us now, Brian Schimpf, along with my Yahoo Finance co-anchor, Josh Lipton. Please welcome them to the stage.
Brian, good to see you.
Good to see you too. Thanks.
So maybe we could start with politics, Brian. So Donald Trump moving back into the White House, and I know a lot of people are trying to figure out what that is going to mean in terms of foreign policy. And I'm curious what you think it could mean in terms of how it could end up comparing and contrasting with Biden.
Yeah, so, look, Anduril's done well in prior Trump administration. It's done very well in a Biden administration. And I think will continue to do well in any future administration. I think the reality is we are probably in one of the biggest periods of geopolitical uncertainty and instability we've seen in our lifetimes. And the bizarre thing to me is we don't really talk about it that way, right? Like, when is a scenario that, Houthi rebels have basically disabled shipping in the Red Sea? We're, in a hot conflict in the Middle East. And then obviously the Russia-Ukraine stuff continues. And there's escalating tensions in the South China Sea. Like we are engaged in an unstable world all around the globe right now. So I think for a Trump administration, the most important thing is to recognize the degree to which American leadership on this still really matters. Mm-hmm. And a lot of that is going to come from the fact that we have the strongest and best military, and that we need to take leadership. We are the only superpower that is actually about human rights, rule of law, and that is incredibly important stabilizing factor for the world. So I think if anything, the Trump administration has an amazing opportunity to reassert that leadership, to show our allies and partners we stand with them. They need to also stand with themselves. We need to support them. But it really is about how do we have the best, most superior military for all of our allies and for the United States.
So if that's the case, let me ask you, Brian, let's say, there's a new Secretary of Defense and he comes to you, and he or she actually might come to you, right? And they say, listen, how can we improve the Pentagon? How can we get smarter, more effective, more efficient? You say what to them?
I think there's two big aspects to this. One is that, the Trump administration has focused on, talked about, and I think is correct, is really just streamlining the bureaucracy, right? There's just so many roles, so many things that make it hard to do what we really need to do as a country, to move out, to take risks, to actually just build the military we need to have. I think it can be wildly more efficient. And that's something that I think they can take a lot of leadership on. The second part is recognizing how are we going to build the military of the future? We are in a particularly precarious position. There's these war games that show what a conflict with China would look like. We run out of key munitions in like 8 days. Mm-hmm. Like this is a major problem. Ukraine has showed this. We cannot supply the munitions we need. We are struggling to produce at the volumes we need to. And on top of it, our allies are looking at this and saying, is America going to be there as sort of like the preeminent defense supplier of the world? That's a real question now. That wasn't a question 15, 20 years ago. But now I think it is showing that we have some serious weaknesses in our ability to produce.
So what do we do about that, Brian? What's the answer to that?
Our view is you are not going to get there with the same approach we've been taking, right? We've essentially isolated the military, kind of supply base from the commercial world, and we've created this like weird enclave that doesn't have to compete, doesn't have to be efficient, because it exists in just this one special place. And everything about it, from the regulation, how fast they procure, how fast they update, how hard it is to sell into the Department of Defense, makes it so that we have this amazing commercial apparatus. We are still great at building cars, building all sorts of complex things, right? And we have an amazing supply base within the US. We have to tap into it. We have to tap into all those commercial suppliers. You look back at the Cold War, you had nearly every major corporation in America contributing to defense production. Like, this was a national effort. Since then, it has really whittled down to a very few set of people engaged in this. So our approach to this has been, okay, how do we think about, uncrewed autonomous systems that can be made in a different way, manufactured in a different way, that can tap into this broader supply base? Really, like on the weapons front, how do we really tap into what's actually possible with the things that companies like Tesla have learned of how do you build at scale, build these complex things fast and cheap? Like, that really does work. And so our belief is you can build a new class of systems, of weapons, and you can really make them smarter and more efficient with use of AI, with autonomy, and really tap into what America is great at in the corporate world.
I'm also curious, though, Brendan, how do you think the relationship between the U.S. government and kind of defense tech companies like Anduril can shift, evolve? And I say that because there was this really interesting exchange. Elon Musk responding to Palmer Luckey, founder of Anduril, and Musk saying, very important to open DoD/Intel to entrepreneurial companies like yours, referring to the Department of Defense and intelligence agencies. What is Musk getting at there? Open them up to the Andurils of the world.
So the way that the DoD works is they, you go back to like the McNamara era, like back in the 70s, they put in place this basically like socialist planned economy structure, right? So this was kind of all the rage in like the 60s and 70s, this idea of the science of progress. And they believed they could map out technological progress over a decade, plan for it, stimulate it. And this might have made sense when the DoD was a huge percentage of the national R&D funding that was going into it. But that's no longer the case. But they still have the same system in place that is very much about how do I just plan it out 20 years. So, we were very successful this year. We were awarded this program on this Loyal Wingman, like an autonomous fighter jet program. Incredibly cool, really successful thing. Took us kind of 5 years of working with that office to make progress, to build the trust that we could do it, which I understand. But the reality is, if we hadn't won, there's not really an opportunity to do this again for about 15 years. So why would I invest? Why would an entrepreneur show up and say, I can build something better? This is the same thing that occurs on nearly every ship, on every weapon, anything like that. These are multi-decade long commitments. So there's no opportunity to bring in the best technology. Our view of this is, let's do what literally every free market system has done. Let's just have the DoD be a better buyer. Buy the best tech. Show the entrepreneurs that if you build technology that actually works, that solves a real problem, we'll actually buy it. And you have a chance to actually succeed doing that at scale. So I think it's actually very simple. I think it's moved from this more, planned 30 years, there's no chance to like update new technology, into this model of, hey, let's every 5 years, let's just buy the best stuff. Like, it actually would work really well.
Do you see it actually, is that a shift you could see happening under a Trump-Vance administration?
Absolutely. I think there's a ton of places this would really work. It's probably not going to work for aircraft carriers, and that's okay. But the future is not really going to be defined by a lot of these major legacy programs. You can look at what happened in Ukraine. With basically these cheap autonomous boats, the Ukrainians, having no navy, disabled and caused the entire Black Sea fleet to be irrelevant. Like, they are hiding out at like faraway ports because they are so at risk from these cheap, low-cost capabilities. So the world has shifted. A lot of these like big kind of pinnacles and like these icons of defense, still relevant in certain cases, but it's not the thing that's going to define the future.
So the future of warfare looks more like, Brian, relatively low-cost autonomous systems. It's drones, it's autonomous submarines, and your point being maybe not as much on these kind of relatively high-cost, low-quantity fighter jets, battleships. Is that the idea?
That is our belief on this, which is like in warfare, you look at, the Russians are probably sent what, like 10,000 munitions a year, not including all just the artillery. Like I think I saw a stat that it was something like 8,000 of the Iranian drones that they shot at the Ukrainians in the last 2 years. The volumes on these things are just massive, right? And then you have to defend against that. You have to be prepared for that. Just the sheer mass of what you need to put in battle to be effective at this point is huge. We can't afford to get there by doing it with $100 million airplanes. Like, it is not going to work. Those are still great. They're incredible airplanes. Like, I think we need them. But we have to complement this with just an insane quantity of systems, and it is only going to get there through these autonomous and uncrewed systems. That's the only way.
So if that's the future of warfare, it doesn't sound like you think we're very well positioned for that.
I think that America is incredibly well positioned because you have entrepreneurs like us. You have tons of defense tech startups. They're all hungry to do this. And the reality is these things can be done so much faster than anyone believes is possible, right? Like, you look at what happened with SpaceX. They went from operating no satellites to being the largest satellite operator by a factor of what, like 1,000 in a year, right? Like, these things move incredibly fast. So America has every advantage. We have every entrepreneurial talent. We have the industrial base. We can do this very, very quickly. If the DoD wants to do it, they could move out now. And so this is where I think like there's a mistake that sort of modernizing the military is this 20 or 30-year exercise. It is not, right? Like, this is a thing that can be done in single administration to completely change the game.
Let's talk about the Anduril story a bit too, because not everybody in the audience and probably watching online is familiar with it. Talk about that story, because it's 2017, Palmer Luckey, group of young guys get together. They have a very different view of what a modern defense company can look like. And it's important for the audience to understand, Brian, I was out in Bay Area in 2017. I mean, starting a defense company in 2017 was not a very popular idea in a lot of places.
Yeah. So a group of us got together, and the belief was, you play forward 20, 30 years, the future looks like these systems are more autonomous, more intelligent. There's thousands of sensors on the battlefield. Processing that information is incredibly hard. You just have this huge mass of systems that you got to solve for. So like our kind of belief on this was the existing defense industrial base, look, they're geared for aircraft carriers. They're geared for exquisite airplanes, and they're actually like pretty good at it, right? Like, we're not trying to do that. The reality is we thought there was a different class of things that needed to exist. It was very software focused. It was about cheap mass. It was about quantity, and how do we really enable that to go? And we knew we needed to do this, kind of as a defense prop. We had to solve the whole problem. This wasn't like a single product. This wasn't just selling through the big guys. That was a crazy idea. You were exactly right. I mean, look, we had investors who were like questioning our ethics, that were like giving these sort of like ethics quizzes. It was just really a crazy time. We shockingly didn't get protested that much. I was at Palantir at the time. We were getting protested every day. But it was very, very unpopular. But we just had this belief that this needed to exist, that this was important, and that the U.S. needed to win. I think all of that really shifted over the last several years. And the biggest shift was Ukraine. I think people, prior to that, nobody really thought that this idea of state-on-state conflict was going to happen, right? Like, it just seemed like warmongering, fear-mongering. That's not how the world works anymore. We're kind of post-war. And then they realized that there's still bad actors that will use force to exert their political ends if they can. And so our goal is to make it so that that won't work, right? Like, we want to arm our allies. We want to arm the U.S. in a way that makes it so that wars, you're just not going to win. So don't try it.
So just spitting ahead now, only about 7 years, Brian. You now have, correct me if I'm wrong, I think it's like 3,000 employees roughly?
About 4,000.
About 4,000 now. You're valued at $14 billion. Does the growth you've seen, does it even surprise you, Brian?
It is wildly surprising how fast this has gone. So I was at Palantir for 10 years. It took us years to break in to the DoD, right? Like, it was like 5 years in before it started being taken seriously. And I think it just shows a couple different things. So, one, we learned a lot of mistakes, right? Like, at Palantir, we learned a lot of what not to do, what works, what doesn't.
Like, some of those mistakes would be what? Was it lobbyists, sales team? What was it?
I think the biggest mistakes were believing that you can kind of sell through the incumbents, right? Like that. When you're doing something disruptive, when you're doing something that requires a different way of thinking, a way of operating that doesn't fit the mold, you got to tell your own story. You've got to be your own advocate, and you got to find those people in the government who see that change the same way you do and want to advocate with you. And so, kind of from day one, our belief was we got to be telling our story on the Hill. We got to be explaining that we think this can be better. We think this can be more efficient, and you can get better results for your dollar. that we can make the American military as strong as we need it to be without breaking the bank, right? Like that was a key part of this, and we can do it now. And then you got to find the people in the government and the problems that have that sense of urgency. Areas we've done the best are the problems that people felt like they needed to solve now and not 5 to 10 years from now. That the cost of not changing was worse than the cost of changing, right? And so so we've been able to find those people, to find those problems. We've done well on counter drone technologies. We've done well on base defense, border security, really across the board. We found a set of these problems that people want to move out on now.
Let me ask you, you mentioned the primes, those kind of well-established defense giants. It's the Boeing, Lockheed Martins, Northrop Grumman's. You're focused in different areas, Brian. When I think about those companies too, I mean, they must listen. They're smart people. They're seeing these same big themes and trends we're talking about play out. They've got smart engineers, big R&D budgets. They've got lobbyists. Why can't they kind of do the same thing, Brian? Just kind of like also decide, okay, we're going to kind of pivot here, also create this portfolio of next-gen autonomous systems. Is it a different skill set?
I think a lot of this comes down to business model. So, we operate, we're venture-backed, and so we use our own balance sheet to invest in the technologies we think need to exist. So in a lot of times, we're building ahead of when the government has, a requirement, or they know exactly what they want, or they're ready to fund it. So we're often leading the government years in advance of when they know what exactly they want to have to solve these problems. That is completely at odds with the traditional business model where a lot of the primes are just in a different incentive structure. They're working on contracts that are what's called cost plus fixed fees. So they get reimbursed for all their costs incurred, plus a fixed profit percentage on top. But nowhere in that do they have, but all of that means is government funded, right? So the ability to lean forward to do it in advance is very, very hard. And the reality is they are so big that their growth rates are challenging, right? So they're not growth companies at this point. They have to just optimize on profit. So the ability for their, to go to their investor base and say, I'm going to pivot to this other model where we're going to lean in hard on R&D well in advance of the government, make these risky bets, eat into profit on the belief that on the other side we're going to win, we're going to grow, and we're going to succeed on this. That's a hard pivot for them to make, right? Like their investors won't support it. And so I think it's like just an incredibly different set of incentives we have. We're growing really fast. We're growing like 100% a year. Like that's a very different world where we believe that everything we invest in, that's going to lead to future success, and we can keep solving these problems.
Let me also ask you about the mega trend of AI. I'm curious, how at Anduril do you think about infusing that technology into defense tech? What does it achieve? What does it scale? What does it do?
Yeah. So look, we've been kind of involved in each wave of the AI pieces and figuring out the best ways to apply it to defense. Early on when we started computer vision, right? So how do I really start to get these things deployed onto every product we have? Like I recently did just like an inventory of like, we got a couple dozen products, and I was like, which ones don't have an NVIDIA GPU on it? It was actually literally zero. Like all of them have NVIDIA GPUs, every single thing we do. So every single product we have has been infused with this idea of, how can we apply these AI models to just kind of transform this? So we kind of started out there, we're doing machine learning against like, radio signals. How do I really quickly classify everything I'm seeing? And then with this wave of, kind of the Gen AI stuff and all the LLMs, I think there is huge applicability, right? So the ability to comprehend vast amounts of information, to interpret that, to synthesize it, to interact with it in a much more human way, that is going to have massive benefits in the long run. Just the volume of information that the DoD has and being able to just supercharge every human to be able to access that information, that is going to be a massive unlock. So we're actively working with nearly all of the AI labs and trying to figure out, how best can we pull them in to US government work? How can we adapt what they're doing to national security problems? And then probably just as importantly, how do we get the DoD to understand the potential impact and scale of this? And that's actually the hardest challenge, to be honest, which is, again, it's based on this idea that, you kind of start these seedling things out, but you controlled it all the way through this tech progress. A totally exogenous shock, like what has happened, like, I remember using ChatGPT. It was like, dude, this is alien technology. It just felt like nothing anyone had ever seen. We've normalized it already, right? We're like, oh yeah, chatbots, that's easy. Right. But like that felt like alien tech. That exogenous shock to the DoD and how do they deal with that? Man, that is not an easy thing to get a 3 million person bureaucracy around. And how do you start to absorb that? What does that imply for how you change your operations, the way you work? the way you think about this. So that is going to be the journey. It is, I think, going to be much more impactful, much more broad spectrum than they can possibly imagine right now.
And the question I have, maybe this is less business, more ethical, but how critical is it to keep a human being in the loop as you deploy AI in the war zone?
So this is where the U.S. has to take leadership, right? And I think the U.S. has to be the first adopter, and they have to be the best adopter of this, because we have to set the norms, we have to set the expectations, because the reality is the U.S. wants a position of human accountability, right? And I think that is good. We do not want, computers making life and death decisions. But the reality is it's a much more like kind of complex and gray area. So the way we approach this is we really try to break down what is that point of accountability we really want the humans to have? How can we really use AI to get rid of those mechanical, repetitive aspects, where humans get fatigued, they make mistakes, they're actually not as optimal in that case. But what we want them to do is use of force, right? Like, when is this justified? When does this make sense? When have we satisfied the rules of engagement? And the military has always had a very good system around this, right? Like, a commander is responsible for what happens when they fire a weapon. Right? Like, at the end of it, doesn't matter if the weapon is, they are responsible for what happens when they fired a weapon. So we have torpedoes today. We have anti-radiation missiles that, you say, hey, in this box, if there's a thing that matches this signature, that's a legitimate military target, right? We've had those since the 70s. So the DoD actually has a framework around a lot of it. It's just then figuring out how this then best applies and how you can lever those humans to make those informed decisions and actually be more accountable, because they have better information, because they can be more precise. And that's where I think the opportunity is. But the US has to set the norms on this. Like, China and Russia are not going to do this. Russia is down for, anything that moves behind the front lines.
Are they, I meant to ask about that. Well, I guess two questions. One is the DoD, Brian, do they already set guidelines for you all about, hey, this is how you can infuse AI into the systems? Are those guidelines already in place?
I would say the reality is, with a lot of these things, they've had guidelines for similar things for a very long time. Now it's just added the word AI to it, right? And it's like, I think fundamentally, the nature of warfare and accountability that we want to have in our system, that's a pretty well understood problem in a lot of cases. And they've done things on policy, different, kind of executive orders or directives on how to think about use of AI in military systems. But what it fundamentally boils down to is what I said, right? Which is we want to know these systems are predictable. We want to make sure the humans are still accountable. And we want to ensure that commanders can still know what's going to happen.
You mentioned Russia. I mean, I would assume, of course, China, Russia, Iran, are they all also already infusing AI into their weapon systems?
Absolutely. I mean, you're seeing this in Ukraine. The Russians have been experimenting with these lethal drones that they can send behind kind of Ukrainian lines, and then anything that matches a certain computer vision signature, they'll attack it. Right? Like, that has been a thing that they have deployed. And so these things are already starting to move out, pretty effectively. And then
Who does it better, Brian? Is it U.S. or adversaries?
Look, the U.S. has a massive advantage because we have the best researchers, the best commercial sector, but we have a disadvantage compared to China, and I actually think this is a good thing, where we don't demand civil-military fusion. China demands that any technology in the civilian space will be applied to the military space. That is not a thing we do in the US. I actually think it's a good thing. People should have a choice of whether they work on military problems or not. But so I think the US still has the best tech. We still have the biggest advantage. We just have to be able to capitalize on it. And the DoD's role in that is just be the best buyer, just be the best adopter. They're not going to invent the best AI tech, and that's okay. But they have the best companies in the world working on this who want to work with the US military. And that is a good thing. We can lean into it.
Final question, IPO, could that be a 2025 event for Anduril?
Look, we're committed to an IPO at some point. We want to go public. But we're going to do it exactly when the timing is right. And we're getting prepared to do it, but we'll choose whenever we want to go out.
All right, Brian, thank you so much for your time today. That was great.
Awesome. Thank you.
Thank you.
Brian and Josh, and of course, if Anduril does go public, it will be at least the second company to be listed that is named after something in Lord of the Rings. You guys can quiz me later on what exactly Anduril is named after, or you can Google it. We've been talking a lot about disruption through startups in different industries, just heard about how it's changing the face of defense. Now we're going to talk about brain chemistry. And for that, we're joined by the CEO and co-founder of Precision Neuroscience, Michael Mager, and Yahoo Finance senior reporter Yasmin Khorram. Please welcome them to the stage.
Michael, thank you so much for joining us. So tell us about your company, Controlling Technology with Your Mind. It sounds like science fiction.
So I'm the CEO and co-founder of Precision Neuroscience. We are developing what's called a brain-computer interface. A brain-computer interface is a medical implant that allows people to control computers using only their thoughts. Sounds like science fiction, but actually it's been validated in academic work for 20 years. So the first person was implanted with a brain-computer interface in 2004. And since then, there have been nearly 70 people implanted with various forms of sort of academic type prototype devices. But they've been able to do amazing things. They've been able to send emails, create digital art, play video games, all using only their thought. But so far it's really been confined to academic settings and, as I mentioned, sort of prototype type devices. We are part of a small group of companies that is taking the science that we know works, productizing it, and taking it through the regulatory process so that it has the potential to reach the many millions of people who stand to benefit. The company that I co-founded, I did so with Ben Rappaport. Ben was one of the co-founders of Neuralink. He's also an active neurosurgeon. We co-founded the company almost 4 years ago. And in that period, we've designed and now manufactured a cutting-edge new system. We've validated it. We've tested it in 25 human patients across 3 medical sites in the United States. So we're working at Mount Sinai here in New York, Penn Medicine in Philadelphia, and West Virginia University. We've been granted breakthrough device by the FDA, and we've raised over $140 million from some terrific investors.
And talk about who this is for. I know Precision right now is focused on the medical aspect of it.
Yeah, so our initial focus is on people who have severe paralysis. So this is people who can't use their arms and hands, in some cases can't speak. And this is as a result of generally sort of spinal cord injury, diseases like ALS, and certain kinds of stroke that leave the cortex intact but disrupt the connection between the cortex and the rest of the body. There are about 400,000 people in the United States alone who sort of fit that description, and about 30,000 or so new patients every year. How does controlling a computer with your thoughts help those people? It may sound a little bit unintuitive, so maybe I could give a real-world example.
Sure.
So 2 people on our patient advisory board are Jules and Maria. Jules was diagnosed with ALS 4 years ago. ALS is a very cruel disease. It basically, people who have ALS, their brains remain totally cogent, but the brain's ability to control the muscles in the body deteriorates over time, initially with sort of the limbs and leading to all of the musculature. It's 90% non-hereditary, so really ALS could happen to anybody. And Jules, now 4 years on, has a tracheotomy, so he's unable to communicate at all. The only way that he can't communicate verbally. The only way he can is through what's called eye gaze technology. So he stares at letters on a computer screen and hovers over them and at select letters, but it's incredibly slow and frustrating. So he basically can communicate a few words per minute. It would be like having all of your communication through an Apple TV remote, unbelievably frustrating. And as a result, he sort of self-censors. It's awkward to have people wait around for minutes to extract a sentence, so he just curtails his own thoughts. We asked Jules, why in the remaining time that you have, would you dedicate it to us and helping inform our product? And basically, he listed 2 things. The first is, Jules and Maria have a 7-year-old son, and he would like to be able to speak at a normal conversational rate with his son in the time that he has left. And the second thing is, he'd like to be able to have fun, play video games, and do other recreational activities with his son. So, controlling the computer with your thoughts, it sounds maybe a little bit abstract or perhaps even trivial, but I think for a certain group of people, it has the potential to be totally transformative.
And let's talk about that technology that could potentially help people like Jules. I know you brought a chip with you. It's thinner than a piece of human hair, so you guys might have a little trouble seeing it, but
here it is.
Tell us what goes into this.
So you can see here, it's incredibly, incredibly thin. It's a fifth of the width of a human hair. And on this, it's basically, it's thinner than a piece of Scotch tape. Here, you can hold it if you want. And we deposit 1,024 microplatinum electrodes on the array, most of which are about 50 microns in diameter. So that is the size of an individual neuron. You can't see it with the naked eye. The way that we manufacture these chips is borrowing manufacturing techniques from the semiconductor industry. So we use photolithography in order to make these chips, and that's actually that's never been done before. Borrowing manufacturing techniques from semiconductors for a biomedical application. So we've had to acquire our own fab in Texas. We have a 22,000 square foot facility with a level 5 clean room in which we make these devices. The way it works, I'd say, to try to simplify it, is you can think about that electrode array like a very high resolution camera that is taking video in sort of 4K of the awake human brain and using the brain signals that it's picking up to correlate to an intended action. So for example, a certain group of neurons fires in a certain pattern when I want to move my right index finger. A different group of neurons fires in a different pattern when I want to move my left hand. And that's basically the building block of a brain-computer interface.
Interesting. And your approach is different than, say, Neuralink, which you mentioned, Ben, your co-founded alongside Elon Musk. Talk about the different approaches between Precision and Neuralink.
I mean, I think it starts, we have fundamentally different missions. If you look at Neuralink's website or speak to the co-founders of the company, I think their stated objective is to create some sort of symbiosis between human intelligence and artificial intelligence. That's a fine goal and maybe a very important one, but it's not our goal. I mentioned earlier that Ben is a neurosurgeon, so we are a physician-led company. Really built into our DNA is a focus on safety and patient impact. The goal of this company is to make a really meaningful, positive difference in people's lives. When Ben left Neuralink and we started talking about starting this company, he was convinced that a brain-computer interface needed to have 3 attributes for it to ultimately achieve the sort of widespread adoption that is our objective. First, it should be safe and non-damaging to neural tissue. So some competing approaches to this technology, including Neuralink's, involve doing some amount of tissue damage upon implantation. And Ben's view has always been, that's ultimately going to be an impediment to widespread adoption. So the precision system sits on the surface of the brain, underneath the skull and underneath the dura, but on the surface of the brain without doing any damage. The second thing is reversibility. So, should people want to have the device explanted for whatever reason, should they want an upgraded system over time, the system should be reversible also in a safe manner. And finally, it should be high bandwidth. So you can think about a brain-computer interface as a communication device. And just as any communication link, bandwidth really matters in terms of what you can achieve, what the function of the device is. And so, our system is architected to be very, very high bandwidth. All that said, I think this is an industry that is going to be very large, and there's room for multiple approaches. We don't think this is a winner-take-all market. So I think there's room for more than one approach to this.
And as you mentioned, you guys are minimally invasive, less damage to brain tissue, less chance of an infection. Why aren't more companies taking this approach, or are you guys losing out on something by not inserting into the brain?
I think I'd say 2 things. I'd say, first of all, the implantation that we've patented at Precision involves a very minimally invasive slit in the skull that allows the array to slide through like a letter through a letterbox without doing sort of a craniotomy, which is what most of the competing approaches require, removing a large piece of skull. And I think that having a co-founder as a neurosurgeon who thinks about the actual mechanics of how do you get devices into the brain in a safe and scalable way, I think it's a huge competitive advantage. I think, in terms of the underlying sort of technology and the fact that our system is non-damaging, when Precision was started, I think that there was a commonly held view that you actually had to penetrate into the brain in order to drive a powerful sort of brain-computer interface function. I think our work and actually some of the work that's come out of academia in the past several years has really proven that that's not the case.
And we're going to have some video that shows the precision chip tracking a human brain. Can you explain what we're seeing? I understand it's going to be a patient saying 1, 2, 3.
Okay.
Right there.
Yeah, so I mentioned earlier that we've done 25 human implants. Our most recent was just on Friday, so this is happening actively. And at different sites, we're able to do different protocols, which are really validating the safety of the system, that we can implant and explant it safely, and the fact that it's working, as well as training the algorithms to be able to do the decoding work that is at the core of a brain-computer interface. Here, this is a speech protocol. So someone who is implanted with our system is saying a series of words. And we are recording from the part of the brain that controls the motor cortex associated with the mouth and the tongue. And so we can see, we can hear what they're saying, obviously, but without hearing what they're saying, we can see what muscles are being activated in what pattern, and we can use that to predict what words the person is saying or thinking about saying.
And what about the dangers? The brain is already such a sensitive part of our body. On top of that, you're introducing a computer, which aren't perfect machines. What if it malfunctions? Can it be hacked? Are there privacy issues?
All super important questions. I think from a sort of, what is more sensitive to us than our own neural data? The data security and data privacy questions are really built into the regulatory regime that the FDA enforces. This is a highly, highly regulated industry for good reason. And it's not the case where companies are able to move fast and break things. So the FDA is very prescriptive in terms of the data security and data privacy issues, as well as the fact that we operate within the HIPAA regime. But I think there are issues that are kind of specific to brain-computer interfaces. And one of the ways that the industry is tackling that is through something called a collaborative community, which is something the FDA helps convene, which really is intended to bring together a lot of different stakeholders in an industry that is in the process of sort of emerging, such as this one. So, it's industry. So Precision is one of the 5 founding charter members of the collaborative community, but it's physicians, it's patients and patient advocates, it's the payers, so public payers like Medicare and Medicaid, as well as private insurance companies, but it's also academics and ethicists. And one of the focuses of the collaborative community is outlining sort of the ethical landscape in coming years. And I think we're really lucky to have some of the world-leading academics and bioethicists and neuroethicists associated with that project. What I'd say just on the question of ethics, just to sort of keep in mind, my perspective at least, is that we're trying to deliver a patient benefit to people right now who have nothing available to them. And I think the ethics of doing that for the time being are pretty straightforward.
And I've heard you mention this Morgan Stanley report that says the BCI industry is a potential $400 billion market, estimated about 5 years away. That's allowing for procedures outside of the medical world. Talk about that potential customer. Why would somebody like me or you or someone in this audience want to get this surgery on the skull?
So I think that there is growing recognition that this is going to create a large industry. I imagine that's why I was invited here, and that's also why Morgan Stanley, I think, wrote that report, despite the fact that there are no listed companies in the space yet. The way we see this industry developing is initially for people with very severe paralysis. So I mentioned people who can't use their arms and hands at all, and in some cases who can't speak. And that's about 400,000 people in the United States and about 30,000 patients every year. We think that creates a $2.5 to $3 billion initial market in the next few years. From there are a lot more people. There are about 5 million people in the United States who have some form of motor deficit. So maybe they can use one of their hands but not the other, or maybe they have very severe arthritis that prevents them from being able to operate a computer or a smartphone or a tablet in the way that most people can. As this technology becomes more and more commonplace, as the idea of people controlling computers with their thoughts becomes sort of less fantastical and something that people just see more commonly, I think there will be some adopters from that 5 million pool of people who will decide that they want this technology. And I think, beyond paralysis, there are hundreds of millions of people globally who suffer from neurological illnesses that right now either have poor pharmaceutical therapies available or none. We can't say with the same level of confidence that we will be able to address other neurological illnesses. We know that paralysis is tractable because there's been 20 years of academic work that prove it so. But we are creating, in effect, a high bandwidth link between artificial intelligence and human intelligence. We think it's very likely that there will be applications for that go beyond paralysis. And we're excited to work on them in coming years.
And on the AI side of it, it's not perfect yet. There's a lot of inaccuracies. How does that impact the BCI sector?
Yeah, just going back to this idea, so it's been 20 years in academia. Why are we talking about it now? Why is it becoming an industry now? I think it's common for new technologies, first of all, to gestate in academia for a while, and also they really need to wait for prime time until some of the enabling technologies that are critical to its sort of commercial rollout, to their being ready. And I think that's absolutely the case here. So you think about material science, for example, of the array itself, being able to manufacture something that's biocompatible, that's high resolution, that's going to last in the body for a long time. Same thing with the electronics, being able to miniaturize really powerful electronics to process the signals that are coming off the array, to digitize them, and to do so in sort of a low power environment. That's also, I think, innovation that's really happened over the course of the past several years. But AI is absolutely, a great example of a technology that needed to be developed for this to become an industry. Just to try to quantify it. So our system is designed to have 2 of these arrays on the brain at the same time. So that's 2,048 electrodes or sensors in total. And we are sampling from the brain, or we're measuring the brain's activity several thousand times per second. So that's 2,048 sensors, each of which is measuring brain activity several thousand times a second. That translates to billions of data points per patient per minute. So that's way more data than any human being could possibly compute. So AI is absolutely critical in really decoding that neural activity and making sense of it.
And what about the regulatory roadmap? You guys just filed for FDA approval. What are the challenges and where are you in that process?
This is a global industry. And there are a few promising companies in Europe. China has explicitly made brain-computer interfaces a focus. It's listed as a technological priority on the most recent 5-year plan. Still, in spite of that, 80 to 90% of the innovation and the capital that's being raised is in the United States, which is great. Why is that? I think there are a few different reasons, but one of them really is regulatory, where the FDA is by far the most sophisticated in terms of sort of the global regulatory regime in advancing this technology. The person who leads the neuro division of CDRH, which is the part of the FDA that regulates devices, is himself a former brain-computer interface researcher. Many of his colleagues are as well. And the FDA has been really proactive in helping to define the regulatory landscape for us and for companies like us, including issuing draft guidance as much as 5 years ago. So I think the FDA in this case is a real asset for the United States. I think we need, any new technology like this needs a very clear regulatory roadmap that is spelled out by people who really understand the technology itself. And I think it's really lucky that we have that in the United States. As you said, we have submitted our first FDA application in August. We are hoping for our first clearance in early 2025, which is really exciting. It will be for a temporary version of the system, one that has to be used in the hospital and for up to 30 days. I think this is an important milestone for us and for the industry. We will be able to start selling a device, so generating some revenue, which will be great. We'll also, be developing a reputation and a relationship with all of the stakeholders that are going to be important for the rollout of the long-term implant. So the clinicians and the nursing staff and the hospital administrators, like all of the stakeholders that it takes time, will be establishing a reputation among them. And it also means just an explosion of the neural data that ultimately goes to training our algorithms and making them more powerful. So we see this as a really important step towards clinical impact, which, as I said, is sort of the whole reason that precision exists.
And next year we'll bring a new political environment with RFK Jr. Likely he's going to oversee a big role in healthcare. Elon Musk, your direct competitor, has the president's ear. Do you see that as a good thing for the BCI industry, or are you worried about a little favoritism?
I think like everybody else, we're waiting to see what happens. I certainly don't have a crystal ball. I don't think it's a bad thing. I think it's to have someone who really understands the technology, its importance, its potential to do something really good for people who right now have no therapy at a senior level in government. I think that's no bad thing. All that said, we as an industry don't need any special favors or treatment. The data will speak for itself. The patient benefit will speak for itself. I think that said, there are areas of, I think, potential improvement, not just for brain-computer interfaces or companies like mine, but for medical device companies more generally. So I'll give you a quick example. Right now, there is on average a several-year gap between an FDA approval and when CMS, which is Medicare and Medicaid, decides to cover a novel device. That's totally different from how it works in pharma. Pharma generally gets reimbursement right after approval. And just from like a first principle standpoint, no one would design a system like that. No one would design a system where you get FDA approval and then it's several more years of work and validation before insurance companies can cover a device. And private insurance generally for devices take their cues from CMS. This ultimately means it's more difficult for medical device companies to raise capital and develop devices. You have to go through the whole regulatory journey and then continue to fund the company for several more years while you go through the reimbursement path. And it ultimately means that patients who stand to benefit from this technology don't get it in a timely basis. So it's not a system that makes a whole lot of sense. The Trump administration actually late in their term passed a rule that said that any device that has been given breakthrough status with the FDA would automatically get reimbursement for a fixed amount of time. But the rule was never totally funded or implemented and was later reversed. I think something like that would be enormously helpful in just providing clarity to the medical device industry and ultimately would speed access to important technology to patients.
And before we go, I have to ask, Bloomberg has a report out that you raised $93 million last week at a valuation of $500 million. Can you confirm that today?
I am constrained in what I can say. I can confirm that article was based on a regulatory filing, which is accurate. I can say that, to my knowledge, it's the largest capital raise of a brain-computer interface company of its kind, other than what Neuralink has reported. And I will have more to say on this in a few weeks, but beyond that, I can't say. Sorry.
And is an IPO in your future? How important do you think that is to Precision's growth?
There are different ways of developing a medical device company. I think the most common way is to try to prove the efficacy and safety of a device and then sell it to a company that has a massive distribution platform like Boston Scientific or Medtronic. We view brain-computer interfaces as a generationally important life sciences innovation, and one that really is, people say platform technology, but we think that this is going to have applicability today in paralysis, tomorrow in a number of different areas. We tried to build this company from the very beginning to go the distance. Who knows if we get there, but that's what we're working towards.
Thank you so much. Michael Mager, Precision Neuroscience.
Thanks, Dr.
Thank you so much. Now, you probably noticed that one of the big threads, obviously, running through our discussions today has been the uncertainty surrounding the new administration. What is it going to mean for a host of different industries? And of course, one of those that could be most acutely affected, or at least that there's been a lot of discussion about, has been the green transition, right? And that's the subject of our next discussion. Join me in welcoming Tom Steyer to the stage, co-executive chair of Galvanized Climate Solutions, along with Yahoo Finance anchor and reporter Madison Mills.
Thank you so much for being here. The last time I talked to you, you were running for president, actually. So great to meet you in person again.
Madison, nice to see you.
So obviously, heels of this election, the market saw best post-election rally ever. I know that you care a lot about the climate. You call yourself a climate investor, not a climate activist, but you are an investor. Do you think that investors are really that better off now than they were 4 years ago?
Than 4 years ago, because 4 years ago we were right in the middle of COVID and the world was a very different place. Do I think that we're better off as a society than we were at the start of COVID? Yes. Mm-hmm. Do I think that there's no such thing as a normal time in investing? Markets fluctuate all the time and sometimes they fluctuate wildly. Mm-hmm. And I think as an investor, a big part of the job is to look through the noise and try and see what's going on in the real world and not necessarily listen to all the hype that the media is putting out.
So what's the noise right now versus real world?
Well, I think in terms of clean energy, what we're seeing is very dramatic growth around the world of clean energy. Just to give you some quick statistics, I think over the last 4 years, solar has multiplied 4x. I think that EVs in the last 4 years have multiplied 5x. I think the cost of batteries in China went down 50% last year. I think solar around the world costs have gone down 60% over the last 4 years. We're seeing a transition happening around the world really fast. Last year, new electricity generation, 2023, 86% renewable. So whatever you read in the media, what is happening is a dramatic transition in the way we generate and use electricity.
So I want to get your perspective on what's going to happen next here, because the U.S. is already at peak production, and we just elected Mr. Drill, Baby Drill. Where does that leave energy?
So, drill, baby drill, let's talk for a second about oil. Oil production in the world is something like 102 million barrels a day. The United States produces about 13.5 million barrels a day. We're the biggest oil producer in the world. We're the biggest oil producer in history. we're talking about going from 13.5 million barrels a day to 14 million barrels a day. In the context of the world, in the context of our economy, that is not anything dramatic. So when we don't have a shortage of oil and gas in the world. In fact, we have a glut of oil and gas in the world. We are not going to get rid of oil and gas because we run out of oil and gas. We're in the middle of a transition to much cheaper energy sources. And that is something where the energy sources dependent on technology are getting cheaper, they have gotten cheaper, and they will continue to get cheaper. And so the differential in terms of cost is just going to widen. Let me say one last thing. I wrote a book that came out about 5 or 6 months ago that said, cheaper, better, faster, how we win the climate war. The truth is people are going to be self-interested when they buy things. They're going to be self-interested when they purchase energy. They're going to be self-interested when they buy cars and heat pumps. And basically, we're in a business of competition between different sources. And you can see that some of those sources are growing really, really fast.
Part of the thesis of cheaper, better, faster is this idea of free markets. Let the market do what it's going to do. If you make cheap, better, faster products, consumers will flock to it, right? Sounds like a great capitalist, Tom. But how does that work then under changing regulatory backdrops? Does it matter who's the president under that thesis?
Well, I think to a very large extent, it doesn't matter. And let me give you an example of this. I think if there's a state in the country whose legislators have been antagonistic to renewables, it's Texas. Texas has been the center of the oil and gas business in the United States, maybe in the world, for a really long time, and they're very proud of it, and they feel as if that's an important part of their identity and their economy. Over the last 3 or 4 years, Texas has tripled their amount of solar. It's supposed to go up another 35% this year. Texas is by far the biggest wind energy producer in the United States. The top 4 states with wind energy are all deep red states. Why are they doing that? Because of the money, because it's a good deal. And so they can talk about whatever they want to talk about, but the fact of the matter is they're not having brownouts and blackouts during their extreme weather events. And why is that? Solar and wind. So when we look around the world and you see 86% of new electricity generation in the world is renewable, is that because people in Vietnam are saying, we should spend more on energy so people in Florida aren't flooded out? No, they're saying it's cheaper. This is a good deal for us. Let's do what everyone is self-interested in this. So when we look around the world, this is business. This is economics. Nobody gets to, gets away from the rules of markets and prices. And that's what we're seeing in this world. And when you look forward, the question you have to ask is, does the new technology win over time? And you can look back hundreds of years and the new technology works over time. We're not sitting here going like, I have a big store of whale blubber and I can sell it to you cheap. No one's in the market for whale blubber.
Disappointing for investors out there listening, Tom. So I guess I wonder then, thinking from a global perspective, if you're worried at all that a Trump presidency could put the U.S. behind on climate tech moving forward, and Trump doesn't like when other countries beat the U.S., so what will that do to legislation moving forward?
Well, the United States has traditionally been a business and economic leader. We've been innovators, we've been in the front of technologies. That's been true, and that is true. And so when we look forward, the country that is focused on the energy transition by far the most is China.
Right.
And so when we think about who we're in competition with from an economic basis, from a world leadership basis, from a finance basis, the country that we're in competition with is China. And so for us to miss this transition and not go all in on it seems to me to be a huge miss, because there is gigantic opportunity here. And there is gigantic opportunity for Americans. And some of these things we're not going to be leaders in, but an awful lot of them we definitely can be leaders in. And I think it's really important as we move to a time of what I think of as energy abundance. A lot of cheap energy around the world from various sources. Are we going to be able to drive that, profit from it, and use it to both build our economy and to remain what we are, which is the leading country in the world.
Well, investors are really bullish on nuclear energy as an additional energy source. How are you thinking about nuclear? We know Vistria beat out NVIDIA as the best performing company in the S&P so far this year, a huge superlative. What are you thinking? Are you investing?
So I think when you look at nuclear, let's just take a step back. There are two different kinds of nuclear energy that people are talking about in terms of the nuclear renaissance. One is the old-fashioned kind of nuke, which is fission. And people are talking about fission has three problems: cost, toxicity. The nuclear waste traditionally has been toxic for 100,000 years and really dangerous, and disasters. And people are building small modular nuclear reactors as a way to get away from toxicity, to get away from disasters, and to hopefully bring down costs. Let's see if they can do it. It's, since 3 Mile Island, when people have tried to build new fission nuclear plants in the United States, they've gone way over budget. They've produced very expensive energy. But if it does work, that is cheap, no CO2 emissions energy that is baseload. So that's something people really want. The second kind of new nuclear that people are looking at is fusion, which is basically recreating the sun on the planet Earth. In order to do it, people think you have to get the reactor to 100 million degrees. Not easy. I invested in this personally in 2006. I believe that if it in fact happens, this is something that will be transformational. It is a very hard science and engineering task. There are about 72 companies trying to do it. 12 of them people take quite seriously, 5 or 6 they take very seriously. Let's see what happens. There's a lot of optimism in that industry that in fact over the next decade we'll see the commercial sale of fusion nuclear power. If that's true at a respectable price, that's a game changer. But as in all technologies, there's a lot, there's many a slip twixt the cup and the lip.
So where are you putting your money in nuclear, if at all?
No, we feel as if in looking at the energy transition, there's no question this is happening globally. I don't mean to be rude, but this is happening and it's going to continue to happen, and this is a huge trend. And we think that that's a huge tailwind to investing. But as an investor, you also have to ask yourself, over what time are you investing? What are the risks you want to take? What is a good investment? Just being part of the energy transition doesn't necessarily mean that it's a good investment. And so what we've said is we want to be invested in things that will have an impact this decade, which honestly, I think you'd have to be awfully aggressive to think that fusion will. We've looked seriously at fission, but as these things happen, we're going to react to the pricing and the opportunities and the risks.
Do you like the 3 Mile Island deal, Microsoft and Constellation?
I really don't know enough about it. What I think it says is this: AI is going to demand, and data centers are going to demand, significant increases in electricity generation. People want it to be base load because you need absolute certainty that your plant is up and running 24/7, 365. Nuclear, as I said, is a no emissions type of generation. And so if you look at the big, people trying to win in AI, excel in AI, build huge data centers, they also are serious, and Microsoft is definitely really serious about their responsibilities in terms of emissions and climate. So they're willing to go and try something that's difficult to do and maybe controversial to do, and unclear exactly how expensive it's going to be in order to meet what they see as their obligations as a responsible corporate citizen, and also their absolute determination to be competitive and do the best job.
You teed up my chart perfectly, Tom, because Torsten Slot crunched the numbers on this over at Apollo, our parent company, and he said that we're going to need an additional 18 gigawatts of power by 2030 in order to meet the demands that have been, the energy demands that AI requires here. If nuclear, it doesn't sound like you think that's a great solution, then what is the solution to the AI demand for energy?
Well, I think when you look at the growth in clean energy that is baseload, let's talk about it. So wind and solar are by far the cheapest sources of electricity in the United States and around the world. That's why they're 86% last year of new electricity generation was wind and solar, because it's by far the cheapest and getting cheaper. The issue is about base load. That is it something you can call on all the time? Obviously, sometimes the wind doesn't blow. Sometimes the sun doesn't shine. And the batteries that we have right now don't have very long duration. So in fact, people don't feel that that combination really provides 24/7, 365. So when you look at the base load, what's traditionally been base load in the United States has been probably coal, natural gas, hydro, and a little bit of geothermal, which is digging it down into the world for hot water and steam. So as we look forward, what are the things that people are looking forward to as baseload? And nuclear, excuse me. Mm-hmm. So people talk about nuclear, they're also talking about a much more advanced and possibly large part of geothermal. Basically, instead of going down 500 feet to get hot water and steam, which has no emissions, going down 5,000 feet, where there's a lot more, where the drilling techniques are really taken from oil and gas, and you can get baseload, clean electricity. The question is, how much of that is there? That's a real change. So we've got a couple new kinds of nuclear, we've got geothermal, we've got people trying to redo the old nuclear plants, to resuscitate the old nuclear plants. And then we've got people who are saying, let's use natural gas, which is available, we know it works, we know it's a baseload fuel, and let's then figure out how to offset that. That's where we're going.
That sounds to me like we're not actually getting better for the climate, though. If we keep using energy the same way we always have and then put a nuclear Band-Aid on top.
I don't think that's true. I think what we're going for, when I look at this, I think we're going to a place of abundant, cheap, renewable energy. And the question is, how fast do we get there? I think deeper geothermal, so-called enhanced geothermal, is a big deal. I hope that some of these nuclear things will turn out to be relatively inexpensive. I also believe we're going to have a couple of revolutions in batteries in the next 10 years, that we're going to see not just the prices have gone down incredibly substantially, and they'll go down a heck of a lot more. It's not about cost. It's really about duration. That as batteries become much longer duration, in fact, they get you to that 24/7, 365. And so I think we're going to have a couple of revolutions in battery duration over the next decade that are going to take us really from hours to days and weeks. And I think at that point, you're talking about a completely different question. People are focused on this. I think we're looking very much in the short time frame, but really, I think this is something where the world is focused on it. People are doing a lot of experiments. People are spending a lot of money. And I believe the cost of generating electricity is going to go down a lot.
So for investors who have that long time horizon and who really care about the climate, what would you advise them? Where should they be putting the money where their mouth is?
So the energy transition, the response on climate, really goes through virtually every kind of investment strategy. So I believe that there is an investment strategy around real estate where you can get better returns by reacting to this problem, that it's not about being nice, it's not about making concessions, it's about being smart and getting better returns. I believe that that's true in credit. When I sit here and think about new companies, the question is, what are the companies that over a long period of time are going to generate real compounding good returns? And those are not always the companies that people talk about in the headlines. I think there's a real sense around climate. People think that the breakthroughs in the technologies are going to be gadgets. So it's going to be solar panels, wind turbines, heat pumps, electric vehicles, batteries, things you can touch, because to a large extent, things you can touch are what's causing the emissions. I think there's going to be a whole other part of this economy absolutely relevant to climate, where returns are going to be really good. Information, agriculture, sequestration. You know, everybody's focused on very specific parts of this, and of course I think that's terrific. But from an investment standpoint, you have to ask yourself, where are the good investment returns? You really can't bring just what is an impact attitude to this. The real question you have to ask is, this is business. I mean, I've been a professional investor for decades. If you want to get a good return, you've got to have domain expertise, really understanding what's going on in the ecosystem in the world. But also you have to be an old-fashioned, disciplined investor about getting returns and understanding what drives that and not getting carried away. And so when I look at this, I think there are lots of real opportunities, but they aren't necessarily the thing that's on the front page of the New York Times.
So it sounds like Tesla is not a bull case then, under that investment thesis.
Well, I think that Tesla has just had a huge screaming run. So I was looking at it this morning. I think it was trading at 93 times earnings.
Yeah.
And most people don't think that's that cheap.
Well, yeah, it's not. It's 93 times earnings. Okay, so no on Tesla. I do, on the topic of Tesla, though, in our final minute together, I want to get your thoughts on Elon Musk and a Trump administration. Do you anticipate Elon maybe moving Trump on climate?
I really don't know. I really don't know. And I think that to a very large extent, what is going to drive climate is markets and prices and, cheaper, faster, better. I think the question for the United States that I do think is really interesting to me is how are we going to participate as a country? Not how are we going to, the rules within the United States of America, which I think are going to be driven largely by just normal business, markets, prices. To me, the question is, how do we participate in the world? Because this is a global problem. The United States is the so-called indispensable country. If we want to see international standards, international cooperation, it's very hard to see it without us. And if it does happen without us, and the markets are going to move with or without us. But if we want to see global cooperation, if we're not leading it, that means China's leading it. If we're not pushing on this from an economic and business standpoint, that means China's pushing on it from an economic and business standpoint. So from my standpoint, the real question is America going to be a leader in the world, or are we basically going to withdraw and say we're going to just look after ourselves and not participate with other people? In my mind, from the standpoint, as an American, I would like to see us continue to be a world leader, both from a business standpoint, an economic standpoint, and also a value standpoint.
Tom Steyer, thank you so much. Really appreciate your time.
Madison, thank you.
It was a great conversation to cap off the morning's festivities. We here in person are going to take a break for lunch. Those of you who are watching online, our Shauna Smith and Jared Blicker are going to take you through the next half hour of your trading day. Stay with us.
Welcome into our live coverage here from Yahoo Finance Invest Conference. I am Shauna Smith alongside Jared Blicker. And Jared, we just heard from a great lineup of names. Deena Shakir, general partner at Lux Capital. Also Brian Schimpf, Anduril Industries, co-founder and CEO Michael Mager. He's Precision Neuroscience, co-founder and CEO. And just wrapping up on stage behind us here, right to our right, was Madison Mills. And she was speaking with Tom Steyer, the co-executive chair of Galvanize Climate Solutions. And you and I, after the first several speakers, we were talking about this tone of optimism.
Yes. What
and
of the
I
day?
would say that the last couple of speakers, it was more of a realist conversation, just in terms of some of the struggles and some of the challenges that are ahead here, not only for the economy, but you talk more broadly just about from an investment landscape, how that is being factored in. And then I thought Tom Steyer, in his last comments there to Madison, just talking about the fact that he thinks it is important for the U.S. to remain a leader here, not only on the economic scale, but also what that means in terms of value-wise and where we are setting our priorities, and ultimately the landscape and the tone that that sets for not only the U.S., but also just on a global scale as well.
Yes, there's a tremendous responsibility here. And besides all the talk of geopolitics, I was really fascinated to listen to Michael Mager of Precision Neuroscience and just the strides that are being made to really develop the connections between human brain and the science of understanding it, and just pretty much, I mean, hooking up the human brain to a computer and then feeding it through AI just opens up all kinds of interesting possibilities and possibly sticky wickets. But the future is here, and I think that's kind of the tone of the day here.
Tone of the day. It certainly is true. Let's bring in our very own MC for the day, Brad Smith, my morning brief co-anchor. Brad, I'm curious, what have you made of some of the commentary that we've gotten so far?
Yeah, I've been putting together a little bit of a word cloud, as we all have been, as we've been listening into these conversations here at Invest at Second in New York City, and a lot of our live viewers tuning in online. And a few of the words that really jump out to me and kind of form a mode in this kind of mathematical mindset, if you will. Tariffs, number one, that's come up in a few conversations. We heard that, and how the CEO of Macy's, Tony Spring, is thinking about tariffs, and also Apollo Global Chairman and CEO Marc Rowan thinking about this and hoping, and you get a sense that they're cautious but hopeful, banking on some relief that it's not as bad as perhaps campaigned on, or perhaps as it could be here. And we'll see what that looks like when President-elect Trump ultimately gets back into the White House, and what the balance of power looks like in D.C. Another part of this word cloud, nuclear reactors. And you know that I'm hot to trot to talk about nuclear reactors day after day because of the type of people that are talking about it. It's everything from AI companies to energy companies and utility companies. And so it's got to be important, because there's also the zoning that comes along with it. So to build more nuclear reactors, you need land to do so. This is also a jobs opportunity as well. So there's a broader employment economy type of impact that we could potentially see in the future. And then additionally, the mentions that we got just from Tom Steyer, who was on stage a moment ago, about nuclear reactors. Marc Rowan also talked about that. And so it all feeds into what you were talking about, Jared, in the AI theme here. And then just lastly, within this word cloud, because I can go down my list, but the VCs that we've heard from in this kind of last tranche of featured guests and speakers here, looking for AI in pitches, but where it makes sense. And so pushing back on where they're hearing from founders and looking through some of these extensive slide decks that are getting put in front of them on a daily basis and saying, actually, you have nothing to do with AI. When is this actually going to benefit your business? And they're being a lot more, it seems, stringent with the dollars that they're putting forward in the capital that they're infusing into some of these ventures. And so that gives us a little bit of a mindset about capital flows right now as well.
What about some of the commentary on Elon Musk, too? I was asked about that. Marc Rowan, I thought, had some great insight just in terms of the optimism that he sees, just in terms of the fact that he thinks there needs to be change right now, and Elon Musk could be the right person just in terms of helping the new administration usher in that.
Yeah, you know what? It was fascinating to really hear how so many people are thinking of, and I think even more so than thinking about Elon Musk, thinking about the other types of profiles that this return or reboot Trump administration is going to be trying to put around it, and more business-minded figures. Now, Elon Musk, as whichever side of kind of the mindset a lot of people will find him on, he has a track record that a lot of people, a lot of voters looked to. That's why he had a certain amount of swing. He's also added on about, $70 billion in net worth over the past few weeks. He's going to have a lot of say once Trump does get back into the White House. And there's really more of the mindset around not just Elon Musk, but who are the other business profiles that are also going to be put around Elon and Trump to really have the ear of the president and drive some of the policy that's going to be put forward, and hopefully increase the amount of the jobs, hopefully make sure that there is not an overhaul of the way that the Fed is operating independently of the White House, because it is its own legally protected entity. We should remember that, regardless of what the campaign trails was saying over time. But I think for Elon Musk specifically, it's going to be more of, okay, what can I signal to Tesla investors here over the longer course of time that I'm doing to benefit them as well? And Tesla investors, they certainly have been, seems like, rejoicing over the past couple trading sessions.
Hope so.
Yeah, who wouldn't be from the reaction that we've seen in the stock, right, Brad? Great stuff. We got to let you go. You have a busy day ahead. All right, let's take a look at some of today's trending tickers. And first up, Boeing. News out today that it delivered just 14 aircrafts during the month of October. Now, to put it in perspective, that was actually the fewest number that we have seen from Boeing since 2020. The Boeing's machinists head back to the factory floor after a 7-week strike had halted the output. We're still seeing the implications of that, or the result of the fact that Boeing machinists were on strike for so long. So just to put it in perspective, again, the lowest total that we have seen since November of 2020. Jared, we have talked to so many strategists and analysts at Yahoo Finance over the last several weeks during this labor strike, talking about the fact that the impact that is going to have on Boeing, not only now, but also in the long term, and the advantage that we're really seeing Airbus have here. And that is also reflected in Airbus's most recent numbers here that they're putting out for the month of October, delivering 62 airplanes, 48 of those, including the A320neo.
Yeah, it's not a surprise. 33,000 hourly workers walked off the job, and since October 31st, Boeing has only been able to deliver 24 jets, and that includes 17 MAX and 6 Dreamliner jets. I think if we go to the Wi-Fi Interactive, this is going to be instructive. Let's just take a look at aerospace and defense. This is today, and you can see both Boeing and Airbus are down about 3.5%. I should say there's been a little bit of market pressure today, but let's check over the last 10 days, and we can see how things have evolved since the election. You're going to see a lot of green here, and an exception is Boeing. You can see Boeing down about 5.6%. That's because of the strike, but also Raytheon down about 0.3%. You might have some earnings stories parked in here, but aerospace and defense as a sector is an industry that had been hitting all-time highs before the election and was kind of a stalwart of the rally when we were talking about it was just the mega caps. Well, aerospace and defense was playing a role there too. But here's Boeing, and let's go back to the Wi-Fi Interactive. I'm going to put a 5-year chart. You can see this here is a fallout from the second, I believe, 737 MAX disaster there. And it's just, the stock has been in this big trading range, and it's towards the bottom of the trading range. So when you're stuck in a big trading range like that, you got to wait for the next catalyst.
You do, and actually Brad and I were talking to Southwest CEO Bob Jordan not too long ago, and Brad, you actually asked the question about ultimately what they want to see from Boeing. I forget exactly how you phrased it, but he was saying that they need Boeing to be stronger. They need Boeing to be better, and was almost critical just in terms of what he has seen play out over the last several months.
Yeah, I was supposed to exit the stage by now, but I heard you guys talking about this and decided to stick around. I asked Shauna to bring me back in, so that's just a little, inside baseball for the viewers at home.
Get yelled at?
Yeah, just in case anybody gets yelled at. It was my fault. It was my fault here. But I was just taking a look at all of the airline stocks right now. Take a look at AAL. Take a look at UAL. Take a look at DAL. All of them are down right now. And why is that? It's in reaction to the fact that they're going to have to push out even further some of the expected delivery timelines. That's going to impact routes. That's going to impact the capacity. That could impact the amount of customers that are ultimately able to fly and the pricing mechanisms therein as well. All the while, these companies might be spending a little bit more on maintenance at the same time. That means that they have to keep an aircraft in circulation that much longer and make sure that it is still up to snuff and meeting all of the regulations in order to take flight to all of the destinations. So this is where investors are really trying to get a good sense of what they need to be pricing in to all of the airlines' names as a result of what you're talking about with Airbus deliveries and then additionally with Boeing here.
Great insight there.
Thank
We're
you.
happy you stuck around.
Yeah.
That's the perfect person to
I'll be
have
for real.
on set. All right, let's move on to Honeywell today as Elliott Investment Management announcing it has amassed about a $5 billion stake in the company. Now, the activist investment fund is calling on Honeywell to split up its aerospace and automation divisions here. They basically want them to have the simplification of the structure that we have seen. They want one company to focus on aerospace, one company to focus on automation. I was going through the letter that was sent to Honeywell's board from Elliott, and within that, Marc Steinberg and managing partner Jesse Cohen writing that uneven execution, inconsistent financial results, and an underperforming share price have all ultimately hurt the company's record of value creation over the last 5 years, and they're pushing for change.
Yeah.
Elliott's been busy.
Yeah, definitely. We'll go to the chart in a second. Just want to give you another quote here. The conglomerate structure that once suited Honeywell no longer does, and the time has come to embrace simplification. And so this is somewhat reminiscent of the bifurcation that GE underwent. They just split into GE Healthcare as well as GE Aerospace. And as I bring up the Wi-Fi Interactive here for Honeywell, you can see gapped up today and has been drifting down. But let me show you the last 5 years, and you're going to see what the investors are kind of balking at, which is that it has been caught in this trading range and has really not done much since the late 2021, 2022, and it is right back up to that resistance line. However, let's put a longer term chart. Let's get a max up there. You can see that is very close to record highs, but we're still looking for that catalyst that pushes it through, and we'll probably see some incremental news over the coming days and weeks with regard to this stake in Elliott. Is it going to be enough to push it convincingly to new record highs, or are we going to get sucked back into that trading range? That's what remains to see for investors.
Yeah, the three-year chart. I'm looking over your screen right now. It hasn't done much. Talking about the pretty much.
No, and the 5's not any
flat
better.
Performance. Yeah, exactly. Which is why Elliott is not happy. All right, let's send it over to Josh Schaefer, standing by in our studios in downtown New York, with a closer look at some of the movement that we're seeing in the markets today. Josh.
Hey, Shauna, yeah, I'm taking a look at the three major averages, both lower, or all three lower on the day here. So we're taking a look at the Dow Jones Industrial Average, down a little bit over 0.5%, about over 250 points. Then you take a look at the NASDAQ Composite, that's also down a little over almost 1/3% there in the S&P 500. You can see all three of the major averages have sort of been drifting lower throughout the session. We're sort of looking at this as maybe a little bit of just a breather from that post-election rally we've been seeing. But some reasons that you could be seeing that, I'm going to flip lower here and take a look at the 10-year T-note. So the 10-year T-note now has been gaining throughout the session, now up over 11 basis points to 4.41. That's one of the highest levels we've seen since that election. So we came off that boil close to 4.5 post the Fed meeting. But here's been the trend. It's been higher yields since we've known that Donald Trump has won that election. That's been one of the so-called Trump trades. Another Trump trade we've been watching is the US dollar. The dollar's been gaining steam again today, now hitting its highest level against the euro in a little bit over a year. So that's what we're going to take a look at here. This is euro versus the dollar. Take a look at that over the last year. The euro is its weakest we've seen against the dollar in about a year. So two potential headwinds there. But guys, I want to focus a little bit more in on that Trump trade, because a lot of the stocks we've seen rallying over the last couple of days because of the Trump trade, taking a little bit of a back seat today. So I want to highlight the big one, Tesla. We've been talking a lot about that rally we've seen in Tesla shares thanks to Elon Musk's relationship with President-elect Trump. That stock had absolutely ripped over the last 5 days, down 5% today. Similar look, if you take a look quickly at Bitcoin. Bitcoin had been a part of a massive rally in crypto, got all the way up to 89,000. Now you're looking at about 87,000. So again, a little bit of a breather in some of those popular Trump trades is a big part of that market action today.
All right, Josh, thanks so much for breaking that down. We're going to take a quick break. On the other side, we got the latest from the Yahoo Finance Invest Conference. More on that coming up straight ahead. Welcome back to our live coverage of Yahoo Finance Invest in New York. Now, we have heard from so many great names, great business leaders since the start of the Invest conference earlier today. And here's a listen at what some of our guests have had to say.
I think we're all waiting with bated breath for exit opportunities. And it's been very slow for several years now. At the end of every year, when I'm doing one of my prediction, interviews about what the next year will look like, we're all hopefully optimistic about what the IPO market will look like. But it remains to be seen whether we're actually going to see some real healthy IPOs. And then, the M&A side of things has also been a little tough, certainly with some of the pressure from the current administration around that. So there's a bit more hope around that to come as well.
That brings me to the idea of Trump 2.0, which I'm hoping to get into with you here. A lot of optimism on the stage about what the next 4 years look like. Marc Rowan saying he's incredibly optimistic to kick off the day. As an investor yourself, but also an investor who focuses on women's health, how does that rah-rah attitude sit with you?
Yes. I think, not to use the phrase again, but I think it's also, again, a tale of two cities. Let's talk about the venture side of things, and then we can get into the women's health and the health tech. On the venture side, I also sit on the board of the National Venture Capital Association. So we spend a lot of time with legislators on the Hill trying to advocate for policies and for changes that will benefit the entire industry, that will benefit the founders in whom we invest. And there are some things, I mentioned FTC and so on, that perhaps, could open up a little bit more under a new administration. And so that may present some broad macro excitement in the industry. But when it comes to health and when it comes to women's health, I don't think that many folks in that space necessarily share the same optimism. I think there's a lot of concern for autonomy. But at the same time, oddly, quite a bit of optimism. And the reason that I say that is because we already sort of experienced this. In fact, I did an interview with Yahoo Finance right after the repeal of Dobbs, where I said I had seen, and I'll say this is true today, an influx, almost an inundation of inbound from investors as well as entrepreneurs who are particularly interested in women's health, who see capital as a means of capital deployment as a means of action. The investors, are one side of it, but the innovators are actually what give me the most hope.
Look, Anduril's done well in prior Trump administration. It's done very well in a Biden administration, and I think will continue to do well in any future administration. I think the reality is, we are probably in one of the biggest periods of geopolitical uncertainty and instability we've seen in our lifetimes. And the bizarre thing to me is we don't really talk about it that way, right? When is a scenario that, Houthi rebels have basically disabled shipping in the Red Sea? We're, in a hot conflict in the Middle East. And then obviously the Russia-Ukraine stuff continues. And there's escalating tensions in the South China Sea. We are engaged in an unstable world all around the globe right now. So I think for a Trump administration, the most important thing is to recognize the degree to which American leadership on this still really matters. Mm-hmm. And a lot of that is going to come from the fact that we have the strongest and best military, and that we need to take leadership. We are the only superpower that is actually about human rights, rule of law, and that is incredibly important stabilizing factor for the world. So I think if anything, the Trump administration has an amazing opportunity to reassert that leadership, to show our allies and partners we stand with them. They need to also stand with themselves. We need to support them. But it really is about how do we have the best, most superior military for all of our allies and for the United States.
So if that's the case, let me ask you, Brian, let's say, there's a new Secretary of Defense and he comes to you, and he or she actually might come to you, right? And they say, listen, how can we improve the Pentagon? How can we get smarter, more effective, more efficient? You say what to them?
I think there's two big aspects to this. One is that, the Trump administration has focused on, talked about, and I think is correct, is really just streamlining the bureaucracy, right? There's just so many roles, so many things that make it hard to do what we really need to do as a country, to move out, to take risks, to actually just build the military we need to have. I think it can be wildly more efficient. And that's something that I think they can take a lot of leadership on. The second part is recognizing how are we going to build the military of the future? We are in a particularly precarious position. There's these war games that show what a conflict with China would look like. we run out of key munitions in like 8 days. Like this is a major problem. Ukraine has showed this. We cannot supply the munitions we need. We are struggling to produce at the volumes we need to. And on top of it, our allies are looking at this and saying, is America going to be there as sort of like the preeminent defense supplier of the world? That's a real question now. That wasn't a question 15, 20 years ago. But now I think it is showing that we have some serious weaknesses in our ability to produce.
As a quick glimpse at some of the all-star lineup that we have heard from here this morning so far, today so far. We also heard from Tony Spring, the CEO and chairman of Macy's, not too long ago. Our very own Brooke DePalma was on stage with him. And Brooke, it was a great conversation. Congratulations. Talk to me about what some of your biggest takeaways were from the conversation, because one of mine was the fact that he was so optimistic and very confident, it seemed like, in where the consumer is today.
Yeah, very confident on Macy's at large, with both the Blue Mercury, the Macy's, and the Bloomingdale's business intact. Of course, we heard a bit more about that bold new chapter strategy. They're looking to, keep the iconic department store, but really turn into what is now a very popular word in the industry, that idea of a marketplace. And they're really looking to do that by leaning into this idea that it's a one-stop shop. You can get prom dresses, you can get your baby registry, your wedding registry. You can really do it all at Macy's. And we also leaned into the fact that we have a new administration. This is a top of mind for many investors right now, with the idea that there is potentially going to be tariffs that come into effect once Trump takes office in January. And he said that their private labels brand have moved out of China. He called it very advantageous to do that. He said it's too soon to say if consumers will in fact face higher prices. Of course, it seems like in the past they have avoided that. And also we heard more about those first 50 stores that they're investing in. He wants the customer to be able to come to them and really see what they want right away. He said that there's a golden equation they're looking for: an increase in foot traffic, an increase in conversion, and an increase in the average order. But he did say that consumers are willing to spend, and they're really looking to either go for an experience or escape in this sort of environment that we're in right now.
Escape. I like that.
Escape, yeah, I know. I think a lot of people are thinking that these days. Well, certainly we'll see what the holiday shopping season brings. Brooke, great stuff. Thanks so much. We will take a quick break, but coming up, we've got full coverage from Yahoo Finance Invest here in New York City. Stick with us.
Please join me in welcoming our first guest, Apollo co-founder and CEO, Marc Rowan, who will be interviewed by Yahoo Finance executive editor, Brian Sozzi.
You know, of course, Marc, one, just good to see you. Thanks for coming down here to the conference. So we've seen really a euphoric market response in the days after the re-election of President Trump. I mean, you heard Tappan mention a new cast of characters. You know, these new cast of characters coming into the administration, are they as market friendly as the market is pricing in today?
Look, they are clearly market friendly, and clearly markets, financial institutions, other institutions sensed a need for change. I think they're going to bring change. You know, as I was joking, pre-election, this election was about whether you were more scared of 4 years of the same or more scared of 4 years of change. I think the verdict's been rendered. Market's verdict's been rendered. I come at this incredibly optimistically.
What type of changes do you think would unlock a higher market? I mean, what makes you so hopeful?
Look, we're coming in this administration is coming in at a point in time where they really do have an opportunity to pivot. Think about where the U.S. is in the world. I mean, all the action is here. I mean, just recite what's going on. The economy is in great shape, certainly relative to the other two large blocks of Europe and China. We have stimulated our economy over the past 4 years, and we're about to get the dividend of that. I mean, we forget 3 years ago we passed almost $2 trillion for infrastructure. It's all under construction. 2 years ago, $52 billion for semi plants. Not a single plant is open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, all under construction. 3 years in a row, we've been the largest recipient of foreign direct investment, all under construction. It's coming our way. We're where the action is, and now the question is, can we lead? And you can pick almost any area. Pick energy. We've spent all this time where the dialogue's been about energy transition. I think we're actually going to start talking about energy accretion. I mean, think of just the demand for data, for power, for data to help redefine our future. We can't just talk about transition anymore. We have to acknowledge we are going to need more power. No one produces clean power the way we produce it. We can have it produced here, or we can rely on others producing it for us. Financial services, I think we're going to see exactly the same sorts of changes.
Does Elon represent wholesale change? $2 trillion in potential cuts he's floated.
I think Elon Musk represents wholesale change, and I think we actually need wholesale change.
Interesting. So I know Apollo's focused, and you brought this up at your recent Investor Day, global infrastructure. How is Apollo playing in that arena to help support that build out? I imagine AI is a big area of focus for the team.
Look, we call it a global industrial renaissance. Think about what we're doing in the world. Almost everywhere in the world, we're building infrastructure. There was an article today talking about European defense, and the most striking thing about European defense was how much infrastructure was required in Germany. So infrastructure is one of the things that we're building. We're doing energy transition because there is no change, there is no going back. We are going to build alternative sources of energy, and companies are transitioning where they get and how they use energy. And the third is this notion of power accretion rather than just energy transition, I think is going to become part of our lexicon. We have vastly underestimated how much power we need. Which of us thought utilities was going to be a growth industry?
Oh, nuclear. Everybody's talking about nuclear.
In all forms. I mean, the irony that AI could actually be the cause of a renaissance in nuclear power, we just have to, kind of chuckle at that. But if you step back and you think about it, all three of these megatrends, this global industrial renaissance, are long duration, complex, and are generally ill-suited to shorter-term bank balance sheets or plain vanilla bond market. The amount of credit, the amount of hybrid equity, and the amount of equity that is going to be needed dwarfs anything we've ever seen from an investment point of view. Oh, by the way, the government's still running a $2 trillion deficit at the same time, and we have massive change in our financial marketplace. This growth in the need for credit, particularly complex, long-dated credit, is one of the primary drivers of our business. And I think that is going to power not just Apollo, that's going to power our whole industry.
In the last minute and a half we have left, I remember talking to you 2 years ago, and your mantra, I guess, to the firm was that no new toys, meaning no big acquisitions. I mean, is 2025, with rates coming down, a friendlier administration, Apollo's back in the market for big new toys?
I won't say new toys. The absolute prohibition is gone. Christmas is back on at Apollo. Hanukkah, Christmas, whatever we need to do. But what I will say is we have to be very humble in what we do. At the end of the day, we are a small asset manager in the scheme of the world. If we hit our business plan, we will be twice our size in 5 years. We will still be a small asset manager. We are winning because of strategy. We are winning because of what we've done, but mostly we win because of culture. And to me, acquisitions that bring in lots of people, other than if they're essential to what we do, just put pressure on our culture. So I think you will see for us small additions to our capability through acquisitions, but I will be surprised if something transformational happens. We have so much to do in just our base business that it's some new toys now.
Please welcome Tony Spring, who is the chairman and CEO of Macy's, and Yahoo Finance senior reporter, Brooke DePalma.
I want to get right to the heart of the business, the customer. We are now, as everyone knows, 7 days post-election. How does this impact the Macy's consumer?
Well, I think the consumer never likes uncertainty. So I think as we all experienced kind of what will happen, the consumer doesn't enjoy that. I think the level of uncertainty we've seen in 2024 has been high on a number of different factors. So I think post the election, retail is a great place for those that want to celebrate and those that want to escape. So we actually are a great place for people to come for what we call retail therapy, a chance for people to enjoy themselves. The holidays are coming. It's a perfect time of year where you're actually thinking about your family, your friends, your loved ones, as opposed to the geopolitical environment where you've got people who are, on opposite sides of the equation and not necessarily comfortable having conversations.
Now, did it help the fact that we had a decisive conclusion on who won Wednesday morning?
Yes.
Yeah. And are consumers seeking value in this sort of environment, or are they willing to splurge now that we got past that uncertainty?
I think you have different consumers looking for different things. One reason is why Macy's Inc. as a portfolio, Macy's, Bloomingdale's, and Bluemercury is such a powerful engine of retail is because we appeal to different types of consumers. There are those people that are looking for what's the latest fashion, what is newness, and that's very important to the Bloomingdale's business. It's also important to the Macy's business.
I want to flip to the fun side of things. I know that in late February, Macy's introduced this bold new chapter strategy. Now, for those who don't know, within the first 50 stores, you have more sales assistants in the shoe department, you have more help in the fitting room, there's more visual advertising within the store, within the products. What sort of returns are you seeing early on that gives you confidence in this strategy?
Yeah, we've seen 2 quarters of growth in our first 50 stores. So, taking a step back, bold new chapter, obviously for Macy's Inc., first part being to reimagine Macy's. The reimagining Macy's is to close 150 underproductive stores and invest in our 350 go-forward stores. A part of that 350 is 50 stores that we selected to try to amp up our efforts. And that was in product, that was in service, that was in presentation, that was in marketing, all the things you referenced. The early signs of success are customer service scores up 600 basis points, sales in almost every family of business up in these stores, or up in from a differential standpoint to the remaining Macy's go-forward fleet. We're seeing interest in brands and in products, manufacturers wanting to sell us into those stores because of the way we are treating the product and the care we're showing for their brand and their business. So I'm cautiously optimistic. Again, it's 2 quarters in a 3-year strategy, so we're not slamming the ball, but I think there's interest in doing more of what we're doing and bringing some of the strong fundamentals back to retail. How do we have better product, better experience, and better value?
People are not as optimistic as you are about the department store. So many have turned to e-commerce. What makes you so confident that this strategy will help make Macy's relevant?
I just want to take a step back and rephrase the term department store, because essentially if I told everyone that I had a business, that we could be in the cosmetics business, we could be in the women's apparel business, we could be in the men's business, we could be in the home business, we could be in the electronics business, you might call that a marketplace. And a marketplace is very attractive to people because a marketplace is where I can go and find the things I want in the brands and the prices and the styles that I like. And I think a part of what we've not told as compelling a story with is that department store says it's fixed. What we've allocated to apparel or allocated to men's, we can't change. Crazy. We can absolutely change that. We could change the amount of inventory we have in those categories. We could change the amount of people we have in those categories. We could change the amount of advertising we dedicate to those categories. So what I love about department stores, and my love goes back 37 years now, is the fact that we can move to where the customer is going. So if the men's business is great, we can have more inventory in men's, more advertising in men's, and more people in men's. And if we're in a moment where people are excited about fragrances, we can double down on the fragrance business. And so I think sometimes that fact is missed when there is a interest in the specialty business or in the off-price business, that the department store has the bandwidth and the scale to be in all these categories. And Celebrating life's moments is something that Macy's does pretty well. So whether it's the prom dress, whether it's the first interview suit, whether I'm getting married, whether I'm having my first child, all those are moments where we can show up. And because we're in all these categories, it allows us to show up as one of the top choices.
I just want to hit home this conversation. We're in this environment where young consumers are turning to Amazon, they're turning to Shein, they're turning to Temu. Do you think that you can capture the younger audience to stay and go to Macy's in the future?
Yes, as long as we continue to evolve our operating model. We have 5 generations shopping with us currently. And I want to make sure that 5 generations enjoy and feel comfortable shopping with us. Some are going to shop us for fragrances. We have lots of young people today who view Macy's as the fragrance destination because we have brands from all the different designers at all kinds of different price points. We're also the place where moms go with their daughters to buy prom dresses. We're also the place where people go, as we said, to get married. We're also the place people go to get things for their first home. We just launched a baby registry. The benefit of something like Marketplace online allows us to delve into categories like baby furniture and electronics and gaming, things that appeal in some cases to younger consumers that we haven't always had within our stores.
For more on the future of the industry, please welcome in Deena Shakir, General Partner at Lux Capital and Yahoo Finance's own anchor and reporter Madison Mills.
Deena, thank you so much for making the time this morning. As our lovely MCs mentioned, you're over at Lux Capital as a general partner. I know you focus on tech, women's health, a lot of different areas of investment. I just want to level set to kick off, right? We've heard a lot of conversation on stage today about interest rates coming down. It's the era of free money, rah, rah. Is that what you're seeing? What have you been seeing over the past 6 months or so?
Yeah, well, first of all, thanks for having me. Delighted to be here. You know, venture is an asset class in finance that has to think 10 years ahead. So we don't necessarily immediately see the implications of what's happening from a day-to-day perspective on the markets. That being said, it's a tale of two cities in venture. And so you've got the AI side of things, and now I would also add perhaps the defense tech side of things. I know we have one of our companies presenting right after me. And then there's the everything else. The everything else has not quite seen that exuberance yet. The AI and defense tech is benefiting quite a bit from some of these tailwinds.
What will it take for the everything else to catch up?
Well, I think we're all waiting with bated breath for exit opportunities. And it's been very slow for several years now. At the end of every year, when I'm doing one of my prediction, interviews about what the next year will look like, we're all hopefully optimistic about what the IPO market will look like. But it remains to be seen whether we're actually going to see some real healthy IPOs. And then, the M&A side of things has also been a little tough, certainly with some of the pressure from the current administration around that. So there's a bit more hope around that to come as well.
Another aspect of the macro picture I want to talk to you about is this idea that women are getting richer. They're inheriting more wealth. I think it's $80 trillion expected to be funneled to women by 2030. As women get richer and they are becoming the biggest investors, is there an opportunity in venture, in private investing, for women to both seek out better returns but also higher impact that you talk about?
Yeah, absolutely. I mean, when it comes to, we just talked about women's health. I'll use that as an example. Women's health is an area that represents, of course, half the population. 80% of the dollars spent in healthcare are actually controlled by women. Neil Shaw, who's the chief medical officer of Maven Clinic, coined a term which I like to piggyback on, who says that women are the chief medical officers of the home. Mm-hmm. And yet, this category was categorically underinvested in. It was seen as niche. Literally that word, for many, many years. And it still represents a very small percentage, not only of dollars deployed in venture, but also on the R&D side of things. So there is a massive opportunity to unlock here. And the fact of the matter is, a lot of the people doing that deployment are also women, because for a very simple reason. It's natural, intuitive to us. We live it, we experience it. And for a long time, when the investors were largely male, and if you talk to some of these early innovators like Kate, she'll tell you her seed rounds, even her Series A, 90% of the investors she was talking to were men. Still a lot of the investors are men, even in women's health, but their diligence process was talking to their wives or their daughters. So that is changing. And I'm on boards of women's health companies with a lot of men who are starting to see that this is not just good for the world, but it is good for business, that there is a real opportunity to create value for our shareholders, for our LPs. And I think that's something that we'll start to see lots more of, hopefully coming from women.
And Maven just hit a milestone, right? A $1.7 billion valuation, I believe. Does that officially put the idea that women's health is niche to bed, or is there still more work to be done?
Well, I think the idea hopefully should have been put to bed a long time ago.
Well, hopefully.
Yes, and Maven was, in 2021 became the first unicorn in this space. They are continuing to trailblaze, but what we all really need to see is some exits. And so I think that, again, as the market starts to open up, hopefully we'll see more of that these are not only incredible private companies, but can be generational businesses that are durable and hopefully, can become public entities.
When is the AI goodness going to hit women's health?
I'm actually really excited about what's out there. There's a lot happening, but let's remember, the actual percentage of dollars going into R&D in women's health is less than 2%. So as long as less than 2% of research money is going into this space, we're not going to see crazy breakthrough.
Yeah.
That is changing. You know, this past year, ARPA-H had this $100 million initiative to fund women's health research, real moonshots, just like they did, you know, with other sectors. We're seeing everything from investments in artificial womb technology, incredible advances on fertility tech, AI in particular being used. We have a company in our portfolio called A-Life, which is revolutionizing the way that embryos can be selected and optimized for that. Early detection of cancer, lots of advancements on that. Early detection of things like preeclampsia. As you know, I personally suffered a near-death experience with postpartum preeclampsia that couldn't have been predicted. And I've started to see some technologies that are actually looking into early detection of these types of diseases that can be deadly to women. So there is a lot out there. It just takes a longer time horizon, and it takes a lot more capital at the earliest stages. And at Lux, we love to invest at those early stages, and particularly in breakthrough science. And so we have the opportunity to invest in, you know, companies that are really just an idea and an incredible, you know, researcher, and turn that into a viable, durable business.
And welcome to the stage, your hosts, Yahoo Finance anchors Julie Hyman and Brad Smith.
Well, welcome back, everyone. We hope you enjoyed your conversations over lunch. Without any further ado, let's get on with the program.
Yes, let's. One of the areas that we have watched really closely since the election has been financial stocks, and big bank stocks in particular. They've been riding high on hopes that a second Trump presidency will bring economic growth and deregulation of their industry in particular. So I am really excited about this next conversation. I want to welcome to the stage Brian Moynihan, Chairman and CEO of Bank of America, and Yahoo Finance Executive Editor Brian Sozzi.
Brian, as you know, I'm a proud B of A member,
Thank you.
A couple bucks in that account after many years of hard work, so thank you for that. So before we get into actually the topic of this chat, we were just talking in the back. I can't believe it's 15 years, January 1st, that you will be the CEO of Bank of America. I mean, give us the tips to leadership longevity. I mean, how do you do this?
Age, gracefully, I guess. Look, I've got a great team, and that's the number one thing. To be successful across time, you have to have people who do the work well, and keep the energy up and keep the drive. And I'm lucky to have a great team. And every day we at least 215,000 people to go out there and do their job, and they do a great job.
Talk to us. So drilling into this topic, these topics a little more. We've heard a real sense of optimism from the folks on this stage. My first interview of the morning was with Apollo CEO Marc Rowan. Optimism on this new administration, what they can do in terms of regulation, unleashing the power of business. Do you share that optimism?
Well, I think it's clear that the market has moved in anticipation of all that. Now it has to be executed upon. But I think what's really driving the fundamental activity in the economy is the things that make America great. Capitalism, a consumer knows how to, is employed and earning money and spending, a credit which is widely available. And, those are what drives this. Capital markets is deep and open and recycling capital, and investors like all the people here putting it to work. That's what makes America great, and having a set of policies which enhance that is a good thing.
One of the benefits of being the CEO of Bank of America for 15 years, you get to work with different administrations. People call you for advice, and there was a photo that I found just as I was prepping for this, you sitting next to then President Trump during the COVID-19 pandemic. You worked with him. Do you have confidence that he and his new, as someone else said in the here today, cast of characters can execute to the extent that it justifies this market optimism we're seeing?
Well, I think they should be able to. They've got the experience, and so that was in the middle of COVID. It was literally the day which he issued the order cutting flights off from outside because of the dynamics. So, yeah, I think the thing that's always interesting about a second term of a administration, this one had 4 years between it, is that they come in without having to go through all the work the first time, which the work the first time has a couple dimensions. One's the personnel part of it, usually takes a lot longer. And there's been transition planning commissions formed to try to speed that up, but you got to fill a lot of jobs, 4,000 jobs. You also have to figure out what policies you're going to have right out of the box. You have to figure out who you have to reward for things that got you here, and all that is important. When you do it the second time, especially when you have time to think about it, I think it's they should hit the ground running, and I think that's what they plan to do.
The cast of characters, we're learning a little bit more about who will serve the administration. They have a different profile than what they look like in the first term. They appear to be feather rufflers. I mean, do you have concerns as a leader that they may ruffle some feathers on a global scale and it impacts businesses?
Well, I think the idea of the United States is an idea, and it's an idea which is really unique in the world. And it is an idea which has been, a president elected now for 47 times, I guess might be 47 different people have served in the office for 47 times. So if you think about it, and you think about the elections across time, there has been a lot of debate about who this is or who that is, all across time, and all that will play out. At the end of the day, when you get in office, you have the responsibility for 300 million plus people. You have the responsibility of being one of the leading companies in the world. You have the responsibility of a $6 trillion operating budget, a $2 trillion debt, or $1.8 trillion that's got to get managed. All these things become the real issues. So I think people often put in, even when Reagan got in with a huge landslide win, he was going to do things that if you actually go back and look, a lot of them were never done, because at the end of the day, the enormity of the task gets to you. Can you lean the policy? Absolutely. Can you change things? Absolutely. Can you lean the regulatory process? Absolutely. But at the end of the day is the will. You govern all the people, and that takes work. This group that coming in has experience, haven't gone through it before, and I think that will help them speed up.
I know Marc at Apollo, he's had the ear of some of the transition team. Have you talked to some of the key members, key players? And if so, what have you told them? And have you had the opportunity to talk to President-elect Trump?
Any conversations like that I wouldn't share with openly.
What would make it, fair enough, this group, what would you tell them? What do they need to do in that first 6 months or that first 100 days to unleash the power of business?
I think the issues that people think about, the other side is the opportunities for America. It is the place to invest on a global basis right now, because it has a better set of rule of law, it has a good rule of law, it has a set which regulates how you get paid and the rules of owning stock and all that stuff, a good rule of law, it has a talented group of people, has a lot of capital, and has a big final demand. In other words, our 300 million plus citizens consume a lot of stuff. And then it has incentives built in to help enhance that through tax provisions on bonus depreciation, things like that. So I think the first order of business is to play to our strengths. We are the innovation capital of the world. We are the capitalist capital of the world. We are the place where people can be, you 15 years ago that decide to do something and create a company or do something that can get done. And
I envision myself here, Brian.
Yeah, that's
talking to you.
We'll have a discussion about that afterwards. So I think you have to remember that those things are what makes America great, and enhancing those is what people have to do. So what do they need to do? One of the things they have to make sure is that we start to handle the budget better. It doesn't mean there's a crisis right now, but at the end of the day, we have to shape the budget back into a more normalized budget. Interest rates are going to be higher, debt carry costs are going to be higher. A $1.8 trillion deficit on an annual basis is equal to the GDP. That one-year deficit, the entire GDP of the country of Australia. So think about the size, scale, and scope and the amount of resources that pulls out to fund. So they have to think about how to get that in better balance. That is not new news. That's been going back to multiple administrations have tried to figure out to get that balance back, and then COVID hit and threw it all asunder. Now we've got to put that back together. So one is they got to figure out how to get government spending and revenue more aligned. They've got to deal with the tax laws that come up from renewal extension, and we got to do that, and we got to be careful not to impact one of the advantages the U.S. has is a reasonable set of tax provisions for corporations. That's why money comes here, and then we got to keep working on making the conditions of work. If you're trying to solve housing, you got to build more housing, and the way you're going to build more housing is to figure out how to create the incentives for communities to permit more activity. And that is a tricky thing because it's local community control, but the federal government can create the incentives and drive it. So a lot of these issues, they have the power of incentive production, meaning through tax code to the people who do the work, or through saying to the community, you do that and we'll new school buses, whatever it takes, but you got to get demands, the supply side of a lot of stuff built out.
A lot of folks in this room have a portfolio that is vastly worth more today after the election than it was 5 or 6 or 7 days ago. And a large part of that is this belief that the administration will come in and cut taxes. But can they come in and cut taxes at the same time where the deficit is going up and to the right seemingly every single day?
I think getting the balance right of spending containment, tax receipts, clarity and getting the condition there, whether it's cutting rates or simplifying the code and generating other ways to make sure you have it. But you need more revenue, and you also need to manage expenses. There's no other way to do it. In your household budget, you have the same question. I've got $1 coming in, I've got to have less going out to have come in if I want to have.
Yeah, I got alerts from BFA. It tells me I'm doing.
Or if I'm a government, I at least got to have $1 coming in and $1 going out.
Sure.
And the problem right now is we're $1 coming in and 30% of it's going out. 30% more, 130% is going out. So I think the way they're going to do it is going to be interesting. I think the ability to cut a lot of revenue producers will have to be carefully crafted with the amount of growth that the pie grows. And that's the conundrum you always have, which is saying if you cut rates, you've got to be assured that you're going to get more volume through that lower rate structure to get there. There's ways to do that. There's ways to go back all the way to the early 80s where they said you can cut the nominal rates and reduce the amount of loss in the system and build a lot of it. There'll be a lot of techniques there, but that is a hard process to manage.
Well, part of it, if they want to cut the deficit, doesn't it mean they have to cut government spending? And then look, maybe Elon is onto something with this government efficiency program.
I think it's all about growth rates. You know, you have to slow down the growth rates. And so in companies around this country right now, we had an inflation-induced growth rate in expenses. We're all sitting there saying, wait a second, we have to manage that back to a more normalized growth rate in expenses, given that the inflation's through the system and coming down. That the government has to do, that's what everybody has to do. And the trick of that is you've got to be able to do that, realizing that you came from X to about 30% more than X, to give you a sense in our company, in a round of nominal dollars, and then you got to flatten it out. People remember this on the wage side and things like that, and that's going to be tough work. But there's a lot there. I mean, believe me, any company, we look at our company, we can always take expenses out. Any enterprise can be a lot more efficiently run. There's no question. Apply technology, reductions and increases in spans of control, all the thousands of techniques the private sector use, I'm sure are applicable in government.
Part of your role too, I mean, you have conversations with everyone, but a part of that is, you've talked to Fed Chief Jerome Powell before, over I'm sure many years. How concerned are you that the Fed under this incoming administration is challenged?
I think at the end of the day, I think that our Federal Reserve, an independent central bank, is a good place to be. The debate is about what's the range that Congress created the Fed. A lot of people think it has anything to do with executive branch. Congress created the Federal Reserve Act, and the Fed was created out of it, and it was to provide its mandate, which is employment, prices, inflation, those types of things. And I think that they got to continue to work on that. I think that having that direct discussion at various times with people, having that monetary policy as another independent check with a purview of Congress overlooking it by who they appoint and by the annual testimonies or periodic testimonies, there's a control system around it. And so I think we have to be careful, because if you look at other countries around the world that do not have that, it never works out as well as one that is.
Well, that raises the next question. I mean, should the president have a say in monetary policy?
The president's a job owned the Fed for years. That's not a new concept.
Yeah. I mean, in your view...
Just like I can have a job bonus too, but at the end of the day, the people have to go do their job, that's their job, is to figure out where rates should be set.
Has Jerome Powell done a good job in your view?
I think he has. I think he's done a good job of working through the system. I think the reality was, were they too late to get to inflation? Sure they were. They were in unprecedented times. They didn't see it, the transitory, all that discussion. Then they came back, and now you're seeing what's happening is inflation's coming down. Unemployment's been relatively steady. Employment's been very strong. And so you're managing that outcome. And the question is, now's the hard part again. The hard part was to get started. The hard part now is how to manage it down so you don't overshoot. And I have more worry in some respects to the downside, i.e. overshooting now, than I did before, because the balance is tricky, because the data will float around on you, and what you thought was precision becomes less precise when you look back. So just think about the amount of restatements in jobs, the amount of restatements in some of the GDP things, just because COVID, we have to remember, was completely different than anything else. The idea that you had all the stimulus come in, that you basically spackled over, think of a hole in the wall, a hole in the economy, you spackled that over and made it level across the whole U.S. economy. This wasn't a narrow area we had to fix or do something. You had to do it across the whole U.S. economy. And the amount that was spent on that had to win that war. We won the war. But the problem is we not trying to win, so we added more and more to it, which really created a lot of inflation impact. That has to be taken under control.
Are you concerned that inflation resurfaces next year?
I'm probably less concerned about that in the near term than I am making sure that we don't hurt the American consumer's confidence. And I think the consumer was slowing down in the late summer. We saw it. It was concerning me because I thought it was slowing down to the point where it may be underneath what would imply a stable 2% plus minus growth economy, lower inflation. The good news is, as we came into September and October, if you look at the 2 months together, you look at October, it looks like it's leveling out. And the expectations of our consumers to spend more in the holiday season, up 7%, which is good. But that growth is running around 3% plus or minuses if you average the 2 months, 3-4. That's where it should be. And the danger is if you dispirit the American consumer by thinking the future is not going to allow them to earn, be employed, spend, it's hard to get them back in the game. And that's what took so long after the financial crisis, to get the confidence back in the American consumer. I think that confidence you saw it come up when the Fed says we're going to cut rates even before they cut them. The consumer confidence moved up a little.
How many rate cuts
We're basically one more this year and 4 next year, and then they get that a Fed funds rate that sort of stabilizes in low threes, three and a quarter.
What do you think that does to savers? You know, consumers for the past 4 or 5 years earning a lot on a good CD. Does that change?
There'll be a steepness to the curve, and so I think, the Fed, the 10-year, 7-year, 5-year, those. If you have 3.5 and they're 4.5-ish, somewhere around that, which is kind of what the implied normal rate curve shape would be. They'll as people go out duration, there'll be strong returns in the Treasury yields and stuff. And you saw a lot of our clients in Maryland stuff go into the Treasuries, and a lot of deposits went outside the banking system. Not overall among all the consumers, about the wealthiest consumers. If you look at the 20 people here in 20 who are still here today, if you look at what happened is that consumers with lower average balance accounts are still multiples of where they were in 20. The consumer in the highest, like between 100,000 and $1 million, are down 15% because they put the money in the market because it was excess money. That all happened. It's stabilized now. Deposits have been growing for the last 5 quarters in the industry and our company. And as you look at that mix, that means consumers are rational. So what will happen is the dividend yields of equity plays will become more relevant. The core interest rate achieved in a money market fund or a CD will be, maybe it won't be the highest peak it was, but that was based on a rate structure that was completely inverted. It'd be better if the rate structure be normalized and getting that rate by going out some duration. So it'll make the equivalent to balance. Most importantly, a real rate structure, which we haven't had in 17, 20 years, will also, I think, put discipline into financial decisions because there'll be a real cost of capital. And that's what you're seeing. So despite the market running up, you're also seeing a discipline come back into the cost of capital, which will play through.
Part of the reason why, in my view, you've been CEO of Bank of America for 15 years, you've always been level-headed. Like, I mean, you tell people like it is. I mean, but to me, this market move feels too euphoric. I mean, is it justified in your view? There's a lot of people in this audience have never seen, I think, some of the moves in stocks they have seen over the past 5 days. Like, what's your, I guess, word of caution to this group?
Well, we look at the one-day pop. It was actually not the highest pop we'd had. So in 2011, we had a pop that was more gross dollar value of market cap, believe it or not, even though we had more shares and it was less. So I think these things do happen, and the market reacts. The market's a very short-term mechanism. Ultimately, the equity market's supposed to long-term value, but it don't discount long-term value, but they're very narrow in the trading ranges. And so I think if you get to the people, our experts who predict what will happen long-term, it's going to be based basically on earnings growth. And so the question will come down, will the policies of the incoming administration create economic growth, which will then result in earnings growth, and whether if the companies are managed well, they'll get it. That's what will drive the next round of the market. The valuation pop that's happened over the last year and another chunk of the last 5 days, is pretty unusual. Part of it was recovery from last year and stuff, but it's pretty unusual. And so we got to kind of grow into it now, and that's the earnings growth has got to come.
I can hear my banking team, our banking team at Yahoo Finance, Dan Fitzpatrick, our editor, and David Hollerith watching this, probably saying, ask Brian about bank stocks. I mean, bank stocks have been
always undervalued.
Always undervalued. You've been telling me all these years undervalued, but I mean, they've been flying. Over the next couple quarters, what could this administration do to justify this run in bank stocks? Is there a regulation you're looking at? How can they make your life easier?
I think the simple response that you've seen in the market across the board has been, can we get this regulation done right and done in a way that both meets the needs of the economy and the capital structure of banks that support that economy and in the needs of safety and soundness. And as that pendulum swings and swings and swings over time, the idea is sometimes we swing this way and sometimes we swing that way, and now I think the expectation is. And so that's one thing. The second thing is deals, getting deals through, and that's, you've heard.
It'll impact your M&A, your investment banking?
Not us, because we can't do any, but it'll be on the investment banking side. And so I think there's that instantaneous reaction. Now it's got to fall through. But if you look, when we looked at Basel III in the industry, the idea of the finalization of Basel III, the increase in capital, and this isn't theoretical. We made it clear that this doesn't make any sense, and so there's a re-proposal to bring it down another chunk, and we'll see where it ends up. But the obvious issue was if you had our company needing, really, $30 billion more capital for the same risk, you basically were taking our ability to lend $300 or $400 billion out there.
Do these regulations get scrapped, Basel III?
I don't know what will happen. They're already being amended and stuff, and so I think cooler heads will prevail. We'll see what happens. And I think our job as an industry is to make sure that we do it in a way that is fair from all aspects. Fair to the companies so they can support the economy, but and then fair to the consumers, fair to the investors, and fair to the American economy. And also, in the end of the day, our industry is capitalized the best in the world, liquidity best in the world, and we have shown the resiliency through last year's crisis or the earlier backs and forth in the world that shows you that I think we got it pretty much right. So I think the amount of cap we have now is pretty much right. That's been said by every Fed chair. It's not, take my word for it. And rather than why are we messing around? And why are we following countries that are still struggling to figure out the right answer? Just let it go.
How, you and I have talked about this in the past, how just not good these Basel III rules, if they went fully implemented, like what would they mean to a bank like yours?
At the end of the day, if you think what's going to keep pricing tight on credit to small businesses and medium-sized businesses, and you said you're going to increase your capital for the same activity, what would happen is two things. One is the cost of capital of those businesses would go up and the worldwide competitors would go down. You'd say, well, how a $100 million revenue company, if we have to increase the rate they pay on their loan, well, that's not a problem because all the other banks are in the same boat in the United States. Very few companies with 100 million, 200 million of revenue compete only in the United States now. They're tied to the worldwide economy, whether they export to it, whether they supply parts to it, or whether they supply parts to American company can also get those parts from other people. And so the reality is this had a real economy impact that I think was not thought through. And that's why we stood up and said we don't think these rules are right as an industry, and we made it clear. And then what happened is they were moved a bit, and we'll see what happens next.
Last one, Brian, real quick. You're one of the most respected leaders in the banking industry. If you get a call from the president to serve in this administration, would you do it?
I've got a great job and a great company to run.
I don't know.
I think there are people who can work in administration, do a great job, and our job is to make them successful. Because at the end of the day, as people ask me about the elections, our company, the oldest part's been around at every election except for when George Washington got elected. Mm-hmm. So, and we'll be here far beyond this thing. And so our job is to make America successful, or add to America's success and help give ideas to make it even more successful. So I can do that as well from sitting in this chair as I can sitting in any other chair.
All right, fair enough. We thank you for sitting in that chair. Brian Moynihan, the CEO of Bank of America. Appreciate it.
Great. Thank you.
Thank you, Brian Sazi and Brian Moynihan, for that great conversation. In our next theme in our conversation, looking for alpha. Alpha in investing is commonly defined as an ability to outpace and beat the market. The portfolio themes that have reigned supreme over these past 18, 24 months even, they face some looming questions about longevity. And the largest firms, they are identifying their next opportunities for returns. Please welcome in, for this conversation, Bridgewater Associates Co-Chief Investment Officer Karen Carniel-Tambor and Yahoo Finance Senior Reporter Jennifer Schonberger.
Karen, thanks so much for joining us today. It's great to have you.
Thanks for having me.
Want to kick off the conversation with your outlook for the economy. The economy keeps surprising to the upside. Third quarter GDP clocked in at 2.8%, boosted by strong consumer spending, up 3.7%. We're seeing household incomes and savings revised upwards. Can this strength continue into next year?
You know, I think it's a remarkably resilient economy because it's a very different economy than what you usually see this far into an expansion. So usually when you get this far into an expansion, a lot of what's going on is that a lot of borrowing has started getting going, right? And so rather than people just spending out of their incomes, they're spending money they borrowed, and that's vulnerable. It means that Fed raises rates, cuts it off. What happened this time around is that the Fed did cut that off. The Fed did raise rates, it did cut off all the borrowing that occurred, and yet because of where we were with all that extra stimulus coming out of COVID, people still had checks to spend. That income cycle where people can spend their incomes was actually just getting going as the Fed had cut off the borrowing. And so you have this economy where households are spending. They're spending well, but they're spending mostly out of incomes. And on the business side, a lot of the spending is also very resilient because it's not that reliant on seeing demand. Companies are telling you, I am spending for existential reasons. I have to invest in AI. The big risk is to underinvest, not to overinvest. In other words, even if my customers don't have demand now, I'm still going to spend that money. So that is a very resilient set of sources of spending. Then you add to that the Fed being able to ease into an environment of falling inflation, and a Trump presidency probably being able to deliver a little more fiscal stimulus. That means we could probably get some borrowing restarted in this environment. I think that's quite a resilient expansion this many years in. Very rare, very unusual.
But does it continue into 2025?
I think so. I think it's got real room to run because I think the Fed has just delivered a little bit of easing. They're likely going to deliver a little bit more. That is at least a little bit of fuel. You're likely to get a little more fiscal stimulus. That's a little more fuel. And then a lot of the spending that's happening today, it doesn't have as many natural ways of kind of running out of steam. So I think we got an expansion that has a ways to run here.
You mentioned potential fiscal upside from the incoming administration. How do you expect President-elect Donald Trump's policies, from mass deportations to tariffs, tax cuts, deregulation, to influence your outlook for the economy?
Well, I think what's been interesting is that this time around, relative to 2016, the markets have had a pretty consistent view. As things were getting priced along the way, as his odds rose, that's the same thing you saw after he got elected. And markets are basically telling you more or less, Donald Trump means somewhat good for growth, somewhat inflationary. And so you're getting higher yields, you're getting a slightly stronger stock market, you're getting a stronger dollar, and it makes sense. You know that Trump and his team are believers in tariffs, that they really believe that's the right way to go. That has to be to some degree inflationary. You know they're believers in stopping the flow of immigration. That has to be to some degree inflationary. And the plans they put forward of what they want to do with the deficit are, to slightly increase the deficit, certainly not to reduce it, and to do things that are going to be stimulative. And so they want to create a stimulative environment. I think they hope they have is that you'll get enough productivity happening on the other side of that it won't be too inflationary. And that's very hard to predict. We're currently on a great run of productivity. You read the Europeans talking about how bad their productivity story's been relative to the United States. There's a lot of good things that have been happening here in terms of productivity, and potentially we have a big leg ahead of us as AI actually hits and actually impacts productivity. But it's risky because that is a very inflationary set of policies that is going to be generated. And so I think that the big question with the Trump set of policies is, what will they actually be able to implement? How inflationary will it end up really being?
Two follow-ups. One, it sounds like you do expect robust growth under the incoming administration. Is that right?
Yes.
Okay. Secondly, let's drill into the tariffs, because last time Trump was in power, he slapped targeted tariffs on China. This time, he's pledging for across-the-board tariffs, 10% on all U.S. imports, 60% on Chinese imports. I recognize that there could be some negotiations. On the flip side, there could be retaliation. We don't know about the timing and actual extent of that. But if we were to see the scenario that he has put forth implemented, what impact do you expect on inflation and growth?
Well, look, as you've said, these are definitely bigger tariffs than we got in 2016. So the impact's going to be larger. I mean, it's hard to put real numbers because the biggest thing you don't know is what the second and third order consequences are going to be. In other words, it's not just that we put tariffs on others. They can also put tariffs back on us, and you don't know what that kind of spiral is like. What I will say is the U.S. is less vulnerable to tariffs than other countries. So it does give some sense of sort of who has the incentives to escalate and why the policies are coming from here. But the kind of tariffs Trump is talking about, I think, are, could easily be 50 basis points of inflation, which in the environment we were in 2016 was not a big deal. In the environment we're in today, it's a bigger deal. And it's more likely to kind of hit us into limits of what's possible. That said, I think that the Fed is very likely to look at that as somewhat of a one-time hit. And so you could get a situation where a lot of tariffs go through, that raises price levels, but that's seen as a one-time rise to price levels. Not that appropriate for the Fed to be tightening into that if it's a one-time and done. And if it ends up hurting growth, actually being a reason to keep easing into that and make sure it doesn't hurt growth too much. So all of that adds up to we probably still have room to run on growth, even under a scenario of tariffs, with a lot of the unknowns happening from what happens with our allies, who retaliates, what's the second and third order here.
So looking at inflation in the near term, it's within shouting distance of the Fed's 2% target. On a core basis, more persistent. You've talked about the potential upside risks to inflation given the president-elect's proposed policies. Where do you see inflation settling out as we go through 2025?
Well, I think there is a really fundamental paradigm shift that's occurred, right? Where there was a long period where there was almost a gravitational pull of inflation to probably like 1-ish%. And that meant that there was just a lot of room for policy to run. And we know why that happened. We know the environment of globalization and the fact that when you looked at spending that was happening by corporates, it was very often spending that while it was spending, it was deflationary spending. They knew by spending, they would take cost out of the equation and make their products cheaper as a result. That has fundamentally changed. A lot of spending now you know is inflationary. You know that if your job is to say, I'm worried about over-reliance on China, let me go build another supply chain, you're not taking cost out, you're adding cost. You know you're doing that, right? Even spending on things like AI, while down the road may be deflationary, in the near term, it's definitely not deflationary. In the near term, you're pressuring up all the prices of all the inputs and energy and so on that you need to kind of create for AI. So I think the gravitational pull has moved to where the normal level of inflation is probably more like 2.5-ish or something, which it's not horrible. I think the Fed could be totally comfortable with that, but it means it's much easier to get over your skis and say, wait a minute, I'm worried about inflation than it used to be. There's just less room, and we're just used to an environment for, I don't know, a few decades here, where every time there was a problem in growth, inflation was just not a factor. You could ease into that, it wasn't a problem.
On the Fed, do you expect another rate cut in December? And given what you just said, would you expect fewer rate cuts in 2025? Right now, they've penciled in 4 more rate cuts for next year. Of course, they have the ability to retool that forecast at their December meeting.
I mean, look, I think this is the case where the market has actually done the right move, which is the market today is pricing in radically less cuts than it was just 2 or 3 weeks ago. And so the market saw that, pre-Trump victory, significantly more likely that the Fed would really be able to ease all the way down to like 3. And now it's thinking the Fed's going to ease more to like 4. So that's not a lot of rate cuts. That's not that many rate cuts that's left. So I think the market pricing at this point is somewhat reasonable. Now, if you just step back for a second and you say, look, the hardest thing in setting monetary policy is nobody really knows what the normal level of monetary policy is, right? It's a guess. It's a guess we all make, and certainly what we know is it's not what it used to be. I just talked about, kind of the gravitational pull of inflation. You could also talk about the fact that we needed negative real interest rates for a long time to deal with all of our debt burdens, and we don't anymore. And so what we know is there used to be some necessary interest rate, neutral interest rate that was very low, and now it's gone up. We don't really know exactly what it is. So if you look at what the Fed's guess is, it's guessing, I don't know, a little less than 1, something like that, plus 2%, gets us to like maybe 3 is like a normal interest rate. They know that they don't know. And the big thing the market is telling you from saying the rates aren't even going to get all the way to 3 is, wait a minute, this isn't a time for neutral rates. Yes, the Fed is normalizing interest rates. We were especially tight, and then inflation came down, and so that kind of raised interest rates more than we needed. But maybe even at the end of 2025 and in 2026, we'll need higher than normal interest rates, more like 4%. And I think that's about the right call.
So what does all of this mean for your outlook for the stock market? It has certainly been juiced on Trump being reelected, on the hope for greater growth, a viewpoint that you share. Major averages trading at near record all-time highs. Can this continue through this year and for 2025?
Look, I'll say the two sides. On one hand, if you just ask me, not knowing anything about what investors already hold, I think the stock market is a good thing to hold right now, and I'm pretty positive on it. And the analogy I would make is think about 1998, right? In 1998, you could say, yes, we're at an expansion, but aren't valuations already high? And the answer is no, they got a lot higher than that, meaningfully higher than that. You ain't seen nothing yet what actual bubble valuations mean. In 1998, like today, you had a Fed that was easing into kind of an unrelated set of problems, and you had a sense that it was kind of a mid-cycle easing that gave a lot of fuel for the stock market to keep going up. So I think there's a lot of reason to believe that the stock market has room to run, and that the most negative aspect is, valuations have gotten somewhat stretched, but not that stretched. In the most stretched corners of the market, when you look at things like AI, valuations have gone up somewhat, but also to a large extent have kept up with actual earnings increases, with what's actually occurred in AI, which has been a big deal, right? On the other hand, what you can't ignore is that people's exposure to the stock market today is radically different than normal. People are very, very exposed to the stock market. So almost any portfolio I look at, whether it's an individual investor or an institutional investor, what you see is that almost any source of diversification people used to have has really eroded because you've had such a run. So you just go through, such a long time where just buying the S&P 500 is the best thing you can do, that you say, what do I need all this other stuff for? If I just, bought the S&P, that'd be the best thing to hold. And so that leaves you in a spot where you can both believe the stock market could do pretty well and say, well, most people are actually over-concentrated there and would actually do well to have some sense of diversification, because it's not like there are never risks. There are always risks you can't foresee. You could have risk to growth, you could have risk to inflation, you could end up blowing up a bubble that, obviously the bubble that burst in 1999 was very, very bad for people's portfolios for a long time. You don't want to be undiversified even with a positive outlook for the stock markets.
So are you recommending that clients buy now into the next year? How are you recommending clients position themselves?
I see very few people that need to buy more because people are so positioned in the stock market. So I both think the stock market is attractive and that on the margin, the next trade people need to make is usually to something else for more diversification. I'll give you an example, right? Like it used to be that kind of a median portfolio was kind of like a 60-40. I hold stocks, I hold bonds, I hold about 40% bonds. Very few people hold that. That median 60-40 has moved to maybe even 80-20. And I think there was good reason for that. For a while to kind of say, wait a minute, what am I really getting out of my bonds, right? Yields are so low. What's the point? If there's a big shock, the way bonds usually can help me is that the Fed can ease into that. Can they really ease when rates are already zero? Why am I holding this? Clearly not the case today. Today, you could say, if there is a big shock, bonds could actually help you. And then the flip side of that, bonds can really help you only if the shock is more of a growth shock. If the problem is inflationary, bonds aren't going to help you. People have very little inflation protection. And so I think the next marginal move that most helps our clients is either moving to something that'll help them to growth shock, like bonds, moving to something that'll help them to inflation shock, like gold, or a little out of the box, thinking, where can I be in the world that is diversifying? How can I geographically diversify so if there's a problem in the US, I'm just less likely to hit it in another geography?
If people are already so exposed to stocks right now, does that put a cap on the amount of upside that we could see over the next year? Because if people have already deployed all of their cash into the market, what are the odds that we see a repeat of what we've seen this year?
I think that valuations and how much money is deployed does sort of cap stocks to a degree, unless you get such a blow up in expectations, like a real bubble, kind of expanding. And I think one of the easy ways to see that is you look at what is the earnings growth that would be necessary for stocks to perform much better than bonds. And the answer is it's pretty high earnings growth. And so I think companies could do really well, deliver great earnings, and still holding stocks will just kind of be mediocre because it's already in the price, it's already expected. And this is very classic. When you have a lot of period of good performance, usually it starts out, like we did after great financial crisis, with very low expectations. It's easy to beat them. But once you beat expectations for a long time, it starts pricing in those expectations are going to come again, right? And so at this point, the US could do great. We could have a strong economy and continuing expansion. Companies could deliver, and still stocks could be just kind of so-so because the price is already, kind of expecting that. And you could still do better actually holding stocks potentially of countries where they could do a lot worse economically than us, but just expectations are low.
Do you see more volatility next year?
Look, I think that when you get a new set of policy regimes, it's always a possibility of volatility because you just don't know exactly how the policies are going to hit. And so I think that Trump's presidency, in many ways, the type of policies he's doing were already in the air and would have happened with him or without him, right? More protectionism, more of, I'd say, a shift from a sense that it doesn't matter what our economy produces. As long as we have a strong economy, who cares what it produces? Saying, no, it really matters what it produces. We care about the composition. We want manufacturing here. We want to have certain exposures where we control our access to things like critical minerals. Between that and protectionism, those things would have been kind of in the air under a Harris administration as well. But no doubt that Trump and his administration are going to accelerate that, are going to push harder, are going to try to go more extreme, are going to try to really move the agenda forward. And so you just don't know what kind of volatility that'll generate. And I think with any shift, we're in such a broad shift of just where we are geopolitically. Thinking that volatility is possible has to be in your map. I'll use oil as an example, right? Which is, on one hand, you say, look, there's a lot of oil in the world. It's very rare to have as much spare capacity as there is today. The Saudis are kind of sitting there saying, if you just give us a chance, we'd love to pump more oil into the market. We just don't want to get prices too low. At the same time, you have a Trump administration that doesn't love the idea of Iran having as much oil as it does in the markets and could easily tighten sanctions on it. You have an Iranian regime that you can't call predictable. So is it a high probability that you'll get a huge geopolitically driven move in oil? I don't think it's a high probability, but it's certainly possible, and it's certainly the kind of thing that you'd want to have, perspective on whether that could happen to you.
Lightning round.
Okay,
so the yield on the 10-year Treasury is up, better than 70 basis points since the Fed first started cutting. The Fed's already cut 75 basis points. What do you think that means for markets? What is your outlook for the yield on the 10-year? Is there a certain level on Treasuries that causes stocks to fall?
I think it's just about right now. I think that upward yield made sense. The Fed will have a hard time easing as much as was priced in a few weeks ago because it's such a strong economy, because inflation's it's not as low as they want it to be. I think that repricing was about right. I think it's pricing in the fiscal stimulus that's coming, the fact that more is going to be issued, that it's about right. And the reason it hasn't hit the stock market is very simply because if the yield is rising partly because growth is going to be stronger, that effect's going to be stronger on the stock market.
But is there a certain level that causes stocks to fall? If we hit 5%?
I think it's much more the reasoning, right? Like if you get a repricing to 5% because inflation is sticky and the Fed has to actually tighten conditions to stop the inflation, that's gonna be very bad for stocks. If it gets to 5 because growth is just booming, not necessarily.
Gold, where do you see gold going? Do we hit 3,000 next year?
Look, I like gold a lot. I think that it's fallen in the last couple of days for reasons that are partly just positioning reversals or partly what's happening to yields to the dollar. There's just a lot of people around the world that have realized that the dollar is not necessarily a safe place for them to be from a geopolitical perspective. And it's very hard for them to move the price of big markets like the dollar, but it's very easy to move the price of gold. And so that's a lot of buyers. And while yields were rising, there was a natural seller, which is people sat in the United States and said, why would I hold like a shiny rock rather than something that pays me a yield? But yields aren't rising anymore. I don't think I have a reason to rise a lot from here. There isn't a natural seller the same way. A lot of natural buyers. I like gold.
Crypto, Bitcoin's all-time highs. Coinbase's stock up some 70% over the last 5 sessions. Where do you see the price of Bitcoin going? Do you have any recommendations? What are you telling your clients about?
It's honestly not something we have invested in, and so I don't feel qualified to give a recommendation.
All right, last question. What about oil?
As I said before, I think kind of the median case is that oil probably kind of stays range bound, is weak. There's just a lot out there, but you just have these potential upside risks that have to do with enforcing the sanctions or what might happen geopolitically. And so I like oil and general commodity exposure alongside gold as something to have in your portfolio if there is stickier than expected inflation. It's a nice inflation protection to have. If you look at the last, if you look at every time the stock market's fallen, call it more than 15%, so it's actually impactful to people. You could more or less split those into 2 camps. Ones where bonds really helped you because the problem was growth and the Fed could ease, and ones where commodities and gold really helped you because the problem was inflation, the Fed couldn't ease into that, and you really want inflation protection assets. So I like having those things in my portfolio.
Karen, we'll have to leave the conversation there, but thank you so much for your insights. So appreciate it.
Thank you.
I want to thank Karen and Jen for that conversation. Really valuable insights across different asset types. And as we continue to think about different asset types that people hold, let's go into a little bit of a real estate conversation. Just briefly here, personal story, I guess. I'm at the age, I guess, where I have trouble, or I set a cap at least, on the number of new friends that I want to make in a year, honestly. Like, let's be real. You get a certain age and you just have too much going on. But one of the criteria is you need to follow Zillow Gone Wild. And it's a crazy criteria, but hear me out here. Like, if you can't at least theoretically have a conversation with me about maybe pulling together assets and resources and going in on a house that looks like it's where they shot John Wick, we can't be friends. That's it. But one of the amazing things that we've been able to see for many people is how they look across everything from Redfin to Zillow and look across existing homes and also recognize where there need to be new homes built as well. And here's where we get into our next conversation, because for many, home equity right now is the largest investment made during a lifetime. And for many, they are facing an affordability crisis and challenge here. So how can we ensure that a core pillar of the American dream is able to be passed on to future generations as well? For this conversation, let's bring in Margaret Anadu, who is the senior partner of the Vistria Group and Yahoo Finance anchor, Julie Hyman.
See, I thought Brad was going to say the rent is too damn high.
I thought he was going to say he wanted to be friends
the
with
rent.
me.
For those of you who are New Yorkers, you know what that's all about. Margaret, the rent is too damn high for a lot of people, which is where you come in.
Yeah.
So, Margaret, for those of you who are not familiar with her work, worked at Goldman Sachs for some 20 years and left to join the Vistria Group. So tell us about Vistria and why you decided to make that move and what you're doing there.
Sure. And thanks for having me. This is a great discussion. So the 20 years I spent at Goldman, the majority of that time I was investing in areas where we thought we could do two things. One, generate an incredibly strong return, but also do so in a way where we could be productive for individuals, families, communities, whole neighborhoods at the same time. And so a significant amount of that work was in real estate, and a significant amount of that work was in affordable and workforce housing. And so in my last couple of years at Goldman, I realized that relative to the opportunity set, the amount of institutional vehicles dedicated to not just housing, but affordable and workforce housing with a dedicated strategy wrapped with real expertise around the area was quite frankly close to zero. And so the Vistria Group, which is a private investment firm headquartered in Chicago, we invest in three things. So we invest in companies, we provide private credit to companies, and where I'm focused now, investing in real estate. We do that all around the thesis that by being, first and foremost, investing in these heavily regulated sectors that have a significant impact on people's lives, right? Healthcare, education, financial services, and now real estate, we can have a really positive impact on, quite frankly, society at large through those areas. And so that's what I'm doing now, real estate at the Vistria Group.
So give me some of the examples, give people some examples of the types of projects that are now in your portfolio.
Sure, so just keeping going with that, the rent is too damn high. Many of the projects we're invested in do kind of three key things. One, we invest in existing affordable and workforce housing. So there's an existing stock around the country that needs to be managed well, where we can introduce residential services, where we can do important work like increase the sustainability of these assets so they not only are more environmentally sustainable, but also just fundamentally operate better. And then two, we actually add to the existing of affordable and workforce housing stock through the traditional way, new construction, so building new units, but also one of the areas I've been really excited about recently, taking market rate housing and converting it into affordable and workforce housing.
How do you do all of that, keep the housing affordable and make it profitable without raising the rents?
Sure. I mean, one of the key, I would say, misconceptions around the space is that you can't, and actually across a lot of the work that we do, is that you can't do this work in a way that is economic and profitable, but also meet your other objectives as well. And so really the secret sauce, if you will, in the real estate work that we do is partnering with government. So both at the federal level, state and city level, we work with the public sector to identify the sort of part of the spectrum where affordable housing is needed. In a place here like New York City where we're sitting, it's at the very low end of the income spectrum, quite frankly, to the really top of the middle class can't afford housing responsibly in New York City. And in some areas, it's really just at the low end. So we work with public sector to structure deals where we can put in long-term affordability agreements and structure that in a way where the investments are also profitable.
In your view, how did we get here? There's a lot of talk about a supply crunch has created the affordability crisis. Of course, rates, mortgage rates are still relatively high, but that's not necessarily directly tied to rent. Why has it become so acute?
Yeah, and it's interesting because there's been so much, I think, more mainstream conversation around the affordability crisis. I would say over the last few years, certainly
We talked about it a lot during COVID, but we really started getting here much earlier. So it's fairly simple. If one, we haven't built enough and wages haven't sort of kept pace. But if you just look at a few key numbers, so the amount of homes we were building sort of right up until the GFC, roughly 2 million homes a year. That, of course, plummeted in the global financial crisis. And even as we rebounded coming into COVID, we still only got to about 1.2, 1.3 million homes. So we are still not, as a country, producing the amount of housing that we were before, and that we need to keep pace with household formation and just the steady growth you need to keep pace. And then on the other side of that, you have the other issues just on the cost side. Labor's more expensive. Construction costs are more expensive. There's a set of sort of zoning and land use bureaucracy around the country, and certainly at the local level, that also makes housing construction take more time. And as we know, time is money. So it's really about not having enough supply, real wages being flat, and just quite frankly, never really getting back to the level of production that we had 15, 20 years ago.
Now, Bank of America CEO Brian Moynihan, many of you heard that conversation. He brought up the idea of, well, I guess a couple of things. Incentivizing new construction in order to try to alleviate the housing crisis. That's something that Vice President, of course, Kamala Harris talked about on the campaign trail a little bit. And the other issue is the permitting issue that you brought up as well, making it easier to build new construction. How do you attack those? Do you think incentives is a good method? And are these things being alleviated at all?
Yeah, one of the things that's difficult about really addressing the issue around the country at scale. You mentioned Kamala Harris's proposal, certainly speaking from the federal perspective. But when you look at much of the zoning, land use, entitlement process that really does slow us down around the country, it's really at the local level. It's city level regulations, county level regulations, and state. And so the idea that we could have a silver bullet from a zoning and entitlement perspective that comes down from the federal government, I think is pretty tricky. Now, there's certainly things that the federal government can do, but I see more productive areas there in things like rental assistance, the work that they can do in financing costs with the GSEs through Freddie and Fannie. But entitlements, zoning, those are really a local game.
Just to keep it on the federal level for a minute and talk a little bit more about the election, this was definitely billed by some as the sort of anti-woke election, right? Elon Musk railed against what he called the woke mind virus. And the work you do at Vistria as a whole sort of identifies itself as a purpose-driven firm, right? That is making these types of investments, right? In that sort of way. Do you think that kind of work is in danger at all under this new administration, either sort of directly through regulation or philosophically?
Yeah, it's a tough question because first just thinking about the sort of woke or anti-woke, I don't know that anyone, regardless of their political persuasion, would think that people being able to pay their rent is woke, or people having access to quality health care is woke or anti-woke. So I don't. It's hard to think about the work we do on that spectrum. I would say, sort of zooming out a bit from a political perspective, on the housing side, one of the things we've seen, and it's a bit of a consequence of just how deep the crisis have gotten. We are working on really important structures in places like Texas, just as much as we're doing them in California, as we're doing them in New York, in Florida. And so what you're seeing, the idea that we want, individuals and families to be able to pay their rent and then invest in all the other things that are important for their lives, it's not red or blue or conservative or liberal. I think it's gotten to a place where it's bipartisan, and it's really about all of us as a whole.
Also, as you talked about, part of the work you do is making these buildings more sustainable. In many cases, are there federal level incentives that you take advantage of on that front that could be jeopardized?
Yeah, there are some that have become a topic in the news. One of the things that I think, again, from both a red, blue, bipartisan perspective, one of the programs from the last administration, the Greenhouse Gas Reduction Fund, was a pretty large program that entities could utilize to reduce or avoid greenhouse gas emissions. And there was a lot of talk and excitement about what impact that could have in the affordable and workforce housing space. I think that one's an issue. But, at the same time, we saw similar incentives, again, at the state and local level. So there's some things on the margins that could move. But I think just the fundamental issue of housing being a focus from both sides, I can't see that changing anytime soon, regardless of, quite frankly, the outcome of the election we just had.
One of the other areas that has become political at times or has sort of come under bipartisan criticism at times has been the private equity investment in housing. Now, I believe most of what you do is multifamily.
Yes.
And most of the subject of the criticism has been private equity investment in single-family housing, for example, as maybe something that is driving prices up or keeping prices high. How do you think about that issue, and how would you respond to that issue?
It's such a nuanced issue, and like all these things, it has multiple sides. I think the criticism around private equity in single-family rentals is rooted in this idea, like you said, that private equity is owning these homes and communities and making them more expensive.
It's sort of crowding out investment.
But you also see the flip side that many of these typically majority single-family home ownership communities with their great public schools and other amenities that private equity and single-family rental has actually provided access to folks to be able to rent those homes to individuals and families who would never be able to purchase them. And so on all these issues, it really gets complicated. I would say that the bigger issue that I think is really important, regardless of whether a single family home is rented out by a mom and pop or rented out by a larger private equity firm, the issue is how do we drive affordability? Because I'm sure you could find several mom and pops across the country who are renting out homes at prices that people can't attain. So I think, again, it's about getting to the issue of how do we drive housing to be more affordable and less focus on who's the owner of that home.
I was listening to Tom Steyer earlier, who was talking about climate investing.
Mm-hmm.
And something that he talked about sort of resonated with me, and I think would resonate with you too, where he made the point, like, you still have to make money on this stuff.
Oh.
It's not like you can donate to a charity that's going to work on some of these issues, and you can also invest in some of these things and get a return. So how do you, when you're making these investments, how do you sort of weigh, okay, I'm doing this because I want to make this affordable, and I also need to make a return for myself and my investors out of this?
Yeah, so first and foremost, on the affordable and workforce housing side, it remains the most supply-constrained part of the multifamily market by far. So in terms of just the risk-adjusted returns that you can achieve, they're phenomenal. So whether someone is motivated by a personal passion around societal issues or really cares about the affordable housing crisis, it's just a space to invest where you can make strong returns. And part of that is about a different supply-demand imbalance. When I look at just the capital need to get out of this just pure supply problem we have, plus the capital that's required to really just fundamentally restore and upgrade our housing stock across the U.S., we're not talking billions, we're talking trillions. And so Tom Steyer's point about the charity, it almost becomes irrelevant because there's not enough charity to build the amount of housing we need. And so I think charity's not an option. Charities is amazing to innovate around new issues.
And to be clear, his point is you have to make money. This stuff has to make money. That's the bottom line.
Well, and I guess I agree, because when you have a capital need starting there of $1 trillion+, there's not charity to fill it. And it is a great fact that you can do this work and also generate a really strong return. So I spend less time in that debate of kind of charity versus returns because the returns are there. And quite frankly, the returns need to be there to attract the amount of capital that we need in the space.
Are you optimistic?
I am optimistic because I choose to be. I think one thing, and I have been saying this for the last few years, there was a time, and 7 years, 10 years ago, we wouldn't really be having a conversation about affordable housing. It was people felt like it was such an issue in New York City and San Francisco. It was, all about the gateway markets. And I think I'd love to hear what you guys think, that it is now kind of well understood that the rent being too damn high, the percentage of renters versus owners in the country also being at an all-time high, that is an issue that is urban, that is rural, that is Midwestern. And so I think that gives me optimism. Once you have sort of a coalition and a tent and just a broad base of not just individuals trying to pay their rent, but also on the policy side that understand it, I think that's when you have real innovation and progress. So yes, I am optimistic.
And do you feel like the states, I mean, you mentioned obviously blue, red, whatever states, different places. Do you feel like by and large the policy on that level is moving in the right direction?
I do, and there's so much creativity around it. So for example, one of the places where we've seen less activity over the last few years, just with the rapid rise in rates, was around new construction. So you have the entitlement issues, the zoning issues. It takes a long time, and construction loans are a lot more expensive than they used to be. We've seen so many cities and states around the country say, okay, well, we're not having the new supply that we've had. What can we do with our existing stock? And so one of the new tools, and we've seen this in Illinois, Florida most recently, Georgia just enacted a new program. How do we take our existing stock, let's bypass 3 years of entitlement and construction, this and that, and figure out how to make our existing stock more affordable? And I think that's a one-way trend. So we do see more innovation and also a lot of collaboration across cities and states and mayors saying, what are you doing that's working? What can we try? And I think that'll continue.
One of the other themes that I've heard a lot about today is investing in private assets, and obviously real estate being one of those, diversification, getting into other things. For the Yahoo Finance audience who says, I can't click on a stock and buy what Margaret is doing, what are the ways they can think about potentially getting into that market? Are there ways that market is getting more accessible?
Yeah, this is a tougher one because I think we're in the, you always see these things get heavily adopted by institutional capital and then sort of find its way, to high net worth and then further into retail. And I think, at least in the work that I'm doing, we're honestly in the early stages, even on the institutional side. So I mentioned, we think about the capital gap or opportunity, if you will, as between 1 and 2 trillion. When you look at dedicated institutional funds focused on the space, it's less than 10 billion in total. So I think we have a ways to go in our space before we're getting to that level of access, but I do think we'll get there.
And the growth that you're talking about, I think you told me you have about $2 billion in assets in the value of your portfolio right now.
I think I'll get killed by the SEC
if
I answer that.
Never mind. I'm just kidding. What I was going to ask is bad
joke.
How much opportunity do you see for what you're doing? For how much growth you're expecting?
Yeah, so we think we can put about $1 billion to work in affordable and workforce housing each year, and still be nowhere near kind of eclipsing the opportunity, if you will.
All right, Margaret, thanks so much.
Thanks for
having me.
having
We won't get you in trouble, don't worry.
Thanks so much, Julie and Margaret, for that conversation. As we continue this afternoon here, go with me for a second here. Prior to a CPI report in 2023, and since Julie was just up on stage, I'll bring her into this story as well. Julie shared with me the work of an unsung economic pundit, Ernest Jackson and Sugar Daddy and the Gumbo Roo, who wrote a song which simply asked, inflation, why don't you get out the nation? Our next guest, alongside FOMC committee members, has a direct line of communication into the very decisions on maximum employment and price stability. Please welcome Neel Kashkari, who's the president and CEO of the Federal Reserve Bank of Minneapolis, and Yahoo Finance senior reporter Jennifer Schonberger.
so much for being here today. It's great to have you.
My pleasure. Thanks for having me.
The economy keeps surprising to the upside. We got third quarter GDP of 2.8%, driven by strong consumer spending, up 3.7%. We've seen household incomes, savings revised upwards. Can this strength continue into next year?
I think so. I mean, that's you, in your question, you said it correctly. We continue to be surprised by the resilience of the U.S. economy. 3 or 4 years ago, if you'd said to me, we're going to raise interest rates by 500 plus basis points, I would have thought that would slam the brakes on the U.S. economy. It hasn't. The economy's been remarkably resilient, which is a really good thing. So in the last couple of years, we brought inflation down, not all the way to 2%. We're running at about a 2.5% rate, and the labor market has remained strong. Right now, it looks like that's going to continue. I do a lot of outreach to businesses, large and small, across my part of the country, to labor groups. They all share cautious optimism, and so right now the fundamentals seem strong, and I'm optimistic that's going to continue.
How do President-elect Donald Trump's proposed policies, from across-the-board tariffs to mass deportations, tax cuts, and deregulation, influence your outlook for the economy, understanding that we don't quite know the exact timing and extent of the implementation of these policies?
Well, there's so much uncertainty about what any new administration is going to do, ultimately what they're going to do in negotiating with Congress. We at the Fed simply have to wait and see. Whatever the Congress and the executive branch decide to do, we will then model it into our analysis of the economy, analysis of the economy's potential and outlook for the labor market and inflation. But until those policies are decided upon, until they become clear, we can't do anything. And so we're just going to wait and see.
On the proposed tariffs, we know that the president-elect has said that he's looking to impose 10% tariffs on all U.S. imports, 60% tariffs on all Chinese imports. If that scenario were to go into effect, what impact would you expect on inflation and supply chains?
Well, on inflation, just step back from those specific proposals and just think about how tariffs work. A tariff, generally speaking, from an inflation perspective, we think of as a one-time increase in prices. So if you have a 1% tariff, you could think of it as a 1% increase in prices of those goods that are subjected to the tariff. That by itself is not inflationary over the long run. It's a one-time change in the price level. Where it becomes complicated is how the other country responds. So if there's a tit for tat and an increase in tariffs from the US, a response from other countries, and it goes back and forth, then you could imagine a longer-term inflationary impact. And so right now, as I said a moment ago, it's uncertain what the proposal will be, what will get implemented, and then, importantly, how other countries will respond. Right now, we're all just guessing, and so I can't opine one way or the other.
Sure. When it comes to immigration, that has been a big part of the resiliency of the job market the past couple of years. It certainly helped with the labor shortages that we've been seeing. The president-elect has proposed mass deportations. Again, we don't know the extent of this policy, but taken on its face, generally speaking, what impact would you expect on the job market and wages?
Well, if you just start by assuming that the vast majority of immigrants who are here are gainfully employed, then at the extreme, those businesses would lose those workers, and that would provide some form of disruption to those businesses. I ultimately think what will end up getting implemented will be a negotiation between Congress, the executive branch, and business. They will figure out a way to do whatever that they've decided to do, and then we will have to respond. And so I'm not here to opine positive or negative, but ultimately it could have a big effect, but we need to wait and see on what ends up actually happening.
Let me ask you about your outlook for inflation. You said earlier this fall that you weren't too worried about upside risks to inflation. You cited wages and core non-housing services prices that continue to fall. But core PCE, your favorite inflation gauge, has been stuck at 2.7% for 3 months. So how confident are you that inflation is still falling to your 2% target?
Well, we break inflation down by its subcomponents. So goods inflation is running roughly back where it was pre-pandemic to slightly disinflationary levels. If you look at other parts of services inflation, they're tied to wages. Wage growth is slowly cooling. Housing inflation is the big elephant that is still out there. And if you look at where new leases are, new lease inflation has already fallen back down to very low levels. But new leases take a couple years to work their way through into the broader measures of housing inflation. So, I don't want to declare victory too early, but I think there's pretty good reason that we have confidence that the housing piece of this will slowly return back down to more normal levels. Ultimately, we're going to get back down to 2% inflation. It may take a year or two to get all the way there, given some of these housing dynamics, but the trends so far are encouraging.
What about the job market? We've seen a lot of volatility in those monthly jobs reports. The October report slammed by those two hurricanes, the Boeing workers' strike. How are you looking at the labor market now?
Well, the labor market, as we mentioned a few minutes ago, has been surprisingly resilient. A 4.1% unemployment rate. It's a good labor market. When I meet with, again, not just businesses, but also labor groups around my region, it's one of cautious optimism. I mean, a bunch of labor unions that I've met with recently have said that they're feeling confident enough that they're going to have some actions taking place, meaning they're preparing to strike. They're feeling like they're in a strong position. Usually I don't hear labor unions talking about that if they're feeling like the pendulum has swung away from labor. So most of the dimensions that we look at, the labor market is still strong. It is not as red hot as it was a year or two ago, but the fundamentals are still sound. And so that's encouraging to me that the labor market looks robust and consumer spending continues to surprise us. Consumers continue to be resilient. The fact that the savings rate has been revised up is also encouraging, suggesting that consumers on average are not getting overextended. So right now the economy looks like it's in a strong position.
So then what does that mean for the rate cutting path forward? You said earlier this week that another rate cut in December is certainly possible. What would make a rate cut not possible in December?
Well, I think if we saw inflation surprises to the upside between now and then, that might give us pause. If the labor market, it'd be hard to imagine the labor market really heats up between now and December. There's just not that much time. I think there'd have to be a surprise on the inflation front to change the outlook so dramatically. The bigger question long run is where are we going to settle? What does neutral represent? One big surprise over the past couple of years, if the economy has been more resilient than I expected in the face of this high policy rate, how do you answer that question? Why has that been the case? The answer that I'm taking away is maybe the neutral environment, the neutral rate environment has gone up, at least in the short run. Now, how long is that higher neutral rate environment going to persist? I don't know. A helpful data point over the last couple of years is productivity looks like it's been stronger. If productivity is going to continue to be strong, all else being equal, that would relate to me to be a higher neutral environment. Think about what sets the neutral environment. It's the balance between savings and investment. And if the productivity environment of the US economy is higher, all else being equal, there should be more demand for investment capital to fund those productive investments. So in a higher productivity environment, the neutral rate ought to be higher. And so if we are in a structurally higher productivity environment, that would tell me we have less room to cut until we eventually get back to neutral. I'm not saying we're very close to neutral right now, but when we think about the destination, we may not go down as far.
So given what you just said, we know the consensus of the FOMC is for 4 more rate cuts next year. Given the strength of the economy that you expect it can continue, given your comments just now on neutral, do you see fewer than 4 rate cuts next year?
We have to see what the data says. I mean, ultimately, the data, one thing that Chairman Powell says is the neutral rate is not directly observable. We know it by its effect on the economy. And so we're going to continue to monitor the labor market, inflation, GDP, spending to try to ferret out how close are we coming to neutral. I think we all agree we are above neutral now. But over the course of the next year, we're going to get a lot more information about where neutral is. And we're also going to be looking at market signals in terms of the real yield curve. Where is the long end of the real yield curve? That's giving us some feedback as well.
Let's get to the yield curve in a minute, but I'm curious whether Donald Trump's election changes the terminal rate forecast for you.
We have to wait and see. We have to wait and see what ultimately gets enacted by the Congress and by the executive branch before we determine anything. Obviously, the long end of the yield curve has moved a lot since we started cutting rates, 6-8 weeks ago. The long end of the curve has moved a lot. It doesn't look like that is in long-term inflation expectations. There's been some move in short-run inflation expectations, but long-run inflation expectations do appear to be well anchored. Could that be a view of that productivity is higher and the neutral rate is higher? That's probably part of it. Some people have speculated that maybe there's expectations about more deficits to come. We'll have to see. There are a bunch of different components in there that we need to try to strip out to understand what markets are telling us. And the thing that gets complicated for us is that we look at markets, but a lot of times markets are looking at us. So it's a little bit like we're looking in the mirror. So trying to ferret out what is a real signal and what is just a reflexive signal, it's an inexact science.
How restrictive do you think you are right now?
I would say, in my judgment, I think we're modestly restrictive. just by the virtue of the fact that we went up to 5.25% and the job market remained as resilient, that tells me we could not have been very, very restrictive. So instead of, while I thought we were putting 2 feet on the brakes, I think in hindsight we were probably only putting 1 foot on the brakes. And what's really difficult about this is this notion of a neutral rate. It appears to be time varying. So yes, the neutral rate has been elevated in recent months or the last couple of years. How long is it going to stay there? We're not sure.
You mentioned the yield curve, the yield on the 10-year Treasury up better than 70 basis points since you first started cutting, and you've actually cut by 75 basis points. So how does that complicate your job if this persists? And where do you see the yield on the 10-year going?
Well, it complicates it. Trying to assess, this conversation we're having is a lot about trying to assess how restrictive is the stance of monetary policy. And I always think that there's 4 components, 4 instruments that we have in monetary policy. There's the federal funds rate, there's the path, the expected path of the federal funds rate, there's the balance sheet, and the expected path of the balance sheet. All 4 of those are individual tools that go together that represent the stance of monetary policy. And I look at the long end of the real yield curve, so say 10-year tips, as a proxy that puts all of those components together. 10-year tips today is something around 2%. Prior to the pandemic, it was roughly around 0, which at that time I thought was roughly a neutral stance. In the middle of the pandemic, with all the stimulus, we drove it down to -1. It then went up to about +2.5 and is now running at around a 2% level. So right now at a 2% real tips rate at the 10-year, the economy is still performing pretty well. And so we're going to need to watch and see. Again, it goes back to, are we in a higher productivity environment? Are we in a higher structural growth environment? Can the economy grow with this type of real yields? We're going to have to see, and it's going to ultimately be a judgment call as we take in the new data and adjust our policies in response.
The trajectory of debt is not a good one. We're close to 100% of debt to GDP, and it's rising. It's expected to continue rising under the new administration and would have under Harris if she were elected as well. I'm curious, does the trajectory of put the discipline of fiscal policy to rein it in, or does the central bank feel pressure to try to offset that trajectory as far as long-term rates?
Well, first, if you look at the Congressional Budget Office's forecast of the debt over the next 20 years, it goes to the moon. It grows unsustainably. And that obviously cannot happen. So ultimately, Congress and the executive branch will need to work together to come up with some kind of a plan to address that. Our job is not to comment on that, not to opine on it, not to offer suggestions on what they do. That's up to them. Our job is to achieve 2% inflation. And that's what we're going to do. And so we're going to do what we need to do to achieve the dual mandate goals that Congress has given us, given the rest of the macro environment that we are recipients of. And that fiscal path is part of the macro environment that we are recipients of. And so that's going to be the job of Treasury and the Congress to sort out. And we will do what we need to do to achieve our dual mandate goals.
If you get too much volatility in the Treasury market, would you stop the balance sheet runoff?
I think for me, the bar of stopping the balance sheet runoff would be quite high. I mean, we've done it in the past. In the last time, when 2019, when we were shrinking our balance sheet, we were the only central bank in the world shrinking their balance sheet after the great financial crisis. And then we were draining reserves out of the banking system. We had, I think, underestimated how many reserves the banks were going to require. And you ended up seeing volatility in the Treasury market and in the federal funds rate. And then we stepped in and intervened at that point. I think we've gotten better, and we're going to be able to avoid that this time. But my judgment is we still have a ways to go before the Fed is done shrinking our balance sheet.
So if there is a lot of volatility, to be clear, would you intervene in the market?
It'll depend on how extreme the volatility is. Ultimately, financial stability is part of our mandate, and financial stability is the Treasury market is part of that. But I think the bar for me would be quite high before we would change our path.
If President-elect Trump tries to pressure the Fed to lower rates, and the Fed doesn't feel that that is the correct course of action, how would the Fed respond?
My colleagues and I are totally committed to achieving the goals that Congress has assigned us: maximum employment and 2% inflation, and we're going to conduct monetary policy to achieve that. And the thing is, the Federal Reserve was designed by Congress in 1913 with specific institutional structures in place to provide continuity. So the governors in Washington get up to 14-year terms. 14 years is a long time. That provides continuity. The 12 Reserve Bank presidents are independently appointed. That also provides continuity. And so I'm confident that we will continue to focus on achieving our economic goals and not responding to whatever pressures might be coming from Washington.
If the president-elect tries to push out Fed Chair Jay Powell, what will the FOMC do? Would the FOMC try to rally around to keep him in place?
I'm going to defer to the chairman answered this question last week in his press conference, and I'm going to defer to his comments there. I don't have anything to add to that.
All right. I want to circle back to tariffs for a second, because the last time Trump was in office, he had slapped tariffs on China. And in that environment, granted, it was a different economic environment. We saw slowing growth, but you guys were lowering rates. And there's a common belief that tariffs could be inflationary and therefore interest rates could go up. So my question to you is that necessarily the case given what we've seen just some 6 years ago?
Well, we were talking about a few minutes ago, I think the analysis of a one-time tariff is pretty clear that that's just a step change in the price level. People will pay higher prices, but that doesn't mean inflation is higher going forward. The real question is the tit for tat between countries. If they go back and forth, escalating tariffs on each other, that could lead to a longer-term inflationary dynamic that we'd have to consider at that point. So I really think it's going to depend on the dynamics of what's happening as opposed to just this hypothetical.
If you did see more inflationary dynamics, would that cause you to consider hiking rates, or would you be looking more towards a lengthy pause?
It's going to depend on so many different things. I mean, ultimately, we have our goals, maximum employment and stable prices, and we're committed to achieving them, and we will use the tools that we have to achieve them.
Any last thoughts when it comes to the trajectory for monetary policy as we get to December and next year?
I would just say the U.S. economy is in a good place. We've cut interest rates by 75 basis points to try to bring it back down closer to a neutral environment. We're not at neutral yet. We're still in my judgment, we're still at a modestly contractionary stance. But ultimately, the economy will guide us in terms of how far we end up needing to go. The labor market is strong. We want to keep it strong, but we need to get inflation all the way back down to 2%. And I'm confident we can do that.
Neil, thank you so much for your insight. So appreciate you being here today.
Thanks for having me.
Thank you so much, Neil and Jennifer, for that conversation. And continuing in that same thread and frame of mind right now, let's just dive right into it. Our next guest was actually a former candidate put forward by now President-elect Trump and then current President Trump at the time for a Fed seat. Joining me now and joining us now here on stage, we've got Yahoo Finance Executive Editor Brian Sozzi, alongside Judy Shelton, Senior Fellow of the Independent Institute, and Yahoo Finance Executive Editor, as I mentioned, Brian Sozzi.
Interview I'm doing with no notes because I just want to see where it goes.
I like it.
I feel this that'd be a good format for you. So you heard Neil just talking about inflation, rate cuts. What do you think about the Fed's dual mandate?
Well, I think that the Fed is straightforward in saying price stability is a responsibility of the Federal Reserve. And that sounds good, even sounds noble. But we've gone through the worst inflation in 40 years. And when it comes to accountability, I'm not sure of people being reimbursed for the loss in purchasing power. I don't think anyone got fired at the Fed. And I think this is an interesting time when people are looking at the appropriate role of the Federal Reserve in a free market economy and maybe rethinking whether we want to have the interest rate, the most important price in a capitalist economy, the price of capital, do we want that to be set by a dozen people voting 8 times a year and deciding what it should be versus, say, having free market forces, demand and supply, allocate capital and establish interest rates? So the other part of the dual mandate, maximizing employment, on the Fed's own website, they state that employment is really a structural matter. And it's not that they have that much influence over it. And both of these aspects of a dual mandate come out of legislation from 1977 and 78. That same legislation called for a 3% unemployment rate by 1988 and 0% inflation. So I also wonder, how is it that the Fed decided that everyone should lose 2% purchasing power every year? I don't know that Congress would have approved debasing the money unit by design. The fact that they don't hit it and haven't made it to the target, I think begs the question, can they finesse all that? But also raises the issue of, if their mandate is stable prices, why doesn't that mean no inflation?
Well, how concerned are you then about the Fed potentially, you heard Neil talk a little bit about the conditions that would be needed to pause with one more rate cut in December. But what if the Fed goes down the path of cutting rates in 2025? Where is this country in terms of inflation?
Well, it's interesting. The Fed is working off of 2 frameworks now. The first one was in effect for the first 8 months of this year. And every time you had strong growth and low unemployment, the Fed said, this is why we have to keep restrictive interest rates, because we're fighting inflation. So that, to me, is a double whammy. And to working people, first they suffer the inflation, and then they suffer high borrowing costs. And that doesn't keep the government from borrowing. The government pays whatever they have to. It's a treasury auction to raise the money to finance deficit spending. So the effect of high interest rates through restrictive monetary policy and fiscal stimulus because of the deficit spending is to take power away from the private sector and move it toward the government. So I think it's a very unhealthy combination. In September, the Fed switched gears. And suddenly, after going 8 meetings at the highest interest rate level in 22 years, they didn't just gradually say, well, we think we might begin cutting. They did a jumbo cut, 50 basis points. Almost immediately, the data that came in suggested it was unwarranted. The labor market was not weak. There didn't seem to be any reason to panic. But the Fed said now they're trying to recalibrate and get back to a neutral rate, that they've effectively dealt with the inflation problem. Now, if I thought a neutral rate meant a market-determined rate, if I thought it meant what would the rate of interest be if the Fed wasn't trying to manipulate it to be either higher than it should be or lower because it was trying to restrict or stimulate, I would be happy. That kind of approach would dovetail with the incoming Trump administration, because that would be a supply-side approach. That would be saying, if you're going to have lower taxes, less regulation, you are empowering the private sector. And the goal is to also have reduced borrowing costs so that entrepreneurs can expand plant and equipment, they can hire people, they can start new businesses, and all of that feeds output. And if you have greater supply than demand, that is how you reduce inflation. But the way the Fed fights it, they say we can't do anything about supply without acknowledging that high borrowing costs are an obstacle to people who would otherwise expand production. They just say all we can do is cut demand. So that's why they raise rates. And I think that's a fundamental problem with the Fed's model.
If you had President-elect Trump on the phone today, what would you tell him in terms of what he needs to do? What changes do you think should be made to the Federal Reserve? And does one of them include waving goodbye to Jerome Powell?
Well, I would not try to tell President Trump what to do. I might point out, he has not said he was going to fire him. I thought it was unseemly, almost belligerent. There could have been a much more gracious answer when Chair Powell was asked what he would do under those circumstances.
No.
He said no. One word, steely-eyed. And it was sounding like a shootout at the OK Corral or something. I didn't understand why he would say, he can't fire me and I refuse to resign. And I think partially this is a media-invented scenario of this tyrannical president who's going to come into office having been democratically elected by a solid majority of the American people, and that somehow he's going to browbeat the people at the Federal Reserve. I think what we're missing here is the power actually goes the other way. The Fed is not the little guy in this fight. The Fed says we have powerful financial instruments, and we know they do. The Fed's tools are used under a directive agreed by the Federal Open Market Committee, which is the rate-setting monetary policy making committee of the Federal Reserve. And they say we can control inflation, we can make it go up or down depending on how we use our tools. We can control employment, make it go up or down using our tools. We can control the growth of the economy. We can either suppress it or we can expand it. And then you have a president who comes in and among his policies and promises are, we want lower inflation, lower interest rates, higher wages, and higher growth. So I start to think, if this is a tug of war or a battle over who's going to control the economic reins of the country, it seems to me that the democratically elected president and his policies are going to come closer to addressing the economic grievances that prompt citizens to demand new leaders to begin with. That's what presidential campaigns are built on. What is my economic program to address that? And I think a big problem in the United States has been in the last 4 years, and you can find this data on the Federal Reserve's own website under U.S. household wealth distribution. We have seen since the end of the second quarter 2020 to 4 years later an increase in household wealth of $42 trillion. That brings it up to a total of $154 trillion. 62% of that, 26 trillion of it, went to the top 10% wealthiest Americans. It's set up on a percentile basis. You can see the Fed chart. The Fed impacts the performance of equity markets every day. We're obsessed with what's the Fed thinking. The increase in wealth due to the surging stock market has accrued overwhelmingly to the benefit of people already wealthy enough to own financial assets. I think it's extremely important and a way to uphold the values of democratic self-governance that the money works equally for everyone. You cannot even have the perception of monetary favoritism. And the fact that the Fed is in a position to channel financial rewards to some members of society at the expense of others is damaging and inherently political.
You went through the nomination process. You and I have talked a little bit about your experience. For those not familiar, what was that experience like? And if President-elect Trump came to you and said, you know what, let's run that playbook again, let's try it again, would you want to get involved?
Let me say, overall, it was a positive experience. But there were times when it was quite brutal. I've been writing about monetary policy and historical monetary systems since at least the 80s. I had a postdoctoral fellowship at the Hoover Institution at Stanford University. I'd written 2 books. One was on what happened to the Soviet Union because of their internal monetary and financial conditions that led to the country going bankrupt. And then I wrote a book in 1994 called Money Meltdown. And it was about the impact around the world of having no international monetary system. Because I think, because that's the case, I mean, what we have today is it's not even a non-system, it's an anti-system. And it really undercuts the logic of free trade. So that's why I think we keep battling these free trade issues, because countries can manipulate currencies, they can depreciate currencies. So what was the process like? When you see, I'll say columnists instead of pundits, it's a little more respectful, but some were so defamatory and called me a quack and right-wing fringe. And I thought, because I talk about sound money, and they said that's a dog whisper to the crazy right-wing conservatives. And there was an article like that saying I wasn't worthy of the Federal Reserve Board that came out in the Washington Post. And I sent it to Alan Greenspan, who I've known since in 1990. I got a handwritten note from him. I'd never met him. He was chairman. And he'd read my book on the Soviet economy and said he'd just come back from visiting. And if I'm ever in Washington, I live in California, why don't I drop by the office? And that started a wonderful friendship. I'd also gotten to know Paul Volcker in 1994. It was the 50-year anniversary of the Bretton Woods International Monetary System, which was anchored by a gold convertible dollar, but set up a level international monetary playing field with fixed exchange rates for international trade after World War II. And it really delivered fantastic results for about 25 years. So I've had these relationships, and with Greenspan, who has a great sense of humor, I sent him that column with an email message saying, there seems to be a hysterical antagonism against the gold standard. That is verbatim a quote from an article he wrote. Greenspan was the radical. He wrote an article in 1966 called Gold and Economic Freedom. And he basically said, unless you have an anchor for your monetary system, the government will use it and will abuse that power, and through inflation will take away your assets and your wealth. So he wrote back and said, or emailed back and said, if gold is such a worthless metal, why does the US government and all major governments of the world hold so much of it in storage? And Paul Volcker likewise we always went to an annual conference hosted by Robert Mundell, who won the Nobel in 1999 for his work on historic international monetary systems. He also was the godfather for the euro intellectually. He also was the economic brainpower behind Ronald Reagan's supply-side approach to helping to fix the US economy at the beginning of the 80s. All of these people talk regularly. I mean, people who've been Fed chairmen, who've been in the arena, they understand that gold has long been a bulwark for central banks, and it's been part of the way that you grant credibility to the ability of a central bank to put out money that can be trusted. Nobody's on a gold standard. It's not saying that. But you notice there's been a big increase in central bank buying. And in times of uncertainty, a friend of mine in Paris, in his 90s, he was the head of the Banque de France, their central bank, and ran the International Monetary Fund for quite a few years. He told me about a month ago, he said, we all know it's the only real currency. So anyway, I don't mean to go off on gold, but what I do want to say, the process was brutal because I really felt some people were ignorant about an issue that they should have been more conversant about before criticizing me.
No, fair enough. In the time that we have left, Judy, I wanted to leave it open a little bit for crypto. Is the move we're seeing in crypto a view that the dollar is going to be challenged because of our high levels, our high deficit levels? And then what if President-elect Trump makes good on his promise to turn this country into some form of Bitcoin superpower and the government is buying crypto assets? Like, what happens to prices? What happens to this digital thing out there in the ethosphere?
I was extremely encouraged. I was delighted. This was a turnaround for President Trump to support the crypto community. It was brilliant. I think that the whole decentralized finance movement does reflect less trust in government management of money. And I think that's healthy. I think we need to challenge whether or not we want to have government use money, which I consider private property. You earn it. I consider it a moral contract between citizens and the government that the money perform as a meaningful unit of account and a reliable store of value. I think it's very healthy to challenge the protected status of the dollar as our legal tender by allowing continual innovation in the sphere of alternative currencies. I'm particularly intrigued with stable coins. I want the dollar, I don't think it's a choice of the dollar versus crypto. I want to capture the efficiencies of blockchain technology, which I think works much better for individual consumers. But I think the dollar can be connected to it, but through private sector innovation, through stable coins and alternative efforts coming forward to say, how can we link to the dollar in a way that strengthens the dollar? You know, Ronald Reagan, he made a commercial once when he was first running for president. He said, my first priority as president will be to make the dollar the most trusted currency in the world. I think that should be our goal, and I am very willing to have the discipline. I mean, we believe that competition brings about a better product. So let's have competition. Let's have competition. And I do not want a Federal Reserve digital currency. I think a central bank digital currency would be a monopoly that would be terrible. But I do think that we should keep encouraging it in the private sector, and I welcome the openness of the incoming Trump administration to the cyber community and to crypto.
Time always flies talking to you, Judy Shelton. We appreciate it. We're out of time for this one. Thank you for coming to Invest. We appreciate it. Thank you.
Thank you.
Well, everybody's already moving around, so you know what time it is already. I don't really need to do much explaining for that. I will say and mention, though, very briefly, I see some of you making your way over to my left here, your right. And as Judy was mentioning, some of her published work as an author. She will also be signing copies of her book, Good as Gold, How to Unleash the Power of Sound Money. And so, we are going to take a quick break here, but you can join us again in the terrace room for the time being. Some of you have also signed up for Ross Mack's podcast and his guest, Southern Bancorp CEO Darren Williams, for a live interactive taping of the Financial Freestyle with Ross Mack. We'll be back here in 35 minutes. 3:15 p.m. sharp. We've got much more discussions with the CEOs of IBM, AB InBev, and Nobel Prize-winning economist Joseph Stiglitz, plus former CNN Worldwide Chairman and CEO Chris Licht. Don't miss it.
Welcome back to our live coverage from Yahoo Finance Invest in New York City. I'm Madison Mills alongside Josh Lipton here at Yahoo Finance Invest. Now, we just heard from Brian Moynihan, Bank of America CEO. We also heard from Neil Kashkari over at the Federal Reserve. And we also just heard from Judy Shelton, who, as a reminder here, was considered to be part of the Federal Reserve under the Trump administration, also an economic advisor to former President Donald Trump. And Josh, I thought it was really fascinating hearing from her about central bank independence. Brian started it off very broad, just asking her what she thinks about the Fed's path forward. And she went straight into this idea that the Fed has not delivered on inflation and that there needs to be somewhat of a referendum in her view following that. I thought it was really interesting to hear just how strong-willed she was on this idea that there does need to be some sort of autonomy or responsibility, I guess, for Fed members moving forward.
Judy never holds back, and she brought it again today. Another voice we heard from was Neil Kashkari, of course, president of the Federal Reserve Bank of Minneapolis, talking with us, and our correspondent Jen Schonberg about the trajectory of inflation from here. Neil talked about how we should be thinking about the neutral rate from here. So Jen's going to bring us more of those comments in a bit. You also talked to Tom Steyer, I know.
I did, and it was great. Tom Steyer is the co-founder of Galvanized Climate. He is also a former presidential candidate and an investor himself. And it was interesting talking to him about a lot of things. One is that he did seem optimistic about 4 more years under Trump, just in the context of saying that to a large extent, it doesn't necessarily matter what happens under the president because he has a lot of faith in American capitalism, consumers spending on clean energy products and technology. It was also interesting to hear from him about nuclear energy. He didn't seem as bullish on that investment opportunity as the stock market seems right now. He was more interested in some kind of classic investments in the pro-climate space, talking about real estate as a potential investment opportunity. But I know that you also had a great conversation with Andrew earlier today. How was that?
Yeah, that was interesting. So I talked to Brian Schimpf, who's co-founder and CEO now of Andrew, which is a defense tech startup. Great time to talk to Brian, get his thoughts about, obviously there's a lot of debate and discussion of what Trump's foreign policy is going to look like. So to get Brian's perspective on that and then what he thinks it means for just the broader American defense tech industry was super interesting.
Yeah, and I know you've covered that so well, talking with Palantir CEO several times. So it was a great conversation. But I do want to bring in our very own Julie Hyman to hear her takeaways so far from Invest. Julie, you've been an amazing MC today, also moderated some great conversations. What stood out to you so far?
So I have deficits on my mind as we head into the second Trump presidency. There is, as we know, a lot of optimism in the markets right now about what are anticipated to be some pro-growth tax-cutting sorts of policies on the part of Trump 2.0, so to speak. The one concern that I've heard flagged time and time again by some investors is the increase of the deficits that is projected. Now, we don't know what will actually happen, but I had the chance to talk to Rick Reeder earlier today about whether the market will grow tired of those deficits at some point and what that will look like. And here's what he said about that issue.
I think markets tend to react to the shark closest to the boat. The shark on the debt dynamic is not going to be next to the boat in January, February, but it is going to get next to the boat sometime. I don't know if it's the latter part of 2025 or the beginning of 2026, unless they address, and by the way, unless they address the size of the spending dynamics, the amount of debt we're issuing, and then obviously inflation relative to that. Now, I've heard the president-elect talk about things around energy and dereg and how to bring cost and inflation down. That's a really big deal, particularly for the long end of the rates market. But they have to address. And by the way, if the right people are in charge and running it, you could build a lot of confidence in, okay, there's a plan. It doesn't have to be executed, and it can't be executed in the next 6 months or a year, but there's a 5-year plan. We can debate, what you put in place when you leave off or when you leave office, how that changes. But you've got to put in place a plan that people feel comfortable that we're going to get the debt under control.
So the shark's not next to the boat. And what he means by that is at some point, the risk is that if deficits in the U.S., if the size of the debt grows to such a point that you see buyers start to step away from the Treasury market. And Rick said he'll be watching demand for Treasury auctions, the yield at which they go, and the number of foreign buyers. If those elements start to weaken, he says, that would be a source of concern for him because it would be basically effectively pushing borrowing costs higher, cost of capital go higher for companies, et cetera. So that could create sort of a ripple effect. Now, on the campaign trail, I don't know about you guys. I heard a lot. I heard talk about cutting costs. I did not hear specifically any talk of cutting the deficit on either side.
No.
So, we'll see if that is the effect of some of the policies that we'll see in this White House. Will we see the $7 trillion increase in the deficit that's been projected? I don't know, but it's something that an increasing number of investors are talking about at the very least.
And that's why it was such an important discussion in terms of what to watch to figure out when that deficit issue is the real zombie in the room. Watch those treasury auctions and global demand there. Julie, thank you so much for joining us. Really appreciate it. We're going to get to some of our trending tickers now. Starting, of course, we got to talk about NVIDIA. We do have a price target raise for the chip giant here. Starting off 2025 strong, according to Mizuho here, raising its price target from 140 up to 165, implying an increase on those shares of double-digit percentage-wise here. It is a top pick for Mizuho moving forward here. And Josh, just to run through a couple of the reasons why here when it comes to Mizuho. They talk about an increase in demand moving forward, of course, for that GB200 super chip. They are expecting to still ship that in 2025. Increased demand for their racks, increased global demand, 60% CAGR growth from 2023 to 2027, surpassing $400 billion annually for their AI servers. So some huge numbers here propping up NVIDIA today.
Yeah, they do also mention risk they told their clients to consider. They talked about escalation of export restrictions to China. That's, of course, top of mind. Pullback in AI server spending is always a risk. Growing competition. We also often hear who could the kind of long-term competition be for Jensen Huang. You're going to hear names like AMD and, frankly, Jensen's own big customers, those hyperscalers, those big cloud giants. But listen, those are risks, but bottom line, they're bulled up. They haven't outperformed, as we know, basically the vast majority of analysts on the street have.
And I was wondering, too, what you thought about this idea that as we continue hitting all-time highs in the market, don't analysts on individual names have to race to increase their price targets on individual stocks because the market's rallying and that means NVIDIA is going to go up as every single ETF pours into those market cap weighted names?
Yeah, I mean, listen, the street has been for a long time overwhelmingly bullish on NVIDIA. I mean, it's hard to find somebody who isn't at this point, even as you head into this earnings report, which is, I believe, November 20th is what's on the calendar. I mean, you're heading into that, November 20th earnings print. Hot. I mean, the stock's up 200% year to date. That has not dissuaded a lot of analysts on the street who cover it.
Yeah. All right. Well, let's get to another name that is ripping here. We're going to talk about Netflix here, also saying that its ad tier is really continuing to have success. The ad tier having 70 million users in action right now, and that is globally. It's interesting because we know that they had kind of pulled back on some of the ad tiers available to customers in the United States, at least, but they are still offering a $7 a month option to stateside consumers. That's at the low end, by the way, of the general streaming market in terms of ad-backed growth. And I talked with Ali Canal, our entertainment reporter, about this earlier. She said that global growth when it comes to the ad tier is something that Netflix is certainly watching moving forward, not just in terms of domestic demand here in the States, but also globally.
Yeah, they're also investing in live programming. You've got the NFL, WWE. That means, of course, more ads. Netflix saying it has sold out all of its in-game inventory for those 2 live NFL games coming next month. And, of course, you've got the Jake Paul-Mike Tyson fight. Allie, that's this Friday.
Are you watching it?
I haven't decided yet.
All right.
I grew up with Tyson, but this is a different Tyson,
Right. Oh, of course, totally. I could definitely ad-lib about Mike Tyson forever. All right, let's get on to Tesla, something I can talk about, pulling back as its post-election rally cools here. Now, this comes as Elon Musk tops Fortune's list of the most powerful people in business. Earlier today, we heard from Marc Rowan over at Apollo Global Management. He is the CEO. He talked about how Musk could bring change to the Trump administration more broadly. Let's take a listen.
I think what the market likes about what they're hearing is they're hearing directional change. The kinds of people that the president-elect has been able to surround himself with, I think, have been captivating for the market, and whether it's the Elon Musks or the others, bringing people who have a new way of thinking is likely to lead to different outcomes.
Can the administration cut taxes at the same time as the deficit continues to rise?
Yes, up to a point, but this is all about balancing act. Our financial situation is fixable. It is fixable in a way that is positive for the base that President-elect has said that he wants to help. but it is not fixable by small amounts of tinkering. It is about wholesale change, and we as humans, we are sometimes scared of wholesale change.
Oh, does Elon represent wholesale change? $2 trillion in potential cuts he's floated.
I think Elon Musk represents wholesale change, and I think we actually need wholesale change.
So Marc, Rowan, fascinating, Josh, hearing from him. He talked about this idea that voters had a choice between more of the same or change. They picked change. He sees change as a good thing, meaning that I took that as he is happy with the election results, and also that he sees Elon Musk as being a positive catalyst for more of that change moving forward here in terms of efficiencies in the U.S. government.
I mean, Musk is a remarkable story. I mean, he closely aligned himself with Trump. He bet big on Trump. He bet right. So now you have a guy in Trump, an entrepreneur, a CEO who's going to have the presidency here. He's going to know the cabinet. He may play some role here on this government efficiency commission, which certainly a lot of economists and strategists coming on Yahoo Finance are already talking about. It'll be interesting to see how that develops. But what does it mean for Musk? What does it mean for his companies and his investors? We'll see how it plays out.
And this might be one of the reasons that he was named Fortune's most powerful person in business today. Jensen Huang getting bumped to that number 2 spot in favor of Musk, given probably some of the power that he has gleamed over the course of the election. I think he earned $300 billion personally following the election rally that was sparked in Tesla. So certainly a good couple of weeks for Elon Musk. All right, we're going to take a quick break, but we're going to have more coverage from Yahoo Finance Invest straight ahead. Welcome back to our live coverage of Yahoo Finance Invest in New York City. We've heard from many great voices so far today, so let's take a listen to what some of our guests have had to say.
Well, I think it's clear that the market has moved in anticipation of all that. Now it has to be executed upon, but I think what's really driving the fundamental activity in the economy is the things that make America great. Capitalism, a consumer knows how to, is employed and earning money and spending, a credit which is widely available. And, those are what drives this. Capital markets is deep and open and recycling capital, and investors like all the people here putting it to work. That's what makes America great, and having a set of policies to enhance that is a good thing. The thing that's always interesting about a second term of a administration, this one had 4 years between it, is that they come in without having to go through all the work the first time, which the work the first time has a couple dimensions. One's the personnel part of it, usually takes a lot longer. And there's been transition planning commissions formed to try to speed that up, but you got to fill a lot of jobs, 4,000 jobs. You also have to figure out what policies you're going to have right out of the box. You have to figure out who you have to reward for things that got you here, and all that is important. When you do it the second time, especially when you have time to think about it, I think it's they should hit the ground running, and I think that's what they plan to do. The market's a very short-term mechanism. Ultimately, the equity market's supposed to long-term value, but it won't discount long-term value, but they're very narrow in the trading ranges. And so I think if you get to the people, our experts who predict what will happen long-term, it's going to be basically on earnings growth. And so the question will come down, will the policies of the incoming administration create economic growth, which will then result in earnings growth, and whether if the companies are managed well, they'll get it. That's what will drive the next round of the market. The valuation pop that's happened over the last year and another chunk of the last 5 days, is pretty unusual. Part of it was recovery from last year and stuff, but it's pretty unusual. And so we got to kind of grow into it now, and that's the earnings growth has got to come.
Well, I think what's been interesting is that this time around, relative to 2016, the markets have had a pretty consistent view. As things were getting priced along the way, as his odds rose, that's the same thing you saw after he got elected. And markets are basically telling you more or less, Donald Trump means somewhat good for growth, somewhat inflationary. And so you're getting higher yields, you're getting a slightly stronger stock market, you're getting a stronger dollar, and it makes sense. You know that Trump and his team are believers in tariffs, that they really believe that's the right way to go. That has to be to some degree inflationary. You know they're believers in stopping the flow of immigration. That has to be to some degree inflationary. And the plans they put forward of what they want to do with the deficit are, to slightly increase the deficit, certainly not to reduce it, and to do things that are going to be stimulative. And so they want to create a stimulative environment. I think they hope they have is that you'll get enough productivity happening on the other side of that it won't be too inflationary. And that's very hard to predict.
Sticking with what is inflationary, let's bring in our very own Jennifer Schomburger. Jennifer, you just got off stage with Neel Kashkari over the Federal Reserve. What was the primary sticking point for you in that conversation?
So a couple takeaways there, Maddie. The first one is that it seems like a rate cut in December is the baseline unless we see an unexpected spike in inflation. So that puts the CPI report tomorrow morning in prominent view. The other thing that stood out to me is that he thinks that economic strength can continue into next year. He talked about the elusive neutral rate. I also asked him about the path forward, and of course, he wouldn't comment on that. But the fact that he sees economic growth continuing to remain strong and that we've seen productivity also remain resilient sort of signals to me that we could see fewer cuts next year. And then the third thing was that there is a high bar to stop that balance sheet runoff.
What about this idea, Jeff, interested to get your take on this, that maybe the Fed is in a place early 2025 where they think, you know what, it's okay to take a pause here, it's okay to take a breather, see how this shakes out, but whether that would then immediately put them in some type of conflict or tension with President-elect Trump, who may not be so happy about a pause.
Right, we know that the president-elect does favor lower rates. However, I did ask President Kashkari if the president-elect were to pressure you to lower rates, but you didn't feel that was the right course of action, how would you react? And he basically said, we have to do what's right for the economy. So I think a lot of this...
He did do what's right, but you can imagine, Jennifer, like you can imagine a situation where a pressure would certainly mount, criticism.
Well, we've seen this movie before, Josh.
Yep.
And the Fed will do what is necessary for the economy. There is Fed independence here. And we've seen successions of presidents who have jawboned the Fed. President-elect Trump seems to be a bit more forceful, but I don't think that that's going to cause the Fed to yield to whatever he wants. Whatever the economy needs comes first and foremost. And in this case, it's what is the trajectory for inflation? What is the trajectory for the job market? Right now, Kashkari telling me that the job market remains in solid shape. It seems to be exactly where they want it right now, a gently gradual cooling job market. Inflation also continuing to come down. We'll see whether that sticky core inflation remains and if that causes the Fed to sort of either spread out their rate cuts or hit the pause button. But I think communication from the Fed is going to be key going forward.
In our final minute, it was interesting hearing from Judy Shelton. She kind of pointed to this idea of why should the Fed decide the price of money given their track record, given how they've done on the path forward on inflation. I know that you were still talking to Neil during some of that conversation, but I just wanted to get your initial thoughts on that.
So I didn't actually hear the conversation, obviously, with Judy Shelton, but as far as, what the Fed has done, yes, they got the transitory wrong when it comes to inflation, and they were late in trying to raise rates to combat that, which is why we saw such a magnitude and forcefulness of the rate hiking campaign. However, I think in the 6 months that we've seen here, as the Fed has signaled their rate cutting cycle and has started to cut rates, I think that Chair Powell's doing a very good job. The fact that he decided to cut 50 basis points in September and then another one in November, I think not only ensures the soft landing, but maybe the so-called no landing scenario, which is why we keep hearing from members of the Fed, including Kashkari today, who told me that he thinks his economic strength can continue to next year.
All right, Jennifer, thank you so much, as always, for joining us for the great panels today. Great job. Thanks so much. All right, let's get it over to our very own Jared Blickery for a check on the markets today. Hey, Jared.
Well, thank you. We're looking at a mixed market now, although the NASDAQ is just barely in green territory. You can see up 1 basis point, and let's just get a read on the day. It's been a pretty low volatility day. Here's the 4-day look, and even over these last 4 days, you're not seeing a whole lot of action. But Dow is down about 0.6%. Russell 2000 leading lower. It is down 1.6%. And one of the things I'm noticing in the market is a higher dollar and higher yields. This is a 3-month chart of the 10-year T-note yield. It is up 12 basis points today. So that little move right there, that's actually a pretty big move. And you can see we are right back up near these recent highs. And in fact, if we were to close here today, and we just did at 3 o'clock, that is a new high going back probably several months. So that's something we want to keep an eye on. Also taking a look at the US dollar that I mentioned real quickly, up to a 4-month high. So that could be weighing on some of the markets, and especially the smaller caps and some of the fringier parts that don't like that higher dollar. Now we're seeing some defensive moves here into staples, maybe communication services and tech, materials and discretionary. Those are the two worst off, down 1% each. Let me leave you with a view of the NASDAQ 100 here, where you're going to see a lot of green. This is not really representative of the S&P 500, but some of these mega caps name really carrying the water for the rest of the market here. Microsoft up 1.5%, Nvidia up 2%, Amazon almost at 1%, Tesla though down 5%. Guys.
All right, Jared Blickery, thank you so much. Really appreciate you joining us on that. We're going to have more Yahoo Finance coming up, but stay with us for more. Welcome back to our live coverage from Yahoo Finance Invest. The incoming Trump administration has been in focus here today, including who's surrounding Trump. Now the Wall Street Journal reporting that billionaire investor John Paulson has taken himself out of the running to become the Treasury Secretary of the United States. Separately here, Bloomberg also reporting that advisors are backing investor Scott Bessent to run the Treasury. He's been a key economic advisor to Trump during the 2024 campaign. I was able to speak with Scott Bessent a couple of months ago, Josh, and it was interesting talking to him about Fed independence and what's next for Jay Powell. He actually did say that he would advise former President Trump, at the time now President-elect, to keep Fed Chair Powell in his role until his term naturally takes its course, which is something that's been a key question. That's what we've heard about a lot today as well, just the idea of what's going to happen with the Federal Reserve and with monetary policy, with the macro backdrop under a Trump 2.0.
Yeah, and of course, Jay Powell made it clear at that last Fed decision asked, he's not going anywhere. Right?
Yeah.
I mean, it couldn't have made that, I think, pretty more clear than he did. With Paulson, it's interesting with John Paulson because he was a very strong supporter of Trump for a long time. He was thought of as maybe he could be the next Treasury Secretary. He's taken himself out of the running. He gives a statement to the Journal here saying that his complex financial obligations would have prevented him from holding an official position in President Trump's administration at this time. Does go on to say he intends to remain actively involved with the president's economic team, and he says helping in the implementation of President Trump's outstanding policy proposals. So may not be taking an official role, but suggesting that he'll still remain on as an informal role. With Bessent, it's interesting too, though, because, and the Journal kind of goes into this, Maddie, about it'll be interesting how that would play out because he was CIO at Soros Fund Management, and of course that was founded by the mega donor George Soros. On the other hand, he does have the backing, the support of some notables like Larry Kudlow. So how that shakes out, maybe we'll wait and see.
Right, and he's a hedge fund manager himself. He's got about $600 million under management here. So I think that from a market perspective, there's a little bit of optimism about having someone who is part of the investor community running the Treasury moving forward. It's also interesting, we of course don't have the decision on who the Treasury Secretary will be yet, but Bessent did meet with Trump on Friday, and Kalshi, the betting markets here, putting an 87% chance on Bessent becoming Treasury Secretary.
Still looking at Kalshi.
We will. Gotta look at
yeah.
Kalshi here. All right, but for now, you should be turning your eyes to Yahoo Finance Invest. We're going to be hearing from AB InBev's CEO this afternoon. Let's head back to our coverage.
Please welcome to the stage your hosts, Yahoo Finance anchor Julie Hyman and Brad Smith.
We are nearing the finish line, but we have some real blockbuster conversations still to come that I'm quite excited about, Bradley.
I am, yes, Julie. We were talking backstage or back kitchen area. And yes, we are essentially about 45 minutes away from the close of trade. We've had a lot of market moving discussions. We're also just a little over 45 minutes away from happy hour. And our next guest knows a little bit about that. As the CEO of Anheuser-Busch InBev, the CEO, Michel Doukeris, and Yahoo Finance executive editor, Brian Sazi, join us for this next conversation.
Good to see you. It feels like we should be doing this interview with a 40-ounce of Bud Light or something. It doesn't feel right. There's no beer in this cup.
It's already happy hour somewhere.
Well, you're an avid.
It's always happy hour somewhere.
Do you still drink beer every day? I read some interview that you're an avid beer drinker.
I do.
Yeah. It's. Well, I guess it goes. I mean, is it Bud?
It makes my job.
Yeah.
And also what I like doing, so I drink beer.
But you view it as you view beer as a social occasion, right? I mean, it's much more than something you pour in a cup.
So beer from all beverages, if you think like how people associate beer with, is always social occasions, sports, and relaxed occasions. So in a way, it cuts across most of the activities that we do during the week. Mm-hmm. Of course, when I say that I drink beer every day. It's not literally every day, but it's most of the days. And it's the beverage that I like the most. It can be sometimes non-alcohol beer, sometimes it's low alcohol beer, sometimes it's normal strength beer. But it's very refreshing, delicious.
When I visited you at your headquarters, or one of them in the city, I walk in and there's this bar. I'm like, this is great. I'm like, every office needs one of these. I mean, but talk to us about, while you're in the business of beer, under your watch, you have now made a recent push into no alcohol beer. Like, what's the play there?
So I think that it goes back to what I said before, is social beverage is very flexible. When I mean flexible, you can have great non-alcoholic liquids. The non-alcohol beer is part of our portfolio forever in many, many countries. But if you go back like 3 years in time, let's say 4 years in time, there were a couple of very interesting breakthroughs in terms of technology. And today we have a technology that we developed that's basically distillation under low temperatures because of the pressure that makes the liquids just great liquids, very similar to the standard format of beer. And you see people getting to drink non-alcoholic beer in occasions where beer would serve them very well, but in before they were constrained by driving or being weekdays or being lunches after and before going back to work. And now because you have non-alcohol available, people are just like choosing beer.
How hard is it to make a beer with no alcohol in it?
It's not that hard. Of course, there is different levels of technology, as I said before. For many, many years, the technology was, in a very simple way, was stopping the fermentation. So you would have a beer that was not a final beer. Today, with this technology, you brew your beer to the end, and then you just remove the alcohol, but you leave everything else. The aroma, the taste, all the components are preserved by this quick distillation at low temperature. And then the liquids today are much superior to what they were before. One of the most interesting things that I saw this year was we sponsored the Olympics, and then we had non-alcohol beer in the Olympic Villa. And people were just crazy because it was such a way for you to hang out with friends. It was summer, drinking a refreshed liquid, very low calories. There are electrolytes in beer.
There's electrolytes in this beer or all beers?
In all beers.
I don't know.
So it's very good for replenishing. If you look in Germany, it's very common for cyclists to replenish. While here maybe people will drink isotonic, there people will drink a combination of a soda with beer to replenish electrolytes.
Your company has been built through a series of acquisitions over many years. Of course, the most notorious, Budweiser. What does the U.S. footprint look like for your business today? What does it look like, in St. Louis, in that namesake market of Bud?
Yeah, so over the years, our company historically grew through acquisitions, and beer consolidated somehow through acquisitions as many other sectors. Sometimes we like to remember beer, but if you look at many other sectors, they are consolidated in 2, 3, 4 companies. And we came to the US in 2008. Headquarters is St. Louis. The US today represents close to 30% of our revenues. 70% of our revenues are in other 49 countries that we operate. And we basically operate across the globe in all continents.
Do you still want to grow via big acquisition?
So in the last 3 years, we reoriented our strategy from acquisitions to a more organic growth strategy. And this, again, because we are in 50 countries, 1 in 4 beers globally are one of our brands in one of our countries. So there is much more for us to grow on the current footprint that we have, which we think that's pretty close to the ideal footprint for us. But of course, we are always, as we work and deploy capital, our number one priority is organic growth, but dynamically, you're going to always find opportunities in returning more cash to shareholders or investing if you have a good opportunity with a good ROI in bolt-on acquisitions in the category, around the category, but this is no longer our number one priority.
Explain to, I think you do have a popular ticker on Yahoo Finance. You have a lot of followers on our platform. Why do you think the stock hasn't reacted accordingly? So I went through your most recent quarter, operating profits up, new $2 billion buyback. Like, what is holding investors back? What do they need to see from your company before they hit that buy button?
It's a great question for you to answer.
Well, not me. I'm not an analyst anymore. I'm like, make the case. What's the pitch?
So let me tell you. I think that we always think that in the long term, of course, the share price is a very good test to the results that you deliver. But when you get a shorter horizon on this, there is always two things. There is the macro, and you don't have control on macro. And there are the things that you focus on, you manage, and you control. So I will talk more about the things that we control and the focus that we have on what we manage and we can do. You just said we released the third quarter a couple of weeks ago. And if you get the results in a nutshell, revenues are growing 3.6%, EBITDA growing 7.6%. EPS is growing double digits, 18%, nominal US dollars EPS. We increased our dividends last year, paid this year, in the last 2 years by 64%. We are generating very good cash flow. We release cash flow twice a year. So I'm talking more about the half year. We grew cash flow more than $1 billion. And with that, we announced a $2 billion buyback this quarter. So we're managing the business, focusing on what we control, which is our own performance, investing on our brands to the long term. Results are coming, and we tend to believe that share price will follow. Now, if you step 1 second and you look at the macro, I think that there are two things in the macro that are very relevant. One is that 70% of our revenues are in non-dollar denominated currencies, and this year is being a year of appreciation in the dollar. So this brings more difficulties for non-US based organizations and companies. And everybody that's over-indexed in the US is having a better result in terms of share price. And the second thing is a little bit of concentration in some tech bets, in some pharma bets, that are living a little bit in the cycle, consumer goods lagging these sectors. But we think that, again, short term, focus on what we control. Long term, share price should reflect that. If you look, what is the pitch? Look at our cash flow generation.
Yeah, so that's well done.
And see what we are doing in terms of return to shareholders, and you have a big case there.
One thing not in your control is weight loss drugs. I mean, how longer term, how does this impact the demand for beer and even spirits for matter, but of course beer.
Say again?
In spirits, how does the push to lose weight via these drugs impact your industry?
So today, there is no any impact that you can read through the numbers. There is a lot of research out there. There is a lot of data out there, and there is some speculation. Again, if you look at the numbers, you don't see any strong correlation. If you look at the research and you look at the profile of these users and how they interact with beverages, it's fair to say that beer is a little bit separated, while it's still part of the consumption, but because we are not in the sweet part of the industry. So wine is sweeter, higher calories. Cocktails has a lot of sweet components, higher calories. I think that beer gets a little bit aside of that. And we have products. If you look over the years, Michel Ultra is a product in the US that is growing a lot. It's low carbs, low calories.
Don't you have a zero alcohol version of that?
We announced it. We are launching for next year. So now you're going to have the regular version, low carbs, low calories, and you have the non-alcohol version that's very low calories as well. So in a way, beer fits well for this type of occasions, and the low carb, low alcohol, low calorie products that we have make a good case for you to continue to have social activities while maintaining your diet. We advocate at the end of the day for a balanced lifestyle. As I said, I drink beer every day, and I'm still doing well on the
You're doing
the
okay,
scale.
very fit. You're very fit. I talked to recently the CEO of Suntory, spirits maker, and we were talking a lot about this next generation, let's say under the age of 25, not drinking as much. What type of risk does that present to your business?
So there is an interesting report that I always recommend people to read. Bernstein did a very comprehensive report on that, and I like to recommend because it is independent source. And at the end of the day, there are a couple of conclusions there. One of the conclusions is, while in the US, legal drinking age is 21. So when I talk legal drinking age in the US, it's 21. 21 years old to 24 years old are drinking less and participating less in alcoholic occasions. Even if this behavior would be projected throughout the years, the impact on the alcohol industry is around 1% of the current volumes. But the reality is that the same study shows that people are doing many activities, including socializing, drinking, older. So they live longer with the parents, they engage in working activities older, they have social activities older, and as they go 24 to 27, most of the behaviors tend to normalize, right? So I think that people are more conscious on their choices. A lot of these young generations are sticking at home and in some of their activities longer. And as they start then to go to more normal lifestyle, they tend to normalize behavior. The third conclusion is that on the other end of that, people are living longer, retiring with more wealth, and socializing much more frequently, especially with premium products, than they were before. So that's why there is a balance on the industry. And while people talk about the behavior of young consumers, you don't see these results translating in the speed, dollars, and volume of the categories.
I think you've laid out a case. You're a very global company. We have an administration that just is about to enter that may make it tougher for a global company to operate. Tariffs on China, potential tariffs on Europe, maybe more steel tariffs, whatever the case. Or how concerned are you as the CEO of your company that your business is going to be really hurt by more geopolitical tensions?
Yeah, so I think there are two pieces there on this question. One, while being global this year, we followed elections in basically half of the world, from Belgium to India to the US. And one take of that, which I think is very positive, that sometimes people forget, is that was a very straightforward process, with the elections being held everywhere, results coming, and people now taking on the next stages of the government. And for us, one thing that for beer is very interesting that a lot of people sometimes do not know or do not remember if they have seen before is that beer is local. We say that beer never travels much more than 300 kilometers. If you look, like the majority of the volume that we sell is brewed locally and distributed in a 300 kilometers ratio from the brewery. Think about the US, for example, 99% of what we sell in the US, we produce right here in the US. And over 95% of the ingredients that we use, we procure from local companies and local farmers. So for our business in the US, tariffs might impact one another component that we buy from outside, while 95% is local produced. And this is true for all other countries that we operate, with the exception of some countries where we have just exports. So as long as the playing field is leveled, and this is good for economic activities in the US, beer is grown in the US, produced in the US, marketed in the US, and consumed in the US. So very local business.
Look, we have to ask this stuff. I mean, your namesake brand, your Bud Light, became caught in the political sphere about a year ago. Sales really came under a lot of pressure. Two-part question. What was it like for you as a CEO to see sales of this iconic American brand fall to the extent that they did? And can you sit on here and say today, this controversy is over, Bud Light's coming back, and it will go back to where it was pre-controversy?
So that was a very tough period for the team in the US. I think that you followed a little bit of the controversy, and we had a little bit of everything, from people being threatened on the streets, a lot of things being told about the company, and at the end of the day, slowly, as things settle and the communication continues to flow, people really understand who we are, right? And who we are in the United States is a company that is here for over 100 years, based in the US, employing American people, sourcing most of the ingredients from American farmers and American companies, distributed in the US for over 500 wholesalers that are in each and every city, that supports military, veterans. We have thousands of them working for us in our breweries and in our wholesalers, 20,000 employees that we employ direct in the US, over 50,000 if we include our wholesalers. And today the business is stable, is growing, as a matter of fact, in the last few weeks. We have a portfolio of brands, and while Bud Light is not growing and was not growing before the controversy, Michelob Ultra, Busch Light are amongst the top 3 brands in growth in the US. And we continue to invest, as we always did for the long term, on our brands, in mega platforms that all consumers love, and supporting the local communities on where we operate, because at the end of the day, this is who we are.
President-elect Trump said, you should be given another shot, Bud Light. I mean, does that endorsement, does that matter to a company like yours?
I think that many people, once all of that settled, came to, again, recognize and remember and be remembered of who we are as a company. And someone one day told me that no one wants their best friend to be judged in a bad day. And I think this is true for Bud Light. This is true for any brand that was caught or any person on this controversy. And if I look from how hard the team in the US is working, how much they are doing for the local communities, for this brand, and for the local economies, of course, it deserves another shot. It's a great brand. It's a great liquid.
I don't know if we have
People
any of
love
it out there in the bar, but I mean, if we do, by all means, bring it out. Michel, good to see you.
Should have.
Thank you for doing this. We appreciate it. We'll let you have your beer now. I appreciate it.
Thank you. Thank you, everyone.
Excellent conversation with Brian and Michel, and really highlighting how certain brands are able to move through either controversy and the leadership that must emanate from the top down, especially amidst those moments as well. So thank you for that conversation. Coming up right now, as we think about studies in the theory of growth and income distribution, some of the theories that were developed back in 1967 from our next guest. Do they still hold true today in 2024 in today's basket of economic inputs? Joining us now, please welcome Nobel Memorial Prize in Economic Sciences winner and awardee and Columbia professor, Joseph Stiglitz, and Yahoo Finance senior reporter, Alexandra Canal.
Professor Stiglitz, this is a perfect time to have this conversation, right? We've been talking about Trump 2.0 presidency, what that can mean for the U.S. economy all day. And I want to start there because just before the election, you, along with 22 other Nobel economists, you signed a letter saying that the Harris agenda was, quote, vastly better for the U.S. economy compared to the Trump agenda. Why are Trump and his policies not supportive or not as supportive of a strong U.S. economy?
Where do I begin? But let me, well, you have to begin somewhere. So the first thing, you know, Americans have been concerned about inflation. Actually, during the Biden administration, the inflation rate came down from the very high level that was a result of the pandemic and then the war in Ukraine, and it's come back to normal level. It's remarkable. Most economists didn't think it was going to happen so quickly, but it did. I was one among those that argued that it was a supply side interruption, demand shifts associated with these events, and that it would come down. In some ways, I had more faith in the markets than the people in the markets did. So take that issue of inflation. Trump has promised, now remember, we can't be sure he's going to deliver on anything because if you add up all the promises, they don't add up. But if he actually delivered on the 100% tariffs on Chinese goods, you think of all the apparel, appliances, all the things, iPhones, you know, smartphones, all the things we buy that either buy directly from China or have a lot of Chinese inputs. That's inflationary, 100% tariff. And even if many firms move to other places like Mexico, and the reason they chose in China was because it was cheaper. So it will be inflationary. And then you start thinking of the inflationary spiral, the prices go up, workers will want more wages, and then you start thinking of what happens if others retaliate. And remember, he's promised tariffs not only against China, which he sees as an enemy, but against all our allies as well. And they might retaliate. So first you have the inflation problem, and then because the Federal Reserve will be worried about inflation, and Jay Powell, I've criticized him on many grounds, but what's very clear, he's announced he's not resigning. He's very focused on inflation. If inflation goes up, he's going to raise interest rates. Now, you combine the higher interest rates and the retaliation from other countries, you're going to get a global slowdown. And so then you have the worst of all possible worlds, inflation and stagnation, slow growth. And then you start thinking of just one more. I could go on, but he says he's going to start not only restricting immigration, but deporting undocumented immigrants. We here in New York know how much we depend on them. You know, we're going to go into, I can't imagine what's going to happen when to our economy when that happens. But one thing we can be sure, it will be inflationary.
Okay, so I do want to pick up on that point because we did have Fed President Neel Kashkari here about an hour ago. He did say that tariffs, it would be a one-time increase of prices, but that the real issue would be if we did see that tit for tat. So when you think about the globalization risks around tariffs, how do you view those comments and what could potentially come ahead?
Oh, I think this is a real challenge to the global order, a global order that's already at a point of fragility. So since World War II, we've worked very hard to construct a global order where goods, services, people, capital move more easily across borders. And it has a lot of downsides, and I've written about that in my book, Globalization and Its Discontents. But it's also contributed to some extent to global prosperity. Now, the big point to realize that whatever your judgment about the extent to which contributed to global prosperity. When you try to unscramble a scrambled egg, you have problems. It may not be possible, but the fact is that breaking these relationships, at least in the short run, is likely to impose very high cost. We had a little sample of that during the pandemic. You know, supply chains broke down. Not because we actually did say certain things couldn't go across borders, but in other cases they couldn't produce them because of the pandemic. But the fact of the matter is supply chains broke down, and look what happened. We had this bout of inflation, and we had shortages, a kind that we never had before. So I think those kinds of things are on the horizon if, and this is a big if, he actually does what he says. Now, we saw from Trump the first term that there's often a difference between the bark and the bite. That in this case, there's a real problem. What happens on tariffs is that the government announces that it's going to raise tariffs, then all the people who are affected, people, when I say corporate interests, big people, not you and me, but corporate interests come in and say, this is going to be disaster. Walmart, I'm sure, will come in and say, we have a whole store, you know, our whole business model is importing Chinese goods, apparel, and you're going to kill us. And then a car company comes in and says, look, we use Chinese steel, or steel from Canada, or parts from Canada. You can't do this, they'll say. And then there'll be a quiet system that had happened before of what are called carve-outs. So you say, oh, this guy is exempt and that guy is exempt, but I can bet that the carve-outs will come more readily to those who make bigger campaign contributions and support Trump more. And we are about to open up the largest potential for corruption that our country has had since Andrew Jackson. So,
are you alluding to someone in particular, Elon Musk, perhaps?
Well, Elon Musk has sort of become a symbol for this kind of lack of understanding of conflicts of interest and the borders between private and public. You know, one thing going around the internet recently, you know, he claims to be a libertarian. He forgets that Tesla only survived because of a $500 million loan from the U.S. government, where the U.S. government gave them a loan without taking any of the upside. And like they did when they lent money to Chrysler, they took some of the upside with what they call warrants. If they had done that, we, the taxpayers, would be much better off. But in the story that's going around Twitter feed and all, you know, the social media, and I can't tell you whether it's true, is that he said to the Europeans, if you try to regulate Twitter in the way that you are, that's called the Digital Services Act, it's trying to stop all the digital harms, and they've had it in place now for a while. If you don't give us an exemption, we're going to withdraw from NATO. Now, can you imagine that? Saying, unless you serve my corporate interest, we're going to let Poland and all those countries be run over by Russia. Now, that just, to me, illustrates that there's no boundaries between somebody who is advancing his corporate interest and the national interest.
So it seems like you don't think Elon Musk would be good for government, but isn't there a thought process where we need these provocative upper echelon of folks? I mean, politics aside, Elon Musk has brought EV adoption to the US. He's doing some innovative things with Starlink. If we want to be the best economy in the world, how do you rationalize that with, you know, kind of to your point, the corporate greed and the short-term greed of it all as well?
Oh, I think we have a wealth of good, honest entrepreneurs that don't necessarily take huge amounts from the US government and then pretend to be libertarians. You know, this kind of, to me, this kind of person who takes all this money from the government and then says, I believe government should be small. What he's saying is, I think government should be small when it comes to the small guy, but big for big guys like me. That's what he's really saying. And you ask, you know, are there a lot of honest entrepreneurs out there? Yeah, there are. Are there a lot of entrepreneurs who are thinking intellectually consistently about the real needs of the country? We need to have, for instance, you know, 100 and some years ago, Henry Ford produced a car for the people. And in Germany, you had the Volkswagen, which was a car for the people. Yeah. Not for the very rich, not the Cadillacs, but for the ordinary people. It transformed America by having a car that was for the people. Tesla is not for the people. You look at the prices. BYD, the Chinese company, has figured out how to make an electric vehicle. It's innovated, make an electric vehicle that is for everybody. Mm-hmm. That is transformative, and that will help the planet in a way that Tesla won't.
So you mentioned Henry Ford. Is there any current entrepreneur that you can think of today that is for the people? And if you can't easily think of one, what does that say about the current place of our
I think there are a lot of, you know, entrepreneurship going all over the country. Just think of what has happened to the cost of renewable energy. That didn't happen on its own. It's fallen by 80, 90% and put us in a place that we can address the problems of climate change. That didn't happen on its own. It happened partly with government-supported research, but it happened by a lot of entrepreneurs. And sometimes we think always that the big entrepreneur, mm-hmm. but innovation occurs, you know, I've studied a lot of innovation in the last 50 years. Most of the important innovations are small, incremental changes, one building on the other. You know, and my view, each of them should get credit, but that's the way our society advances, step by step. I mean, and then occasionally there are grand things, but it's step by step. And I think we put too much, we're too focused on the stars, mm-hmm. and not on that incremental change that really is transformative. Mm-hmm.
And I want to talk about the resiliency of the U.S. economy today, because in the face of a lot of obstacles, high interest rates included, we have GDP strong, we have unemployment low, stocks are at record highs. So when you think about the current state of our resiliency, even if Trump were to enact all the policies that he promised on the campaign trail, is there a scenario where the economy can continue to be resilient?
If he actually delivers on all his promises, I don't think the economy will do well. I mean, just think, you know, no matter what lens you look at the economy, you know, I talked about inflation, I already talked about unemployment, about the stress that's going to happen when we have a labor shortage, you have prices going up. Many other economists, this is Yahoo Finance, you think about finance, and his promises are that have been estimated to lead to an increase in the debt of over $7 trillion. And even in a rich country, $7 trillion is money. And even if you individually don't think it's a problem, you can just use it out of your bank account. The fact is, if other people think it's a problem, if foreigners think it's a problem, it becomes a problem. And I can tell you, a $7 trillion hole in the US budget, people will think is a problem.
Is that the first shoe to drop then? In other words, what type of data points should we be watching for if there's any type of deterioration of the economy?
Well, I think already what you're beginning to see is increase in the interest rates at the long end. You know, the Fed does the short end, the short-term interest rates, but people looking forward down the line are beginning to see interest rates going up. And that is already a sign. Now, how would that translate? Well, higher long-term interest rates is higher long-term mortgage rates, less housing. We already have a problem of housing prices. And so that will be one of the ways it's going to show. Now, higher interest rates is almost surely not going to be good for the stock market. So, well,
which we know President
all of you
Trump
guys
wants.
who depend on the stock market, I would say, get worried. Or take your money out, and then, of course, that's a self-feeding process. So that's another dimension where it will show up. When it will show up, can't tell.
So even amid all these risks, there are some that say the soft landing scenario has already been achieved. And I'm curious to get your perspective, because you were in the White House as the U.S. orchestrated its last successful soft landing in the mid-1990s. Are the dynamics of that time similar to the dynamics of today? And are there any lessons learned that we can look back at?
Well, the particular circumstances of this, you can say, crisis, the high inflation following the pandemic, the high oil prices following the Russian invasion of Ukraine, are really idiosyncratic. I mean, are a really unusual situation. Every big crisis is unusual, and a lot of the economic models don't really incorporate the notion that every big fluctuation, big downturn, inflation, has its own particular characteristics, and therefore it has to be addressed with the wisdom of what we've learned from many such cycles, but with an understanding that there are important differences. So what I emphasized before, the reason that the inflation came down and we had a soft landing in the United States was partly that it was a supply-side driven inflation, which was naturally self-correcting. I think the Fed raised interest rates too much, and we would have had a harder landing except for what happened on the fiscal side. And that was a little bit of luck. That is to say, we needed to do something about infrastructure. We needed to do something about restoring national sovereignty, economic sovereignty through the CHIPS Act and the Science Act. We needed to do something about environment, and we passed the IRA Act. Each of those were really hard. And if you remember the politics of that, it wasn't obvious that we were going to get those bills. And when we passed the IRA, the Inflation Reduction Act, no one knew for certain how many companies were going to take advantage of it. And the CBO that estimates the extent to which people would take advantage of it estimated that the IRA was going to cost something like $350 billion on the tax credits, and now it's estimated to be somewhere between $1 and $1.5 trillion. So that pumped more money in the economy. So what you had is, in my judgment, two things balancing off. The Fed made a mistake. It raised interest rates too much. If they, but at the same time, we had an extraordinarily strong fiscal policy, and those two, it was luck to some extent that we've had the soft landing.
So we're in the soft landing right now.
We are in the soft landing, but it ends on January 20th, and that's when we start getting into a harder place, where we don't actually know where we're going to go. That uncertainty, by the way, is not good for the economy. Uncertainty fiscally, uncertainty about the international situation. That's not, investors don't like that kind of environment. And if we recall the chaos of the previous Trump administration, I don't think that uncertainty is going to go away quickly.
Well, we'll have to leave it there. We'll have to get you back here to discuss this. Professor Stiglitz, thank you so much for your time. I appreciate it.
Thank you.
little bit of contrarianism here as we get closer to the end of our day. Really interesting stuff there from Professor Stieglitz and from Allie. In the meantime, speaking of what may come, we know what's been happening in media. Those of us in the media know very well that it has been a turbulent time for our industry. Somebody else who has some unique insight into what has transpired in media, both from as a participant in the industry and now more as an observer of the industry, is Chris Licht. He's joining us now, the former chairman and CEO of CNN Worldwide, along with our Yahoo Finance anchor, Shauna Smith. Please join me in welcoming them to the stage.
Chris, I like that. I'm now an observer. I'm going to use that. I'm an observer.
That's why we have so many different directions to go in this conversation here over the next 20 minutes. Chris, let's start. I'm sure many of our audience is very familiar with your career, but just your proven track record that you have in media. You started in local news, worked your way up to becoming one of the most influential news executives in the country, creator of Morning Joe, helped create CBS This Morning, led Stephen Colbert. All before then, you went to lead CNN. I bet you a lot of people are wondering what you've been up to since you've left CNN. So let's start there.
Well, it's good to be here. I will say first, I can't let it pass. I did not create Morning Joe. Joe Scarborough created Morning Joe, just because I'll get a phone call.
Been a lot back and forth.
So I have this really unique situation of having time. Mm-hmm. And so what do you do with that time? And I have decided sort of to make my full-time job to figure out where things are going. Because whatever I do next, I don't want it to be, something that isn't building and forward-looking, but no one really knows where things are headed. So I would say for the last year or so, I have taken it upon myself as my full-time job to just meet people and talk to people. And I've been very rigid about how I do it. I am up to about 275 conversations. Wow. I keep track of them in Salesforce software. What did I learn? What is this person? What's unique about what they're trying to do? And generally, it's people that I've never interacted with before. And it's so ironic because when you run these large organizations, you're so hyper-focused on what you're doing that you don't really have a chance for a lot of external focus. Mm-hmm. So that's what I've been up to, meeting people, talking to people, learning, listening, not really looking to jump back in immediately, but through those conversations, advising some companies. I went and taught a class up at my alma mater at Syracuse on the future of media, which was more, hey guys, what's the future of media, as opposed to me saying it, and trying to be a better dad and husband and getting my pilot's license.
There you go.
So that's kind of what
That's a heck of a lot. It sounds like you've been very busy in the time since you left CNN. You mentioned the fact that you've had, 275 conversations with various individuals as an observer of the media industry. I'm curious what you have thought about the transition that we are undergoing right now and what that tells us about the future of the media industry.
I would say that I'm much more bullish on the future than most people are because of these conversations, that there are a lot of really interesting people doing really interesting things successfully that you've never heard of. And there's a lot of people working on satiating what is a massive desire to consume content, whether it's in entertainment or news, and finding ways to do that outside the current legacy system. So eventually, some of these things will bubble up and be either co-opted by the legacy companies or will just propel past them. But there's really smart, interesting people that are, I think, going to be the future of where the business goes.
What does that tell us then about the future of traditional media? You mentioned the fact that they maybe either have to adapt to some of these changing times or they might be surpassed by some of these smaller, more niche players. Is there a way out for a place like CNN?
I mean, listen, there's nothing more annoying than someone who's in it trying to, slay dragons 24/7 to have some asshole go, well, I really don't think they really need to, so I'm not going to do that. But I will say there isn't a media executive that doesn't know that there's a problem. There isn't a media executive that isn't actively working on that problem. But I don't know that, here are some facts. The facts are that people have lost trust in legacy media. That's not me saying that, that's a demonstrable fact. That has not happened in the last 6 months. That is something that's been happening for a long time, and people are tuning out.
Right.
So can legacy media reinvent itself in a way that then can reconnect with people and become relevant in their lives again and become trusted? I don't know. But there are definitely people who are starting from scratch that don't have that scale, but possibly those two worlds will come together. And I think the people that figure it out, there's a lot of economic upside, but also for our society, because you can't exist in a low trust society, which is where we are right now. And I think it's important to delineate between two things, right? There is trusted sources of information, and then there's trusted opinion. And I think those two worlds need to be very separate. And I think part of the problem is they've kind of commingled. Yeah. And, media organizations will try very hard to say, no, this is our news gathering and this is our opinion. But in the world, people don't make that distinction, I have found. So I think that what you're going to see is someone's got to figure out how to restore trust, and that these are the facts. And then let people go and have their opinions, but they want to go armed with what the actual facts are. And right now, we used to have one set of facts, and then you could have 30 discussions around that set of facts. Now you have 30 sets of facts and 1,000 discussions around those sets of facts. And that has to change, or we're in big trouble as a society, which is a much bigger issue.
And I guess, how do you do that in what will soon be the environment? I guess right now it is the current environment. You have President-elect returning to the White House. He has been very vocal about fake news. He attacked CNN multiple times over the last 6 to 8 years. How much more complicated is rebuilding that trust than under a second Trump presidency?
I think these are issues that are larger than just a Trump presidency, but my completely unsolicited and I'm sure annoying advice is swing at the pitches that are thrown. To completely butcher a Chris Rock phrase, if someone kills 8 people, don't say they killed 9. He's gonna do enough things that really require scrutiny and sounding the alarm bells. Don't say, well, this means this and that means that's going to happen. Say, he did this, and then let's discuss what that means. Not, well, this is going to mean this. Because a lot of times the media gets in trouble when they predict things. And I would say there's been a lot of, as an observer, a lot of hyperbole around what a Trump presidency will mean. And it's the end of democracy. Well, if it's not, if 4 years from now it's not, then we have a problem with credibility. So instead, he's appointed this person. This is this person's track record. Not, that means he's going to do this, right? That would be my unsolicited advice of, there will be enough to discuss. There will be enough things that are going to be controversial, but he and his people know exactly what they're doing when they try to gin up what one of my former colleagues called outrage porn. If everything is an 11 and everything is outrageous, then you're able to kind of slip through some things that are actually should create that outrage.
Curious, one of my big takeaways, and there's many takeaways from this most recent election, but one of them in terms of media was the decline, obviously, in traditional media and the rise in alternative media. And I say that with the rise of podcasts and maybe the influence that has really had, especially it seems to be among younger male audience. I'm curious, is there a way that traditional media can shift and adapt to this new reality? And what does that look like? Is it more gender-based? Does it change depending on gender, depending on demographics? I guess how should the media be thinking about that?
So again, I'm speaking really about opinion. Mm-hmm. And in an ideal world, those podcasts, et cetera, would get this one set of agreed upon facts. But in absence of that, what you have happening is people are building communities. Mm-hmm. And so if you're not getting what you need from the traditional world, you go someplace where there's a like-minded community. And television, just broadly speaking, is not a visual medium, it's a connection medium. And if people can connect and build a community, that's where people will go. Now, I don't think that's necessarily a bad thing if you're dealing with the right set of facts. Can traditional media create that kind of community without sacrificing their impartiality? I don't know. It's tough to imagine that you would build a community around, well, that's true, mm-hmm. right? You want to build that community upon taking those facts and what does that mean? Mm-hmm. And I think this is an investor conference. I would invest in something that is going to roll up some of these people and personalities that have built a community so that you can then scale it. I see that happening. I'm involved in those conversations. That's where people are thinking, because there's people out there that are making a go of it based upon truth-telling or not being afraid to question things and not being part of the mass, groupthink. And if you can tap into that and scale it, that's a good place to maybe monetize the future.
Those that are successful in doing that and those that aren't, the conversations that you've been having, what is it that differentiating factor?
Authenticity. And that works, I think, no matter whether it's a late night talk show or you're a news broadcaster or you're an opinion person. If your opinion or your analysis of what's happening is authentic to who your audience sees as who you are, then that is what makes you successful. If you are contouring yourself to match some kind of ideology or to not piss off a certain group of people, or people see right through that, right? I think the ones that are going to get rewarded are people that have fortitude, they're fearless, they speak the truth, their truth. They are not afraid of pissing off some kind of, imaginary horde of online people that are going to descend on you for having a dissenting opinion. And I think you've seen that a little in the election. That was the electorate kind of going, we don't want that. Mm-hmm. And I think broadcasters that can tap into that, and there's people that do it very well. There's people at mainstream legacy media companies that do that very well, and there are those who don't. And I think that's where you're going to see success tied to.
It's interesting. It reminds me of some of the headlines, really, that we've seen. Even this week, you have Chris Wallace leaving CNN. Apparently, he is thinking about, reportedly, wants to focus full-time on long-form podcasting. There was also a report out today talking about the fact that we might see more cost-cutting measures at places like CNN just because of the decline that we've seen in ratings. I'm curious, if you take a name like Chris Wallace or some of these other bigger names that have a proven following in traditional media, what does that look like once they do go out on their own? And I guess what are some of the things that we can learn about just in terms of how people will then consume media and whether or not that is a threat or not a threat to democracy as you talk about more of the opinionated programming getting more viewership?
I think if people are getting as their primary source of information from people that have no journalistic guardrails, that's very dangerous. Mm-hmm. And I think as we go forward, truth and what actually is happening, because we will have a president that has a loose relationship with the truth, will become almost a commodity. Mm. It'll become something, and there may be some big event that forces everyone to go, no, but what's really happening? And if someone can emerge as this is what's happening, and perhaps there becomes a Bloomberg terminal for truth, right? That people who operate in the world, whether you're in finance or government, or you operate where you actually have to know what's happening, that can almost be a wholesale product. I think that's the direction we're moving in. And again, if you're one of these talent that could then take that truth and interpret it for your people that are in your community, that will be the pathway to success. And there are people that have followings that can go and make a perfectly decent living, but can you scale it? Because you're always going to reach many more people on a CNN than you will, generally speaking, unless you're Megyn Kelly or Joe Rogan or some of these people that have massive followings on your own platform.
What do you think about the thought of the death of cable news? Is that greatly exaggerated as you look 5, 10, maybe even 15 years out? Is that a reality?
I think it's like the death of radio, right? I think it will absolutely decline. The sub fees will decline, and that's why you're seeing cost cutting. I think there's a floor. I don't think that one day you're going to wake up and there is 0 cable subscriptions, but there might be different ways to distribute said signal, because at its heart, news is a passive. It's something you have on in the background usually, and so it's less successful when you have to go and like press a button and watch it and have it on there is as soon as you start having kids and have to get kids ready in the morning and make breakfast and all that stuff, you want it on in the background, and that is passive viewing. And so what is that going to look like? How is that distributed? Might be different, but I don't think the legacy linear feed, it might be distributed a different way, but I don't know that there's going to be a death of it. I think you're always going to need that kind of passive viewing experience.
Chris, they say hindsight's always 20/20, so I got to ask you, if you were taking over CNN today, would you do anything different this time around?
Oh, yes.
And what would that be?
That's really between me and my therapist.
Anything you want to share with us?
No, look.
It's always good to share.
In all seriousness, I have spent an enormous amount of time not worrying about the situation I was in, but how could I have handled those situations differently? The things that I could have controlled. And so that is something I spent genuinely a lot of time and a lot of sort of humbleness of saying, okay, not everyone was out to get me, right? Like, so what could I have done differently to have made the mission, more successful? Because remember, I left the greatest job in the world with Stephen Colbert, and I'd never wanted to get back into news, and I did it because I felt it was a calling, and because I'm a journalist at heart, and it's devastating to me that it didn't work out. So yeah, there's a lot of learnings. But we're really running late on time.
Well, what's next? Will you return to the control room, you think, one day?
Right now, I think whatever I do, and I still have a little bit of time, but whatever I end up doing, it's going to be with people I want to do it with. It's going to be something I could be proud of. It's going to be something that's fun. And it's going to be something that I can build with somebody and help them. A lot of these conversations always sort of ends with, is there anything I can do to help you? And many of them have taken me up on that offer. So as anyone who's in the startup business or in the building business knows, there's a lot of times there are fits and starts. And so, yeah, there could be like 3 or 4 major things that I'm a part of, or 0. So it's really about putting out into the world, is there something I can do to help? And the groups or the organizations I'm working with is everything from like a startup that's built a virtual control room that can absolutely change production as we know it, an AI company in Israel, an Israeli company that stops deepfake AI by using AI, a YouTube sports company, so like there's that kind of stuff, and then there's people who have capital that are very interested in solving this problem, and I'm as much as I can help with that, I'm doing that too. So keeping busy, and also enjoying time with my family, and I would say, reintroducing myself to my kids and having my wife say, "Oh, you have parenting thoughts, so that's interesting." Well, welcome back, but really trying to make the most of this time as much as possible.
Well, unfortunately, we are out of time. Wish we had double the time here. But Chris, thank you so much for taking the time to join us today.
Thanks.
Everyone, we are almost there, and Chris and Shauna, thanks for that conversation. Chris, I'm sure our DevOps team certainly took to heart any type of Bloomberg terminal for truth, and we're going to get on that stat so that we don't get beat to it. Coming up next, artificial intelligence, we know, is not new, but a new inflection point is clearly forming here. IBM, known in your hood as Big Blue, developed Watson 20 years ago and put the technology front and center. And you may have seen some of their subsequent marketing campaigns over the year as well, all humanizing its artificial intelligence muscle. But there's plenty of new competition, as we know as well, in the race for AI dominance. And so please welcome IBM Chairman and CEO Arvind Krishna and Yahoo Finance anchor Shauna Smith.
You guys are stuck with me for another 20 minutes. Arvind, it's great to have you here at Yahoo Finance Invest. Thanks so much for taking the time to join us here this afternoon. We've talked about so much here today when we talk about the state of the economy right now, investment in AI, the outcome, the election, obviously everything, all of that applying to IBM. So it's kind of tough to figure out where to start, but I think I'll start with the election because I think that touches on almost everything IBM maybe will be doing here over the next several years. I'm curious just how the results are influencing your strategy and how you're navigating the next 4 years.
Yes, Shauna, first of all, it's great to be here and thank you for having me. Look, when I think about the election, one of the uncertainties that was weighing, I'd say, on the economy globally, if I go back 6 months ago, was elections. And what would the results be? And they could be of very different forms. That uncertainty is gone. Business does a lot better when uncertainty goes away. Two, I think that we are all hopeful that there is going to be a lot more innovation and there is going to be less regulation. Those are both good for business across the board. I always acknowledge we need some guardrails. I always think, at least in the United States, with our system of separation between the judiciary and the legislature, there'll be some guardrails. But I'd say the business community overall, and us especially, are excited that we think there will be tailwinds to the economy going into 25 and perhaps even more after that.
So then what does that look like? You mentioned one of the things in there is that maybe we could see a little bit more or lighter regulation than over the next 4 years. What does that specifically mean for IBM? Is it M&A? How do you plan then, or do you plan to kind of capture some of that?
Actually, the first and foremost is not about M&A. The first and foremost is business leaders, our clients, to be precise, have to make investments in CapEx and OpEx. If you think that the climate is going to be more certain for 4 years, the chances you're going to make those decisions quicker is higher. If they're going to make those decisions quicker, we'll tend to win. If we're going to win, then we are going to invest more because we want to participate in those victories. And so that drives the whole cycle upwards. I think that's number one. Then number two is, yes, if we have more certainty on the outcome, we are willing to more lean in even to things like M&A. And if the regulatory process and antitrust is going to be more certain, that allows you to take more risk in there. And so I think there's going to be a vector of positivity there as well. But it's really the former. I think people are underestimating how much more investment there is going to be, and that's then going to drive investment in those who can win from those CapEx spends.
So what does that mean for IBM then?
I think that the AI spending from our clients is going to go up. I think the automation spending is going to go up. If I predicted the labor demographics are going to get even worse, maybe there's some policy statements that imply that. Well, technology is a way to replace labor, so that means more technology will get deployed by our clients. And so those are the kinds of vectors that we are looking at to help accelerate our business. I also think that there is going to be more of a appetite for US technology globally, with maybe a couple of small exceptions. Maybe they're not so small, but those are already exceptions. I think with those put aside, I think there's going to be a lot more appetite to go invest in US technology from all over the globe.
And you have a very unique view. You have the services side of the business, also the product side of the business. I'm curious, how are you seeing that just in terms of priority of spend here from your business clients, and how you see that shaping up here over the next several years?
So we have a software business that's about half our total business. We have a hardware business that's about 20%, and services is about 30%. Software has been on fire, 22, 23, 24, and I expect it to accelerate going forward into 25 and 26. So that is very clear when you think about products. On services, given what I talked about uncertainty, there has been a slowdown in the second half of 24. I expect that'll last a little bit into 25 because people are going to be deciding what kind of projects they want to do. And unlike sort of CapEx spending in products where you can turn on and off at a switch, labor-based spending tends to be sort of slow on the way down, but then slower on the way up. I expect somewhere mid-year, as people begin to say, we want to do these big transformations, that's going to speed up also. But probably it goes through a little bit of a slowdown. Not anything negative, not anything catastrophic, but just a bit of a slowdown, I think, for a few more months.
Arvind, there certainly has been a lot of excitement surrounding your stock. Your shares aren't too far from an all-time high. You talk about the fact that there's a lot of momentum within IBM's business right now. I'm curious, how much of that do you see just in terms of continuing to drive that near-term momentum? How much of that do you see being cost-saving measures versus what you're seeing in terms of any incremental improvement that you're starting to see of revenue drivers and what that looks like?
Look, anybody who runs a business, cost saving is never going to get you a big return except for a very small amount of time. At the end of the day, the only thing that motivates our investors is going to be revenue growth, and if cash flow growth can be higher than revenue growth. Because that means you're taking share, that means you're vibrant, that's the best way of judging are the products and services you're offering attractive to the market. I think that is what has really driven the stock. If I go look at it over the past year, and it's been sort of 3 years of hard work to get there, but that's what has driven it. And that is what is going to drive it going forward. For example, in software, we printed 10% growth in the last quarter, similar in the last few quarters. 7% of that is organic, meaning it's what we built ourselves. 3% of that is from M&A. I think that's going to be the engine that keeps powering the stock going forward. If I look at our services business, this is going to be partly just in its own right, but more importantly, because it's an integrated business, it helps deploy software faster. It helps deploy our Red Hat software, it'll help deploy AI software, it helps our customers take much more advantage of the mainframe. That's really what the consulting business does. And I actually think that in a long-term vector, consulting taking more advantage of AI, where digital and AI workers are sitting side by side with human workers, is actually going to be a big motivator of both margin and demand in that part of the business.
Arvind, let's talk about your AI book of business because the numbers have been nothing short of impressive. You have 50% quarter-over-quarter growth that you saw within your AI book of business, right around $3 billion. I'm curious, where does IBM sit in relation to some of the other larger tech giants?
So, one, we are not in a consumer business. So we have no particular desire to create a model or a set of applications that we put out on a website and go get subscribers and go get whether hundreds of millions or billions of people. That's just not our business model. We are a B2B company. Our clients are people like Bank of America or Verizon or Elevance or Aetna, et cetera. Those are our clients. So the AI we do is meant for enterprise. So that's kind of a first big difference. We both leverage other people's models, but we also build our own models. And you kind of ask the question, well, why do you build your own models? Because some of our clients would prefer to get indemnity. They would prefer to know there is no data of unknown origin in those models. And so in order to do all that, if we have to look our clients in the eye and be able to give them those assurances, both in a contractual form and in an ethical form, then we need to build our own models. But there are plenty of use cases where other models could also be useful. So we do an and. So we will work with Azure, we work with AWS, we work with Google, we work with all the big models that are out there. But we find that over half the demand comes for our own models because we offer those extra attributes. But we're not changing the multi-100 billion parameter models, what I'll call the extremely large models, because even when we say small here, these are pretty large. I mean, by small, people talk about 30 billion parameters. 5 years ago, people would have started laughing at you if you did algorithms that are that big. So when we say small, it's more like 20, 30 billion parameter models that are great for a single task. I kind of say this a little bit, I'll say a little bit facetiously, but there is a lot of truth under it. If you have no idea what you're going to do, and you might be asking the model, please summarize an email, or please help compose an email, or translate a document from Finnish to French, or write me a haiku, or give me a small essay in the voice of Steinbeck, you probably need a very large model because you have no idea what it's going to do. If your question is simply, please read this document and tell me what are my 4 legal obligations, that is a much more precise and could be a much smaller model. We live in the latter world, not in the former world. So that's why we find that smaller models are as good. So you're not giving up anything on quality or accuracy. All you're doing is saying, can I run them a lot cheaper? So that's what we're after. By the way, just looking at our clients, I think customer experience, customer service, programming tasks, enterprise tasks, the ones that probably the audience finds a little boring and not so great to talk about, but there's a lot of money spent on them. Is it accounts receivable? Is it HR functions? Is it procurement? Is it supply chain? A not so random example, how many PFAS chemicals are in these 100,000 products that we make? Those are the kinds of questions that we love to answer using AI.
You know, Arvind, I was going through a number of recent analyst notes here over the last several weeks, and one of the notes that stuck out to me is from Jefferies Brenthil. He comes on Yahoo Finance's shows across the day quite frequently. And one of the things that he said is he's staying on the sidelines when it comes to IBM because he still has questions around the monetization of AI. What would your response be?
Well, I think 3 billion speaks for itself. That would be my first answer. And since that is an SEC reported number, those of you who report numbers know that those are some things that you're quite careful about. The 50% growth quarter on quarter that you mentioned, by the way, our number was 0 15 months ago. So this $3 billion book of business has been built up over 15 months. So I think those things speak to itself. I mean, look, I mean, with Jefferies or with Brett or with anybody else, I think in the past you could have dinged us that we were not able to monetize or convert a lot of our research into actual dollars. I think the last 3 years have been quite different. And I think if we begin to look at our track record there of what we've been able to monetize is different. So would I accept that criticism 10 years ago? Probably. Would I accept that criticism today? Probably not.
Does there, though, need to be more compelling use cases across the landscape here to justify some of the pricing and investment, do you think, within AI? Or are we there?
Look, I think that I use the analogy of the internet because I think that's the easiest way to think about these things. And people talk about, is this like the smartphone? No, it's not. Smartphone kind of went from 0 to 100 within 12 months, and then you were on a boom forever. If you look at the internet, I'd ask you the question, how many of you, most of you look way too young. Many of you probably don't even remember a company called Netscape. Netscape is what kind of brought the internet to people's attention. I'll call it attention because there was 10 years of work before that, but for the investment community, Netscape was 1995. That was the IPO, that was the boom. By the way, by 2000, it didn't exist. Let me point out. There are so many others I can go through that period. Excite, Ink2Me, Fast Forward, you can go on and on. Now, there were many others who did exist, okay? eBay came out of that time period, so did Amazon. Just by the way, Facebook and Google are post that phenomenon, so they were not actually even existing. I think AI is going to be just like the internet. There is an initial boom. People were excited about what today you would call social media. Then there came the boom of the B2B and e-business and all of those things that followed sort of 3-4 years. And even if in the late 90s, people were wondering, is this useful for me? You know, I got so excited, but like a website and a browser, what the hell do I do with that? And then by 2001, 2002, people realized, oh my God, my cost of distribution is plummeting. Could I somehow connect my supply chain and my plants with inventory all the way out to a website, and suddenly distribution, which has been the cost of business for 100 years, becomes so much cheaper, and those who figured it out boomed. And you can see what has happened to the world of online commerce. It's already, 30% of the US, and most business-to-business commerce is done electronically. It's not really done in person anymore. So you take those things and I kind of say, AI is going to play out like that. So I kind of react with, in the short term, are people saying, wait, it's already 2-3 years in, I'm not getting the return? Maybe. But this is one of those where 5 years from now, if you're not using it in every part of your business, I can look you in the eye and say, you're going to be fundamentally disadvantaged. I would assert that 5 years from now, those who use AI well will either have 10% more on the bottom line, and we know how the market will reward that, or you'll have revenue growth that is 10% faster than all your competitors, if I was to look at it that way. That, I think, is what you can see clearly.
Compelling use case. You talk about the increase in productivity. I think lots of questions about what ultimately that means then for the workforce. How do you see AI disrupting jobs?
Look, is there going to be some level of change to jobs? Absolutely. So in our own case, if I look at some of our HR functions, we need far fewer people in some, not in those who are giving cognitive help to their teams. So if you're advising somebody on the team makeup, on what kind of gaps you have, how people should be developed, that's very much human, and I think will remain human. But simple tasks, write me a letter that verifies my salary and title. Why do I need a human for that? Those tasks are going to get taken over by AI. When you put that all together, I think that means 5-6% churn in jobs. Well, 5-6% is less than half our churn in any case. So it's easy to absorb that much. And by the way, if we are more productive, I believe we'll get more market share, which means we're going to need a lot more people in sales, in client-facing roles, in engineering, and in all the tasks that really create value. So there will be shift, I think, at that rate, 5-6%, from more repetitive tasks to more value creation jobs. And that's what then we should do. What do? We try to upskill our people to be able to ready for those jobs. So we put all of our people through AI training. We let them take advantage of how they think AI will impact their role. Mm-hmm. And there's excitement around it. I mean, over 80% of our people participate in those upskilling criteria.
Are you at all facing a talent shortage? And I bring that up in the context of obviously lots of focus around immigration policy, what that's going to look like under Trump. If we do see significant change, does that potentially exacerbate the issue that's already at hand?
So there's always 2 to 3 ways to look at it. Number one, I'll answer directly. Is there a lack of talent, more than the word talent shortage? Absolutely. I mean, I don't need to say that. You all know it. Cyber, 500,000 jobs are left unfulfilled. In programming, we can debate, is it 3 million, 4 million, 5 million jobs that are left unfulfilled. So I think for high-skilled jobs, there is a severe shortage of talent. I think we should accept that. We shouldn't debate that. I go upstate New York. People there talk about not being able to get enough workers to do jobs on farms and factories and to service the towns. So it's more than even our high-skilled jobs. There's a lack of talent. Now, it's more than immigration. The entire world, other than Africa, is now losing people. Right? China's losing people, South Korea is losing people, Japan is losing people, Europe is losing people because birth rates have come down. If birth rates have come down, there is going to be a lack of people on the globe, put aside the US. So we all have to learn how to leverage technology to do some of the jobs that people used to do in the past. I think there's no way around that. Then you have to then leverage talent where it is. So you can do some things offshore, you can do some things onshore. There are many things that will always remain onshore, but then how do you get more out of the people, and how can you punt the tasks that don't need people to machines?
Arvind, there's much more, a couple of follow-ups I want to ask you, but we're running out of time, and I quickly want to get to just your personal story, because you started with IBM decades ago, worked your way up through the company, and I'm curious what you've made of the evolution of IBM during that time, and what makes you so excited about the next 5 to 10 years?
Yeah. So Sean, I was referring to, I've had more than 3 decades at the company. I know that's unusual nowadays, but I've loved it. Look, it's very simple. You got to go back to your core value. What is our core value? We deploy technology that improves our client's business. So if you go back to that core, then you say, obsess about the client, focus on innovation. We can't do everything. We have picked AI and hybrid cloud as the vectors we're going to compete in right now. Put all your eggs in those baskets, and then produce great technology and great experts that can help our clients deploy those two to benefit their business. It's really kind of that simple. Not so simple to do, but simple to say.
And you can say, and your smile says it all, the excitement on your face. Arvind, it was great to have you here. Thank you so much for taking the time. We appreciate it.
Us out there from Arvind and Shauna. Thank you all so much for being here today. The folks who are here in person, thank you to the folks watching at home. Brad and I have had a really great time taking you through the day.
Absolutely. You guys have been a stellar in-studio audience, and for all those who have been, of course, engaging online via social media or via our live stream as well, we appreciate you tuning in. Of course, stay tuned for some of the stories from the headlines that were made here today as well. Our team has been, I've been hearing Madison Mills' keyboard from over here.
Back and away. One more thing, though. The man we call EE, our executive editor, Brian Sozzi, just has a few closing thoughts for you before we leave you.
High five, guys. There we go. Thank you, guys. Thank you, all of you. No prepared remarks on that screen. You can see it. Just going to roll with it and go from the heart. A couple thank yous. Thank you to the Yahoo Finance team and crew. Let's clap it up for them. The folks behind the camera, Julie, Brad, all the journalists that are on here interviewing and talking to these really powerful executives about, 6 days after the election. The job that this team has done over many, many months is mind-blowing. I am so proud to be a part of them. So thank yous for that. Thank yous to folks like Drew over here, a longtime follower of me and Yahoo Finance. And Drew started sending me stories or posts on LinkedIn. I'm coming to this event. I'm coming to some. Well, I don't know this guy, Drew. I have no clue what he is. He sent me a photo. We took United Airlines, right? There we go. And so I met him over there. It's folks like Drew is why we do what we do here at Yahoo Finance. The passionate investor, the community of folks in this room that came here at 8 a.m. and are still here engaged with our audience. You are why we wake up in the morning and try to make sense of complicated topics and things coming at us so fast, especially after the election. So I thank you for your support, and I thank you, all of you, for your support, because you're the reason we're here, and I thank you for the folks that are like Drew watching us on the live stream. Two small things I will note. One, every year, for as long as I've been here, I think 6 years, but even before that, we've introduced our Company of the Year award. It's just a cool thing we do every year, award one of the best companies that we follow here, an award for, I don't know, they do good on sales, earnings, leadership, whatever it is. This year we're expanding it, which I'm very excited. So our Company of the Year award winner will be released on December 16th. We will have successive award winners starting after that. So save it on your calendar. We have some amazing interviews coming up, some amazing content. December 16th is the first day. And last but not least, we're going to continue the conversation, a lot of conversations that we had here at Invest on the Opening Bid podcast tomorrow morning. So I'm back at the NASDAQ, taping that around 7 a.m. That episode will drop, I believe, like 8:30. Check it out on Yahoo Finance. And that's it for this year's Invest Conference. Thank you so much, everyone. Appreciate it. Thank you.
Welcome to our live coverage following Yahoo Finance Invest in New York City. I'm Madison Mills alongside Alexandra Canal. We just heard from several amazing voices today. The CEO of AB InBev. We also had Joseph Stiglitz over at Columbia University, who Ali spoke with. Chris Licht, former CNN CEO. We also had Arvind Krishna, IBM's chairman and CEO. So Ali, I want to run through with you just a couple of the big takeaways from the day, hitting the macro picture just across the board, right? From the Federal Reserve's perspective to individual CEOs. What stood out to you?
A big dominating talking point was that we're going to have a Trump 2.0 presidency. That seemed to be the takeaway from a lot of these conversations, is that things are going to be different. One conversation that really stood out to me was from Federal Reserve President Neel Kashkari from Minneapolis. He talked about how inflation could be the only thing that would make the Fed pause their rate cutting cycle in December. We know that CPI comes out tomorrow. So really, tomorrow is a very critical report. If we see that that coming in hotter than expected. We could potentially see a pause there. Joseph Stiglitz, you mentioned him, Columbia University professor, Nobel Prize-winning economist. He had some very interesting takes about Trump policies, how that could lead to more inflation over time due to the high tariffs, also immigration, how mass deportations could harm the jobs market. So Stiglitz arguing that those policies will kind of derail the soft landing that we seem to be enjoying right now. Then you mentioned Chris Licht. As someone that covers media closely, that was a fun interview to watch from Shauna. She asked him if he were to go back and do anything differently from CNN. He was ousted from his position, what he would do. And he basically said a multitude of things, but that it was between him and his therapist. So he made a little bit of a joke there, but he did talk about the importance of truth in media, especially as we see a lot of these longer form podcasts come out. And also he mentioned that the fact that we have Trump in office again, that's going to be a very interesting backdrop for the media picture at large.
A great backdrop for media at large to continue to monitor. Having said that, we're going to get back to our bread and butter. We're going to do a check on the markets with our very own Jared Blickery. Hey, Jared.
Well, thank you. We got bread and butter futures here. Actually, this is kind of a red board and a couple of green spots here, but the Russell 2000, the small caps, leading the way down today, down 1.75%. Dow is off about 86 basis points. NASDAQ down 9 basis points, but kind of a low volume day in the market. Here is the VIX. Just wanted to draw this quickly for you. This is what happened intraday. Drop below 15. So volatility has been on the way down. Here's a 5-day look. It was north of 20 just before the election. And let's take a quick look at the bond market, how that settled. Just up slightly here. Well, actually up 12 basis points. That was quite a bit from yesterday. Although over the last 5 days, you're seeing it's kind of just come back up to where it was last Tuesday. Now let's check out the heat maps. And in sector action, we only had 3 sectors in the green today: communication services, tech, and staples. And arguably, it was kind of a defensive day. You can see materials, that was the worst performer. XLB down 1.7%. Healthcare, consumer discretionary, real estate, utilities, all down more than 1%. And I showed a very friendly looking NASDAQ 100 before. You can see NVIDIA very close to another record high. Not quite there just yet, waiting for some earnings in a couple weeks. That was up 2%, Amazon up 1%. But let me show the Dow here with a couple new components. We can see Amazon, which joined earlier in the year, that was up 1%, Microsoft 1%. And for the most part, a lot of these cyclical stocks seeing a lot of red today, and that was kind of the theme that we saw in a lot of our leaders. I'm going to end you with China. China has been a thorn in the side of this bull market for the last 5 days, and another red day here.
All right, Jared, thanks so much for that. We heard from a lot of great voices today. We want to take a listen to some of the conversation with Minneapolis Fed President Neel Kashkari.
Please welcome Neel Kashkari, who's the president and CEO of the Federal Reserve Bank of Minneapolis, and Yahoo Finance senior reporter Jennifer Schonberger.
The economy keeps surprising to the upside. We got third quarter GDP of 2.8%, driven by strong consumer spending, up 3.7%. We've seen household incomes, savings revised upwards. Can the strength continue into next year?
I think so. I mean, that's you, in your question, you said it correctly. We continue to be surprised by the resilience of the U.S. economy. 3 or 4 years ago, if you'd said to me, we're going to raise interest rates by 500 plus basis points, I would have thought that would slam the brakes on the U.S. economy. It hasn't. The economy's been remarkably resilient, which is a really good thing. So in the last couple of years, we brought inflation down, not all the way to 2%. We're running at about a 2.5% rate, and the labor market has remained strong. Right now, it looks like that's going to continue. I do a lot of outreach to businesses, large and small, across my part of the country, to labor groups. They all share cautious optimism. And so right now, the fundamentals seem strong, and I'm optimistic that's going to continue.
How do President-elect Donald Trump's proposed policies, from across-the-board tariffs to mass deportations, tax cuts, and deregulation, influence your outlook for the economy, understanding that we don't quite know the exact timing and extent of the implementation of these policies?
Well, there's so much uncertainty about what any new administration is going to do, ultimately what they're going to do in negotiating with Congress. We at the Fed simply have to wait and see Whatever the Congress and the executive branch decide to do, we will then model it into our analysis of the economy, analysis of the economy's potential and outlook for the labor market and inflation. But until those policies are decided upon, until they become clear, we can't do anything. And so we're just going to wait and see.
On the proposed tariffs, we know that the president-elect has said that he's looking to impose 10% tariffs on all U.S. imports, 60% tariffs on all Chinese imports. If that scenario were to go into effect, what impact would you expect on inflation and supply chains?
Well, on inflation, just step back from those specific proposals and just think about how tariffs work. A tariff, generally speaking, from an inflation perspective, we think of as a one-time increase in prices. So if you have a 1% tariff, you could think of it as a 1% increase in prices of those goods that are subjected to the tariff. That by itself is not inflationary over the long run. It's a one-time change in the price level. Where it becomes complicated is how the other country responds. So if there's a tit for tat and an increase in tariffs from the US, a response from other countries, and it goes back and forth, then you could imagine a longer term inflationary impact. And so right now, as I said a moment ago, it's uncertain what the proposal will be, what will get implemented, and then importantly, how other countries will respond. Right now, we're all just guessing, and so I can't opine one way or the other.
Let me ask you about your outlook for inflation. You said earlier this fall that you weren't too worried about upside risks to inflation. You cited wages and core non-housing services prices that continue to fall. But core PCE, your favorite inflation gauge, has been stuck at 2.7% for 3 months. So how confident are you that inflation is still falling to your 2% target?
Well, we break inflation down by its subcomponents. So goods inflation is running roughly back where it was pre-pandemic to slightly disinflationary levels. If you look at other parts of services inflation, they're tied to wages. Wage growth is slowly cooling. Housing inflation is the big elephant that is still out there. And if you look at where new leases are, new lease inflation has already fallen back down to very low levels. But new leases take a couple years to work their way through into the broader measures of housing inflation. So, I don't want to declare victory too early, but I think there's pretty good reason that we have confidence that the housing piece of this will slowly return back down to more normal levels. Ultimately, we're going to get back down to 2% inflation. It may take a year or two to get all the way there, given some of these housing dynamics, but the trends so far are encouraging.
What about the job market? We've seen a lot of volatility in those monthly jobs reports. The October report slammed by those 2 hurricanes, the Boeing workers' strike. How are you looking at the labor market now?
Well, the labor market, as we mentioned a few minutes ago, has been surprisingly resilient, a 4.1% unemployment rate. It's a good labor market. When I meet with, again, not just businesses, but also labor groups around my region, it's one of cautious optimism. I mean, a bunch of labor unions that I've met with recently have said that they're feeling confident enough that they're going to have some actions taking place, meaning they're preparing to strike. They're feeling like they're in a strong position. Usually I don't hear labor unions talking about that if they're feeling like the pendulum has swung away from labor. So most of the dimensions that we look at, the labor market is still strong. It is not as red hot as it was a year or two ago, but the fundamentals are still sound. And so that's encouraging to me that the labor market looks robust and consumer spending continues to surprise us. Consumers continue to be resilient. The fact that the savings rate has been revised up is also encouraging, suggesting that consumers on average are not getting overextended. So right now the economy looks like it's in a strong position.
We know the consensus of the FOMC is for 4 more rate cuts next year. Given the strength of the economy that you expect it can continue, given your comments just now on neutral, do you see fewer than 4 rate cuts next year?
We have to see what the data says. I mean, ultimately, the data, one thing that Chairman Powell says is the neutral rate is not directly observable. We know it by its effect on the economy. And so we're going to continue to monitor the labor market, inflation, GDP, spending to try to ferret out how close are we coming to neutral. I think we all agree we are above neutral now. But over the course of the next year, we're going to get a lot more information about where neutral is. And we're also going to be looking at market signals in terms of the real yield curve. Where is the long end of the real yield curve? That's giving us some feedback as well. So yes, the neutral rate has been elevated in recent months or the last couple of years. How long is it going to stay there? We're not sure.
You mentioned the yield curve, the yield on the 10-year Treasury up better than 70 basis points since you first started cutting, and you've actually cut by 75 basis points. So how does that complicate your job if this persists? And where do you see the yield on the 10-year going?
Well, it complicates it. Trying to assess this conversation we're having is a lot about trying to assess how restrictive is the stance of monetary policy. And I always think that there's four components, four instruments that we have in monetary policy. There's the federal funds rate, there's the path, the expected path of the federal funds rate, there's the balance sheet, and the expected path of the balance sheet. All four of those are individual tools that go together that represent the stance of monetary policy. And I look at the long end of the real yield curve, so say 10-year tips, as a proxy that puts all of those components together. 10-year tips today is something around 2%. Prior to the pandemic, it was roughly around 0, which at that time I thought was roughly a neutral stance. In the middle of the pandemic, with all the stimulus, we drove it down to -1. It then went up to about +2.5 and is now running at around a 2% level. So right now at a 2% real tips rate at the 10-year, the economy is still performing pretty well. And so we're going to need to watch and see. Again, it goes back to, are we in a higher productivity environment? Are we in a higher structural growth environment? Can the economy grow with this type of real yields? We're going to have to see, and it's going to ultimately be a judgment call as we take in the new data and adjust our policies in response.
But you can buy a virtual ticket and watch it.
I'll buy a ticket. Let's bring in our own Julie Hyman and Brad Smith to get their biggest takeaways from the day. Guys, great job emceeing today. I know everybody's a little exhausted, but we got to keep the lights on for our takeaways. Brad, let's start with you.
Let's go. 8 more hours of programming. Let's get it. Fire it up right now. You just have to book it out.
Your number one takeaway from the day.
Honestly, I think we finished with a heavy hitter in Arvind Krishna. Everybody wants to hear about what the next inflection point in artificial intelligence is. And IBM has been at this for decades now. I mean, I was in high school when they started rolling some of the ads for Watson. And now 2 decades later, you think about the fact that, oh my gosh, aged myself. Now you think about the fact that this company is really continuing to sign deals. They're continuing to think about growing out the data center. I mean, they've been essentially at the center of a lot of the different buzzwords that we've heard over time. Think about it. Whether it's AI in multiple iterations, whether it's blockchain in multiple iterations. This company has talked about it, but also been about it as well. And as he was saying, pushing back on some of the analyst coverage out there, they're proving it through the revenues right now.
Well, I also thought it was really interesting what he was saying about AI, the point that he made that birth rates in the developed world are falling, that we are net losing people. And so something, there's all this hand-wringing about how AI is going to cost jobs. He made the case that we need AI. AI is actually necessary to decrease our reliance on repetitive task kinds of jobs because we are seeing that falling birth rate. I thought that was a really interesting point. But guys, one of the other takeaways from the day is the optimism that was out there. We just had a presidential election that bummed out half the country. The markets have skyrocketed, and most of the people talking here today sort of were looking on that brighter side of the equation. Now, you talked to Joseph Stiglitz, and he was cautious, to say the least, about what we might see come January 20th, right? I talked to Rick Reeder, and he talked about that the deficits and debt continuing to climb could end up being problematic for the economy and for the bond market. But by and large, people seem to be feeling optimistic, a little bit sunny here in this environment.
Yeah, it seems like there's more room to run with this economy. That was definitely a point that was made by several people on our stage today. Neel Kashkari saying the economy has been incredibly resilient, and I think in the face of higher interest rates, all these risks that we've been talking about for this past year, the fact that we still have GDP strong, unemployment low, stocks at record highs, that all is pointing to an economy that is really chugging along. He even said that we're in the soft landing right now. To your point, he said come January 20th, that could be derailed. And there's a lot of question marks, too, when it comes to Trump policies that he's promised on the campaign trail, how many of that will actually come to fruition, how aggressive it'll be, the rollout, which everyone was saying as well. We don't know exactly what's going to happen, but for right now, let's enjoy where we are, and it's pretty positive.
You know, what I'll add around this is there was a lot more fervor around Bitcoin now than I anticipated. And some of the guests, specifically Judy Shelton, that really caught my attention in her commentary around building out what Trump and some of his associates have talked about in a strategic reserve for Bitcoin. And I mean, I was ready to baseball slide across the stage and break some news to say that we had hit 90,000 on crypto or on Bitcoin today.
Now that would have been a moment, Brad.
I was ready. I was in full sprint stance, just waiting to steal and go into second and just slide across and say, hey, everyone, we did it. We didn't do it quite yet, though. But I was watching that, and the commentary around that, I think, just adds more fervor to this cryptocurrency landscape where people are looking both at gold, as she was talking about, and she has her book out that really kind of identifies that specific commodity, but now what digital gold might do from here, too, and whether or not we could actually see $100,000 in Bitcoin by the end of the year. That would be remarkable.
And to your point, too, Julie, this idea that is the market over its skis or is this rally fully justified, I think is something that she kind of touched on by kind of giving some pushback to the Federal Reserve. Brad, when we interviewed her a couple of months ago, she was very pro-Fed independence moving forward. That was not really my takeaway from hearing from her earlier today. She talked about a need for sort of a referendum.
Independent from what? From whom? I think it matters to her, probably, who's in the White House.
Right.
Her opinion of independence waxes and wanes with who is in the White House.
Which may be why it's changed since we last spoke with her.
Perhaps so.
What did you make of that, Julie?
I mean, Jay Powell's going to do what Jay Powell's going to do, and the Fed, as somebody else said,
he made that clear.
You know, as someone else said, I think it was Neil Kashkari or one of the other folks who we talked to said, you know, people can jawbone all they want. The Fed is going to do what its job it is to do.
Right.
That dual
the term is 15 years.
I think that's what we can continue to expect.
Yeah, and Neil talked about the 15-year term and how that creates consistency, right? No matter who is in the office, you have this consistent policy in place. You have people that know what their dual mandate is, maximum employment, keeping inflation closer towards 2%. We have that CPI tomorrow, which I'm very focused on. I feel like that's going to be a biggie when it comes to the future of interest rate cuts and, set this up to start off 2025.
It does.
And that's a great point, too, on the 15-year horizon, because we were talking with Tom Steyer, who I interviewed today, after his panel about kind of the whipsawing, the back and forth of government policies and how company CEOs may plan for one administration. What they don't want is to invest all this capital and then have a sea change and then have to rush over to this other purview, and the challenge that presents is also really interesting.
Yeah. And then finally, Chris Licht saying there is value in truth-telling, which is heartening for all of us, I think. That there is value in that in this environment.
Well, here's a cold, hard truth. Tomorrow morning, we're going to have some special coverage on Yahoo Finance, and I'm going to be back up bright and early for that. Maddie, I think we'll all be in some form or another.
No rest for the working
Julie
here.
will not be. Okay.
I won't be there for CPI. I will be with you in spirit. I'm awake. I just won't be in the studio with you all.
Just send us a hoorah or something.
I'll do it.
Exactly. All right,
guys.
Thank you so much for sticking around, both of you, after your long day emceeing and moderating to chat with us. That is going to do it for us here at Yahoo Finance from our Invest conference. Please tune in with us tomorrow at 8:30 a.m. Eastern Time for our full coverage of that October CPI report, all important that we've been chatting about here. That's going to have all things business, economics, and markets. Stick with Yahoo Finance. We've got you and your portfolio all covered.